So, exams are near. Yeah, last how many days? Sir, 9-10 days left. Yes, last 10 days are left. I know you're preparing 100%, you're giving 100% of yours, but you know these revisions are very, very important. So today we are here for this FR marathon. We'll be doing 100% comprehensive revision. Yeah, I'm not telling just a superficial one. We'll be doing a comprehensive revision of the full FR subject, and the total hours we'll be giving for revision is 20 hours. So 20 hours full FR to be revised starting from today, daily evening 5 p.m. to 10 p.m. So from 23rd to 26th, 23rd, 24th, 25th, 26th, 4 days. The next 4 days we are having this FR marathon, daily evening 5 p.m. to 10 p.m. Now sir, which topic to be done when? Okay, I already put it in our Telegram channel, which topic will be done on which date. So I am requesting you to just go through basically the Telegram channel. From there, you'll be able to understand which topic is to be done on which date. And just remember one thing. You're just on the verge of completion. Yeah, CA final, that too. The exams are 10 days. After that, 16 more days or 20 more days for examination, including that holiday due to that election. But next 30 days of yours are the most crucial one. Make sure this 30 days of yours are the best one and you are happy, satisfied with the efforts which you are putting in this 30 days. Good evening everyone. Achha, just one thing. Whenever we are doing this marathon, I want it to be two-way. It should not be just one way. Whenever I'm asking any question, keep on replying. It may happen that by the time your reply reaches to me, I would have gone ahead, but keep on replying. If you want that you are able to sit for 5 hours very comfortably, just make sure you get yourself involved. Now sir, which material to keep open? We'll be keeping our normal material open. I repeat, our regular batch which we have taken, the material of that you need to keep it open. If anybody is there who has not studied from me, I repeat, anybody who has not studied from me, keep the material which you have. Whatever faculty you referred, or suppose you are not referred any faculty, you just keep open the material which you are having and focus on the things which are given over here. No need to do calculation thing. Assume the calculations are fine. We'll be doing every theory. I repeat, whatever theories are given regarding any of the topics, that will be done, and all questions which are marked as important in our material, that all important questions will also be getting covered. So FR marathon from 23rd to 26th, 5 p.m. to 10 p.m. daily. Someone asked me, sir, about audit marathon. The auditing marathon I'll conduct during the exam days. For auditing, you're having 3 days off, 5th, 6th, 7th, and 8th is examination. So 4th, 5th and 6th, I repeat, 4th, 5th and 6th May will be the auditing marathon. Still 7th May you'll be having on your own, and exam is on 8th May. Anywhere you are stuck up, you have any doubts, feel free to ask me without any hesitation. Chalo, let's begin. This is our normal material which I am keeping open. Now, this is the index. All chapters whichever are given will be covering it. I'm just marking the chapters which I'm covering today. Okay, so what I'll be covering today, one is the introduction to Ind AS, that will be covered. Then I'll be covering your Ind AS 1. Ind AS 1 will be covered. Okay, then we'll be covering Schedule 3. Okay, then today we'll be covering is Schedule 3. And thereafter, we'll be doing business combination, consolidated financial statement, and one more, share-based payment. Yeah. So, introduction to Ind AS 1, Schedule 3, share-based payment, and business combination, consolidated financial statement. This is today's target. 4 days we are having. This is today's target. Let's begin with the introduction to Ind AS. Let's begin with introduction to Ind AS. You keep the material open at your place every 15-20 minutes, one sip of water, and make sure you keep on replying. Okay, now see why this Ind AS came. So the thing is, we know financial statement are a tool for communicating your financial position as well as the financial performance, and we have accounting standard earlier. The accounting standards are nothing but a set of documents, and they give you what? The accounting standard gives you the principles relating to various aspects like recognition, measurement, presentation, disclosure. How to recognize, measure, present, disclose various transactions, we had accounting standard. And this is basically to standardize the diverse accounting policy. It should not be like everybody doing accounting in their own way. For that, we are having this accounting standards. In India, who issues accounting standard? The Accounting Standard Board formulates accounting standard. So this was basically why we need standards. Coming to Ind AS later. Okay. Now, prior to Ind AS, we had a normal accounting standard. Prior to your Ind AS, what did we had? A normal accounting standards were there. Fine. Now, what is the limitation of accounting standards? See, accounting standards were there. So, sir, why Ind AS came? There were limitations. What were the limitations of accounting standards? One, for complex financial instruments, the accounting was not given properly under accounting standard. Two, the derivative instruments, how to account for them was not given properly. Group restructuring, acquisitions, merger, demerger, again, properly it was not given. We had AS 14, but things were not proper. Complex revenue arrangement, we had AS 9, but Ind AS 115 is much more depth. Complex tax provision, treatment, etc. So that few things were not available. Same way, how to account for basically employee stock options. So share-based compensation. That share-based compensation, we did not any accounting standard. We have Ind AS 102. So these things were the limitations of accounting standard, and that's why we needed a more comprehensive standard. Which requires more disclosures also. So that is the reason this Ind AS came. Now this Ind AS came from where? So globally IASC, International Accounting Standard Committee, was formed. That was basically in 1973, and under IASC, later on it is changed to IASB, International Accounting Standard Board. IASB was formed in July 2000. That IASC got converted into IASB, and they used to come out with International Financial Reporting Standard. Now see, earlier IASC, they came out with IAS, International Accounting Standard. Now IASC got restructured and now they are known as IASB. IASB came out with additional standards which are called as IFRS. The question, with IFRS coming, whether IAS are gone? Keep on replying. With IFRS coming, whether IAS are gone? Answer is no. So IAS, International Accounting Standards, are still there, plus this IFRS basically are additional standards which are there. Same topic IFRS came, IAS for that topic no longer valid. Fine. Now prominently there are two sets of standard world over which are being basically used. One is called as US GAAP, which is in US, and IFRS, which is basically kind of UK based. And they also tried to converge, or they tried to bring some uniformity between both. Uskili also there was a project which was there, which was basically between a International Financial Reporting Standard and US GAAP, but still variety of differences are there between both. Sir, what are the difference between IFRS and US GAAP? Not a part of FR syllabus. Someone who has taken basically that optional subject, GFRS, for them that will be applicable, but FR may not applicable. Fine. So out of two world renowned standards, one of them is IFRS. Now, India mein, why do we need this IFRS? So see, cross-border transactions have increased. You know, in Reliance, so many international companies have invested. Facebook has invested in Reliance, Google has invested in Reliance, so many Saudi people have invested in Reliance. So now world over, say, people are coming and investing in India. Whenever they're investing in India, before investing they want financials. Now if you say that our financials are not comparable world over, or we follow different policy, people in the world following different policy, that's not going to work. And that's why to have a uniform accounting policy and where your accounts can be compared world over, this IFRS adoption, or we needed to have standards which are based on IFRS. So there's an increased cross-border transaction. Companies have started to raise capital from multiple countries. Now, to have a multiple set of financial statement is difficult. I cannot have a financial statement as per IFRS for there. Yahan pe normally is no. So applying local standards will also be not appropriate. It will give a different picture. The international investors were requiring the companies to follow this IFRS thing, and considering that India made a commitment in G20 that we will also either follow IFRS or will come out with standards which are based on IFRS. Now what are the benefits of global accounting standard? This is important. The global standard brings transparency, enhances investors and market participant का confidence so that they're able to make informed economic decision. ठीक है? Then global standard strengthens accountability by reducing the gap between what the providers of capital and people to whom they've entrusted the money. तो मतलब what they want information and what we are giving, now that gap is being bridged. ठीक है? And helps investor to identify opportunities and risk across the world. So now your accounts are comparable world over. You can identify opportunities and risk across the world. Fine. The IFRS, they are also called as a global standards. I told you two things majorly in the world: US GAAP and IFRS. Now, whenever I told you IFRS includes International Accounting Standard issued by IASC. It includes IFRS, which are issued by IASB, and the interpretation issued by both of them. So IASC came out with some interpretation, as well as IASB also came out with some interpretation. All is included in the word IFRS. Fine. ठीक है. Now, how to become a IFRS compliant? Two way. One, you start following IFRS, or you come out with your standards which are based on IFRS. Tell me, what did India do? Did we follow IFRS, or we came out with standards based on IFRS? Keep replying. Okay, so what did India do? We came out with a standard which are based on IFRS. They are called IFRS converged standard. So we did not adopt IFRS, we converged to IFRS. Now, whenever we are converging, we take a base of IFRS, but we do bit modification as per our country's scenario. So whenever you do that modification, they are called carve-in and carve-out. They are called carve-in, carve-out. Now, what is this carve-in, carve-out? Pay attention. Something which is there in IFRS, but we change the treatment. Something which is there in IFRS, but we change the treatment, that's called carve-out. Achha, something which is not there in IFRS, we added. Something not there in IFRS and we added, that's called carve-in. Did you understood? Achha, IFRS had two options. I remove one of them. IFRS had two options, we remove one of them and we follow only the one. That's not carve-out, because still what we are following is IFRS. If we change the treatment, then it will be carve-out. If they don't have anything, we add something, that is carve-in, like accounting for CCBC. So we have accounting for CCBC, they don't have anything like that. That's called as carve-in. Fine. Okay, let's move ahead. Let's say just 1 minute. I have one call coming from the management team. So I just take out that call and then we'll be starting. Just 1 minute. Okay, now moving ahead. So carve-in, carve-out is done. Just if we change the name, that is also not carve-out. Change of name is also not carve-out. Fine. Now, what is the process of development and finalization of Ind AS? How are the Ind AS prepared? So first, the preliminary draft comes. So under ASB, they have study groups. I repeat, under ASB, they have study groups and they help basically preparing what? The preliminary draft. The draft is circulated to council members of ICAI and the specified bodies. The meeting is also held with the specified body people. Then the draft is finalized. Now it becomes an exposure draft. Pehle tha preliminary draft. Now it will be exposure draft, which will be exposed to public at large. Anybody can comment. It will be hosted on ICAI's website. So exposure draft is there. The final draft, basically based on the comments received, the final draft comes. Final draft is given to Council of ICAI. If necessary, they may make modification to final draft also. Final draft is then submitted to NAFRA. Final draft is then submitted to NAFRA and then it is finalized. And after that, the MCA will notify. So Ind AS mein, so basically it is notified by MCA. The MCA will notify the Ind AS. Fine. The structure, what does your Ind AS contain? Objective will be there, scope will be there, the definition, the disclosure requirement, transition. When you're shifting to transition provision will be there, and appendices, some application guidance, some definitions, explanation on some specific issue, they come under your appendices. Now pay attention. Under your IFRS, they have interpretations which are issued. We don't have interpretation. We don't have any separate interpretations which are issued. We have this appendices. Okay. Now moving ahead. roadmap for implementation of your Ind AS. Ind AS started when? कब से आपको implement करना है? अच्छा, तो this is for other than NBFC. This is other than NBFC. Bank and insurance company till not applicable. Till now it is not applicable. Bank and insurance company other than NBFC. Normal companies के लिए. For normal companies, it is applicable from 1/4/15 onwards voluntarily. 1/4/15 is voluntary. Acha, 1/4/16 mandatory for whom? Listed or unlisted, having a net worth 500 crores or more. Listed or unlisted, but net worth has to be 500 crore or more. Acha, if you are covered, your parent, your subsidiary, your associate, your JV will also be covered. Acha, so if you are covered, then your parent, your subsidiary, your associate, your JV, they are also covered. ठीक है. So 1/4/16 onward, listed or unlisted, both, any of them, having a net worth 500 crore or more. Achha, 1/4/17 onwards, all listed. For listed, don't see the net worth. For unlisted, the net worth 250 crore or more. Unlisted, the net worth is 250 crore or more. Achha, and listed may other than SME. If you are listed on SME exchange, that's not covered. If you are listed on SME exchange, not covered. Fine. And if you are applicable, means if you are listed or your net worth crosses a limit, आपको applicable your parent, your subsidiary, your associate, your JV. Fine. अच्छा sir, what if I'm not covered above? You continue to follow the existing accounting standard. ठीक है. अच्छा, SME में listed, no, not applicable. अच्छा, when you are applying, it has to be applied for your SFS, standalone financial, as well as your CFS as well. Acha, whenever you are following Ind AS or when you start with Ind AS, the comparatives are also required to be given. So even if it's applicable from 1/4/16, effective date will become 1/4/15 because previous year also needs to be as per Ind AS. Fine. Voluntarily also you can follow it. Now, sir, the thing is, I was a subsidiary of a company which was required to follow Ind AS. Now I'm no longer a subsidiary. Achha, I was a subsidiary of a company, they were following Ind AS, I was also following Ind AS. Now I'm no longer a subsidiary. Do I still need to follow Ind AS? Do I still need to follow Ind AS? Answer is yes. Once applicable, lifetime applicable. I repeat, once applicable, lifetime applicable. Achha, if it's applicable to you, it applies to your subsidiary, your associate, your JV, your parent. Achha, now subsidiary. Sir, that is also my subsidiary. Subsidiary is also my subsidiary. So them also Ind AS will apply. अच्छा sir, subsidiaries associate. मेरा associate नहीं, मेरी subsidiaries associate. No. So subsidiaries associate and JV, they are not required as such. But for a group as a whole, if they are preparing CFS, then they also will be required to have CFS, or they also will be required to follow Ind AS, or they will have a dual set of financial statement. The Ind AS does not apply to associate and JV of the subsidiary associate JV. My subsidiary associate, unke basically associates in JV, they are not applicable, but CFS purpose it will be required. Either they maintain a dual set or they follow voluntarily. Achha sir, what if I have a foreign subsidiary? Achha, foreign subsidiary, I told you Ind AS applies to you, it applies to your subsidiary also. The foreign subsidiary, for their country's law, they will be following their standards, local standard. But for the purpose of consolidation, I need figures as per Ind AS, so that subsidiary has to maintain dual set of books of accounts. Did you understood? Did you understood? Achha sir, what if my parent is foreign parent? What if my parent is a foreign parent? The foreign parent need not apply Ind AS. Foreign parent ko Ind AS will not be applicable. Fine. This was basically for other than NBFC. Now coming to NBFC. Same things, but वहाँ पे जो date था ना 1/4/16 and 1/4/17, here the date is 1/4/18 and 1/4/19. Okay, over there the date was 1/4/16 and then 1/4/17, phase 1, phase 2. यहाँ पे it is 1/4/18 and 1/4/19 onwards. Now, important. I'll come to one point which is very good. For bank, insurance companies, still it is not applicable. Sir, voluntary, can they follow? Answer is no. Voluntary also they are not allowed. Okay, just 1 minute. Now, coming to the questions, I told you I'll be doing only the important questions. If it's not marked as important, I'll not be doing it in revision. All theories and all important questions. Okay, question number 2, there's a Section 8 company. Is a Section 8 company, do they need to follow Ind AS if it's a company? Section 8 company, if it's a listed one, mandatory. If it's an unlisted but net worth is 250 crores or more, then it is applicable to them. Now see, everybody knows answer. Important is how do we write it. So check over here, we need to write about section 129, which is on financial statement. The section 129 of Companies Act says what? The financial statement shall give a true and fair view. It shall comply with accounting standard and it shall be in a form which is as per schedule 3. Acha. So see, they've written it shall comply with accounting standard, and accounting standard doesn't mean only AS. So if at all they fall under that Ind AS wala category, they need to follow Ind AS. Okay. So companies covered under section 8 are not exempted from the requirement of section 133 and 129. The contention of management that Ind AS doesn't apply to them is not tenable. Clear? Okay. Moving ahead. Now question number 5. Question number 5. Now these are the structure. There's a company D, they have two subsidiaries E and H. Acha, E has a subsidiary F, associate G, and H has a subsidiary I. Fine. All the companies in structure are unlisted. Net worth of E. Acha, E ka net worth is 300 crore. Acha, E ka net worth 300 crore. All others are less than 250. Acha, so can I say Ind AS applies to E? Acha, if it applies to you, it applies to your parent, your subsidiary, your associate. It applies to your parent, your subsidiary, your associate. Acha, so can I say it does not apply to other subsidiaries of your parent? See, it applies to you, तो आपका parent, आपकी subsidiary, आपका associate, आपका JV. Now this H is not my parent, my subsidiary नहीं है, मेरे parent की subsidiary. So to H it is not applicable, same way I not applicable, but whenever this D is following Ind AS, so can I say this figures of H and I will be required and that figures D will need as per Ind AS. So as such to H and I not applicable, but the thing is practically they will also be following Ind AS, otherwise they need to maintain a dual set of books of accounts, one for themselves and one for giving it to parent for the purpose of consolidation. Is it clear? Is it clear? Okay, next one, how do we calculate the net worth? They say net worth 250 crores or more. Achha, if net worth 250 crores or more, Ind AS applicable. Question is, sir, how do I calculate the net worth? So pay attention. It should be based on your standalone financials. Not consolidated, aapka standalone financials. Achha, you need to see which date's net worth, 31st March 14. Achha, 31st March 14, if the limit is crossed, say for example, 31st March 14, the net worth is 500 crores or more, then 1416 onward it's applicable. Previous year figure also needs to be as per Ind AS. But imagine your unlisted company, 31st March 14, unlisted company, 31st March 14, it is 300 crore. Achha, it is 300 crore, so applicable from 1417 onwards. Achha, unlisted company, 31st March 14, it's 200 crore. Achha, 31st March 14, it's 200 crore, so you don't fall anywhere. As such, not applicable. Okay, so sir, 31st March 14 ka, if I'm seeing it's not applicable, then check every year also. So when you check on 31st March 14, if you're not falling under 31st March 14 ke base pe criteria mein, then you have to check every year, and once it's applicable, like suppose this year you cross, the next year say Ind AS becomes applicable. So suppose you cross the limit, 31st March 21. Suppose you cross the limit in the balance sheet 31st March 21 to 1422 onwards, basically 31st March 21 to 1421 onwards. 1421 onwards, Ind AS will become applicable. Okay, how do I calculate the net worth? Paid up capital, all your reserves except the revaluation reserve. Revaluation reserve is not to be included, and minus your accumulated losses. So capital, securities premium, all reserves minus accumulated losses, revaluation reserve not to be counted. That's it. Coming to this question. Question number 10, important. Keep replying if you want to basically stay focused, keep replying. Okay, it's a listed entity. Which phase does company A fall? These are the assets liability of 31st March 14, we have to consider capital, securities premium, general reserve, no, revaluation reserve, no, P&L, yes, and minus the fictitious asset, so this you deduct. So if you check out, it is coming 505, more than 500 crore, you fall under phase 1, 1416 onwards, it will be applicable. Acha, what if you are not listed, but you are unlisted? Unlisted having a net worth 500 crore or more. Unlisted or net worth 500 crore or more, so still you will fall under phase 1 only, 1416. Did you understood? Listed ho to be 1416, unlisted also 1416. Acha, suppose in above illustration P&L में negative balance. Suppose in above question P&L negative balance 375, then your net worth now is becoming only 55. You do all these things total, the net worth is now only 55. If net worth is 55, earlier it was 505. Acha, so now net worth is 55, phase 1 mein you're not falling, phase 2. Acha, listed ho na? Listed, phase 2 mein don't see the net worth. If you are listed, you will fall under phase 2, 1417 onwards. So listed ho, it will be phase 2, 1417. Acha, unlisted. Unlisted net worth 55 crore. Unlisted net worth 55, you're not falling in phase 2 also, not applicable on. Unlisted, it would not be applicable. Any doubts? Any doubts? Keep replying. Okay, next one. Non-banking finance company whose parent or subsidiary or associate or JV is a NBFC. Acha, so your parent, subsidiary, associate or JV is NBFC. Now pay attention. If NBFC is a parent, now see NBFC has to adopt Ind AS bit later. Remember for them the phase 1 was 1418 and phase 2 was 1419. Acha, the parent is NBFC. Okay? Now subsidiary is basically not an NBFC. Not an NBFC. Now subsidiary ko Ind AS applicable. Subsidiary Ind AS is applicable 1416 onwards. So subsidiary starts following Ind AS 1416 onwards. But now sir, the parent will start from 1418. So 1416 to 31st March 18. 1416 to 31st March 18. Parent doesn't have Ind AS. Subsidiary has Ind AS. The subsidiary has to prepare one more set of financial based on AS to give it to parent for consolidation. So parent doesn't have Ind AS till 1418. Subsidiary has Ind AS from 1416. So 16, 17, 17, 18, subsidiary is Ind AS, parent is AS. So subsidiary has to have dual set. One required for them Ind AS, but to give it to parent they will have AS. So 1416 to March 18, such subsidiary will provide figures to NBFC parent as per AS for the purpose of CFS. Achha, now ulta. Imagine subsidiary is a NBFC. Now imagine subsidiary is a NBFC. The parent is not a NBFC. They started following Ind AS 1416. The parent is not a NBFC. वो 1416 से Ind AS. Subsidiary is a NBFC. They have 1418 onwards. Acha, so now they will have Ind AS 1418 onwards. But problem is 16, 17, 17, 18. उनका parent is following Ind AS. If parent follows Ind AS, for the purpose of consolidation, they need to give figures to parent as per Ind AS only. So NBFC 1418 se starts, but for the purpose of giving information to parent 16, 17, 17, 18, for consolidation purpose, they'll have one more set of financials which will be based on Ind AS. Okay, the check over here, double star, I would have written below here. From 16 to 18, such NBFC, which is a subsidiary, have to provide figures to the parent as per Ind AS. They will be maintaining dual set of books of accounts. I hope this is clear. Okay. Question number 15 is related to that only. Okay, check out over here. There is company X is a subsidiary of company Y NBFC. Okay, Y is a unlisted NBFC, net worth 400 crore. Achha, Y is a NBFC. And Y is a parent. Okay, Y is a parent. The parent is an NBFC, 400 crore. They will start following Ind AS 1419 onwards. Okay, they will start following 1419 onwards. Now, subsidiary has, so if Ind AS applicability for parent is different, what do? So, parent ko, imagine Ind AS is applicable to X. So, subsidiary Ind AS applicable already. parent it will be 1419 onwards. So the bridge time, the subsidiary already has Ind AS applicable. SFS purpose they will follow Ind AS, but for the purpose of giving figures to parent, they will maintain another books as per AS. So check out, for the purpose of consolidation, company Y for the year 1718, 1819 also prepare accounts as per AS for the purpose of consolidation. Is it clear? This point was important. Okay, sections relating to referring to Ind AS is fine. Division 2. Okay, now Companies Act, there are 3 divisions. Division 1 applicable for companies following AS, Division 2 applicable for companies following Ind AS, and Division 3 is for NBFCs following Ind AS. Then the list of Ind AS is given to us. This is your introduction to Ind AS. Moving ahead. Okay, now I go to Division 2 of Schedule 3. Now I go to Division 2 of Schedule 3. We have done full introduction in detail. I told you our revision will be in detail. All important questions will be covering in class itself. Anywhere you're stuck up, stop me at the same time. Okay, Division 2 of your Schedule 3. Division 1 is for those companies following AS, not applicable for basically CA Final. It's covered in your intermediate. For CA Final, Division 2 is covered. Now, under your Ind AS, under your Schedule 3, I'll be taking only the important points which are there. Because as such, it's very huge. The only important points will be covered over here. Okay. Now, if there's a conflict between Schedule 3 and your Ind AS, if there's a conflict between Schedule 3 and Ind AS, what will prevail? So they've already given to you. Ind AS will prevail. If there's a conflict where a compliance with the requirement of Act, including Ind AS, require a change in treatment, the same shall be made and the requirement under this schedule stands modified. The requirement under this schedule stands modified means Ind AS will prevail except Ind AS 1 has an option of presenting assets and liability in order of liquidity that they are not allowing. So they've written except the option of presenting assets and liability in order of liquidity. So Ind AS 1 allows you to prepare balance sheet in order of liquidity. Schedule 3 says no. And वहाँ पे conflict, Schedule 3 prevails. So for that item, Schedule 3 will prevail. Everywhere else, there is a conflict between Schedule 3 and Ind AS will prevail. Fine. Okay. Now, sir, can I give full figures in my balance sheet P&L, or do I need to round off like rupees in hundreds, rupees in thousand, rupees in lakhs? Rounding off is mandatory. I cannot give full figures. So depending on your total income is revenue from operation plus the other income. The figures shall be rounded off. So shall be. So if your turnover is less than 100 crore, either you give rupees in hundreds, thousand, lakhs, millions. But if your turnover is 100 crore or more, then you give rupees in lakhs, millions or crores. Okay, so if I want to give rupees in crores, my turnover has to be, it's not turnover, total income. Total income has to be 100 crores or more, and it's mandatory to round off. Okay. Mandatory to give the previous year figures also, except for the first financial statement. Company started first financial statement and then previous year is not required, otherwise previous year is mandatory. And the requirements given under Schedule 3 are minimum. ये minimum requirement है which will come on your face of balance sheet, P&L or notes. If I want to give extra, answer is allowed. Fine. Now, every division 1, 2, 3, part 1 gives the format of balance sheet, part 2 gives the format of P&L. Now this is balance sheet format. In your balance sheet you have asset side, say it starts. It doesn't start with liability side, asset side. Non-current, then current. Then we go to liability side. Under liability side we have, first of all, equity. Then comes your liability, and under liability we have non-current liability, current liability. Okay, that's okay. This all is fine. You already know about the format, and this is not something which will be coming in exam. Write down the format. So I'm just moving ahead, going to the important things. Just few things. Just check over here. There's a word called financial asset, financial liability. You already know about it. Financial asset includes your cash equivalents, investment in equity. Investment in equity, plus you have a contractual right to receive cash or cash equivalent that comes under your financial asset. Same way, financial liability is nothing but a contractual obligation to deliver cash or cash equivalent. Details about financial asset, financial liability will come under your Ind AS 109, which will be done on the 4th day, last day. Okay, moving ahead. On your liability side, your trade payable. The trade payable are to be bifurcated as dues to micro and small enterprise other than micro and small. This should come on the face. ये face पे आना चाहिए, dues to micro and small other than micro and small. Fine. Now, according to me, the format of statement of changes in equity is important. This has been asked in auditing 2 times already. The auditing paper gave a format of statement of changes in equity. This has been asked. I'm just taking this. So under your statement of changes in equity, we have a equity share capital, other equity. So both. Coming to first of all, equity share capital. The things are required not number of shares wise, the things are required amount wise. Okay? So under this, opening changes basically in equity share capital due to prior period error. Okay, prior period mein error tha, we are rectifying it. So restated opening. We get a restated opening. Achha, then changes which happen during the year, and we have a closing balance. So opening balance, changes coming due to prior period error, we have a restated opening. Changes happening during the year and the closing. Same for the previous year period. This is equity share capital. Now going to other equity. Now sir, what is this other equity? Other equity will have basically your kind of reserve surplus, wo sare aa jayenge. Plus you will have that OCI related item, the OCI reserves which are created. Few items are fair valued through OCI. If they are fair valued through OCI, yearly effect comes in your SOPL, the OCI part. Accumulated balance appears here. The accumulated balance will be appearing over here. Okay, let me just guide you this format first. First of all, I'm taking it kind of horizontally, then I go to the basically vertical thing. Horizontal, if you see, share application money received pending allotment. Achha, if it is to be refunded, it comes under liability. Not to be refunded comes here. Achha, equity component of a compound financial instrument. Compound financial instrument are split into 2 parts, equity component, liability component. Equity component comes here, liability component goes under liability. Under your reserve surplus, capital reserve, securities premium, retain earning and other reserves. And then the OCI related reserves. Achha, OCI related reserves. Okay, debt instrument through OCI, equity instrument through OCI, revaluation surplus, exchange difference on translation of foreign operation. Then they've given effective portion of cash flow as other items. So these are all related to OCI. Accumulated comes over here. Individually, yearly impact. Like this year we did revaluation. So this year, whatever revaluation done, up, down, that will come in SOPL, in that the OCI part. But then it will be carried accumulated over here. Okay. And money received against share warrant. Money received against share warrant, till now shares are not yet issued, it comes over here. So this is basically the horizontal. Now going vertically. Okay, balance at beginning. Achha, due to prior period error, if there's any change. So rectified beginning. Now this year. Okay, this year's profit or this year's OCI items. We did this year revaluation, so there was some opening revaluation surplus. This year ka revaluation added or deducted there. So total comprehensive income for the year. Now, if you declared a dividend, it gets deducted from retained earning. Dividend declared does not come in your P&L. It's not an expense, it's an appropriation. So यहाँ पे जो retained earning था ना, यहाँ पे it will be deducted here. यहाँ पे deduct हो जाएगा. अच्छा, then transfer to or from retained earning. Transfer to or from retained earning. Imagine if that asset which was fair valued through OCI, say debt instrument through OCI or equity instrument through OCI, if they are sold off, because uska related OCI balance will also go away. They're sold off. Achha, if it's item reclassified to PNL, that OCI balance will go to PNL. But if it's item not reclassified to PNL, it will be removed from there. It will go to retained earnings. The internal adjustments will come, that will come here. Any other change and the closing balance. Is it clear? Same, this was for current year. We go to previous year. Now, Definition of current asset, current liability given over here is important. Check out, we have a definition of current asset, current liability. Current asset. Current asset किसको बोलेंगे? If it satisfies any of the following criteria, expected to be realized or intended for sale or consumption within normal operating cycle. Primarily, we are holding it for trading. Achha, expect to realize within 12 months from the reporting date. Now see, expected to realize, due नहीं लिखा है. If you go to liability, word is due. ठीक है. Next, or if it's cash or cash equivalent, something which is cash and cash equivalent is always coming under your current asset unless it is restricted from being used or exchanged to settle a liability for at least 12 months after the reporting date. Any of 4 criteria satisfied, it's a current asset. All criteria not satisfied, then it becomes non-current. Similarly, for current liability, if it satisfies any of the following criteria, expected to be settled in normal operating cycle, primarily held for being traded, अच्छा, due to be settled within 12 months from the reporting date. Due, यहाँ पे due है, not expected. And if you do not have an unconditional right, if I do not have an unconditional right to defer it for at least 12 months after the reporting date, then it becomes a current liability. If I do not have an unconditional right. If I have an unconditional right to defer it, then non-current, subject to other criteria being fulfilled. Any of them fulfilled, it is a current liability. Important definition of current asset, current liability. ठीक है? Okay, other things are fine over here, not much important. I'm just taking things which are important. Acha, just pay attention. Under your PP, under your basically PP, you know, we prepare a kind of a big schedule, name of all that PP, reconciliation table kind of ऐसा बनाते हैं, full. उसमें gross block, accumulated depreciation, then comes net, all that things. Just one thing is, if there's a revaluation and due to that change in revaluation, because of that revaluation up and down, there's a change of 10% or more in net book value. The net book value going up or down is 10% or more. That needs a separate disclosure in that reconciliation table. Fine. Now, how do I have a presentation of your trade receivable? How do I have a presentation of your trade receivable? These are actually long-term trade receivable. Your normal trade receivable, which comes under your current asset, they are also presented in a similar way. So let me just do this. Okay, they are classified as, okay, secured considered good, unsecured considered good, secured considered good, unsecured considered good. And now doubtful ki jagah, they have 2 category. You don't have the word doubtful. So they have trade receivable which have a significant increase in credit risk, and second is credit impaired. Now, when do I say it has a significant increase in credit risk? When do I say it has a significant increase in credit risk? Okay, it has a significant increase in credit risk when it's overdue for more than 30 days. If it's overdue for more than 30 days, it comes over here, significant increase in credit risk. When do I say credit impaired? There's a clear indication it will be kind of bad. So when we have a clear indication there will be bad there, it's called credit impaired. Fine. Plus you need an aging schedule. So trade receivable ka aging schedule mandatory. Now, how do I have an aging schedule? So first of all, either your trade receivable is disputed or undisputed. Do option. Acha, disputed or undisputed. In that also, either it is good or it is basically it has a significant increase in credit risk or it's credit impaired. Acha, the undisputed, usme good, significant increase in credit risk, credit impaired. Same thing, disputed mein good, significant increase in credit risk, credit impaired. Now, how do I present? It's outstanding. Outstanding. Due from the due date of payment, less than 6 months, say it's due. 6 months to 1 year, 1 to 2 year, 2 to 3 year, more than 3 years. This way, the aging schedule is required. This is not much important for FR, but more relevant for auditing purpose. Okay. Now, the word loans. Loan. If I've given a loan to someone, I'll be getting cash. I have a contractual right to receive cash. As it's a contractual right to receive cash, it comes under your financial asset. Under your current asset, non-current asset, we have the word financial asset. Achha, sir, advances. Earlier, we used to have the word loans and advances. Advances, if I've given advance for purchase of goods. If I've given advance for purchase of goods, what will be coming is goods. As goods are going to come, cash is not going to come. I do not have a contractual right to receive cash. So in that case, what do? That will not appear under your financial asset, it will come under your other non-current asset or other current asset. The advances are not under your financial asset, other non-current or other current, because we don't have a contractual right to receive cash. We'll be getting goods. ठीक है. अच्छा, this FDs with more than 12 months maturity. This can come under your objective. That's why I'm taking it. Your FDs with more than 12 month maturity. Now see, if FDs are cancelable, all cancelable FDs, they are current asset because they are considered as cash and cash equivalent. So cancelable FDs, all irrespective of tenure, they are current. But if nothing is given, FDs are treated as non-cancelable. The deposits are, nothing is given. See, if question is silent, ICI treats FD as non-cancelable. Acha, non-cancelable hai. If it's non-cancelable, you cannot cancel it for at least 12 months from the reporting date. Reporting date say 12 months that you can't cancel, then it becomes a non-current thing. The FDs for more than 12 months maturity, non-current mein. Now I've done a FD. I have a contractual right to receive cash. I have a contractual right to receive cash. It comes under your financial asset. So if it's non-cancelable, more than 12 months, it's coming under non-current. Under your non-current financial asset, may other financial asset. Under your financial asset, we have other financial asset under non-current. Clear? ठीक है. Advances में we do not have a contractual right to receive cash and cash equivalent. They are not a part of financial asset. I already did. Acha, under your inventory, if something is goods in transit, acha, the goods in transit, raw material in transit, finished goods in transit, they have to be shown separately under the relevant subhead. So I can have raw material total bracket में लिख सकता हूँ including raw material in transit of this much. Finished goods total including finished goods in transit of this much. But I cannot combine all transit item and put it as GIT. The raw material, finished goods, all transit item combined put as GIT, not allowed. It should be under the relevant subhead. ठीक है. Okay, this is something newly added, the shareholding pattern of promoter. So promoter ka shareholding is to be disclosed under your note of equity share capital. So whenever you're having equity share capital, usme shareholding of promoter is to be given, promoter's name, number of shares and percentage, and is there any change during the year? See, this is not much relevant directly exam wise, that's why I'm not taking, but uske related to internal questions all will be taken, don't worry. Okay, now current maturity of a long-term borrowing. Current maturity of long-term borrowing. What is this current maturity of long-term borrowing? Loan is taken for 5 years, remaining period is say 6 months. Loan taken for 5 years, remaining period is 6 months. So see, now it's a current liability. It's payable within 6 months. Acha, it's a current liability, understood. Yeah, you also understood it's a current liability. Now current liability, how do I disclose? It will come under short-term borrowing. Earlier we used to take it under other current liability under division 1. Here it will come under short-term borrowing. Did you understand? So under financial liability we have borrowings, uske under short-term mein. So under current liability, financial liability, under that borrowings, there it will be coming. Fine. Trade payable, we bifurcated as dues to micro and small, other than micro and small on the face. For micro and small, there are 5 disclosures. For micro and small, there are 5 disclosures. Simple words may have written over here. As per Micro, Small, Medium Enterprise Development Act, MSMED Act, if our supplier is MSME, we need to mandatorily pay them within 45 days. If we don't pay them within 45 days, then interest at 3 times the bank rate is to be paid, and such interest will be disallowed under your income tax. So to just protect the small people, if our supplier is MSME, we need to ensure we pay them on a timely basis. So 5 disclosures are required. Which are the 5 disclosures related to MSME? 1. What is the principal outstanding to be paid at the end of the year to MSME? And what is the interest on that principal which is outstanding? So principal outstanding, interest outstanding on the principal which is outstanding. Second, what is the principal which has been paid late during the year and how much interest is paid on it? Principal paid late, interest paid on the principal paid late. Third, interest outstanding on the principal paid late. Acha, principal आपने late pay किया, उसका interest you are not yet paid, that comes under C. So sir, what was the difference between this and this interest? A point में the interest was on the principal which is outstanding. अच्छा, principal paid off late, but interest outstanding, that comes under C, and the total outstanding interest comes under your D point. And E point, what was opening interest outstanding payable to MSME, which is still outstanding, means which is outstanding at year end also. The opening outstanding, which is still outstanding. Any doubts? Anybody with this? I tell you, this 20 hours we are revising, that will be kind of exhaustive. After that, you still have sufficient time. Whatever topics we do today, try to ensure you do the same topic at your home tomorrow by the time basically we reach till 5 o'clock. So, aaj jo kar rahe hain, you revise on your own till 5 o'clock tomorrow. Any doubts are there, you can ask me. Again, we'll do some topics tomorrow. You do that next day. That way, if you do, it will work out for you. Okay, now trade payable also, there's an aging schedule required. Under trade payable, we have MSME, micro small, others. Also undisputed and disputed. So here there are 4 things. Acha, in your trade receivable, it started with less than 6 months. Here it starts with less than 1 year, 1 to 2 year, 2 to 3 year, more than 3 years. Okay, this is fine. Okay, proposed dividend. The amount of dividend proposed, we don't account it. It's not to be accounted. We account for dividend only when it's declared. The declared dividend is a liability. We'll have retained earnings to dividend payable, but our proposed dividend is not a liability. Sir, what do I do with the proposed dividend? The amount of proposed dividend and related per share amount, total and the per share amount, are to be disclosed in your notes to accounts. Okay, now this L point, additional regulatory information, these are newly added. This is important. This whole thing, L point, is important. So, title deeds of immovable property, if they are not held in the name of company. Achha, if title deeds of immovable property are not held in the name of company, you're required to give following detail. The relevant line item in balance sheet, like PP. Okay, under PP, it's what? Land or building or what? Uska gross carrying amount. It's held in the name of whom? Achha, whether that guy is a promoter, director, relative of promoter, director, or employee, kind of that. Since which date it is held and why, the reason for not being held in company's name, this is to be given. Okay. Then investment property. We know investment property, they are always carried as per cost model, Ind AS 40. But the fair value of investment property are to be disclosed in your notes to account. The fair value of investment property is to be disclosed in your notes to account, and plus whether that fair valuation is based on report of registered valuer, that also is to be written. Same way, this all is fine. Achha, if you're given a loan, to promoter, director, KMP or related parties, if you're given a loan to promoter, director, KMP, related parties, such that which is repayable on demand, वो loan कैसा दिया है? Repayable on demand or without specifying terms and condition, then this is required. The loan to following people, repayable on demand or without specifying terms, then this is applicable. What I need to disclose? The type of borrower, amount, and the percentage compared to the total loans and advances. Achha, there's a question from Sudarshan. Sir, which items are coming under long-term trade receivable? They are within the working capital, so short-term. Now see, if it's expected to be realized within normal operating cycle, then in that case, it's always a current asset. So it will be a normal trade receivable coming under current asset. But imagine, normal operating cycle as such is 5 months, 6 months only. And if it is expected to be realized within 12 months also, then also it's basically a current asset. One of the debtor, it's a new party, first time we are transacting, and we gave him, say for example, 14 months time. So normally we don't give 14 months to anyone. Operating cycle is also not 14 months, but one of the debtors specifically we are given 14 months. So he'll be paying after 14 months from the reporting date. Suppose reporting dates is still 14 months are pending. So he will come under a long-term trade receivable. Clear? Okay. Next, acha, details about your CWIP is to be given. So capital work in progress, uska one, aging schedule. Project is in progress or temporarily suspended. Aging schedule, less than 1 year, 1 to 2 year, 2 to 3 year, more than 3 year. And second, ye aging already happened uska. And now whatever to be spent completion ke liye. So completion, if it's overdue or cost has exceeded basically the limit, so completion schedule also you give. Future, aging schedule is for something which is already spent. completion के लिए future की बात है, तो it is to be completed within less than 1 year, 1 to 2 year, 2 to 3 year, more than 3 years. ऐसा. Did you understand? And now, completion schedule is required only when completion is overdue, or what do we say? The cost has exceeded the limit. Fine. Same way for intangible under development, aging schedule, completion schedule. Achha, details of Benami property. Benami property is nothing but money is of someone else, but property is in someone else's name. तो किसी और का पैसा but property मेरे नाम पे, that's called Benami property. So when any proceeding has been initiated or pending against company for holding any Benami property under the Benami Transaction Prohibition Act, so company shall disclose the following. If that proceeding is initiated or pending, disclose the following: details about property, उसका amount, who are the beneficiary, real beneficiary, जिसका पैसा है. If property is in the books, which item? If property is not in the books, it's registered in my name, but I have not accounted because it was not my money. So not accounted, the fact shall be stated. Acha, proceeding whether it is going on against the company as an abettor, helping someone in doing wrong things, and the nature of proceeding, status, etc. is to be given. Sudarshan, are you clear with your doubt? So if you ask a doubt and once it is done, please make sure you reply. Okay. Now, if you have taken a borrowing from bank or financial institution, loan is taken on the security of current asset. If you have taken borrowings from bank, financial institution on the security of current assets, okay, stock debtors के security पे. Now you have to give figures of stock debtors to them. So whether the quarterly return, whichever given to bank, financial institution, are in agreement with books of accounts, and if not, the summary of reconciliation and the reasons is to be given. So now we are required to disclose in notes whatever figures given on quarterly basis, stock debtors to bank, are they matching with the books? If not, and this all is to be done by management. Schedule 3 is for the management, they are preparing financials. Fine. Willful defaulter, if you are declared as a willful defaulter by a bank or financial institution, willfully you don't pay, that's called willful defaulter, like Vijay Mallya. So date of declaration as willful defaulter and details of default are to be given. Achha, if you have some relationship with stuck-off company whose name is removed from the list of ROC, that's called stuck-off company. So uski details are to be given. Then in that case, compliance with number of layers. Now see, A Limited as a subsidiary B, B as a subsidiary C. So how many layers are there? 2. Actually only 2 layers are allowed, more than 2 layers are not allowed, unless if someone is a wholly owned subsidiary in between, then they are exempted, वो सारी चीजें हैं. तो maximum 2 layers allowed. So have we complied with the layer or not? If not, so below the allowed layer, whatever companies are following, उसका CIN number, company's identification number, etc. is to be given. Acha, following ratios. See, till now ratios were not required in your financial statement. Now ratios are also required in financial statement. This ratios, so just read that once, and any ratio may there is a change of 25% or more. So last time say for example your NP ratio, net profit. So suppose your net profit ratio was coming as 20%. Now what is 25% of 20%? So 20 ka 25%, can I say 5%? Okay, the last time NP was 20%. Now if it becomes less than 15 or more than 25, 5% up or down, uska details are to be given in notes. Fine. Compliance with the approved scheme of arrangement. Whenever you go for that amalgamation, merger, demerger, the scheme of arrangement is approved by basically the court. The accounting has been done properly or not, and whether there's a deviation from the accounting given under Ind AS, so that needs to be fulfilled. Achha, utilization of borrowed fund. This is kind of offbeat, but what happens sometime? A Limited has invested or given a loan to B Limited. A has invested or given a loan to whom? B, with a condition that B will further invest or give a loan or give a guarantee on behalf of C. Achha, so A gave to B, but B has to invest or give a loan or give a guarantee on behalf of C. So you can say ultimate beneficiary is C. Ultimate beneficiary is C, and this is an intermediary. So there are few disclosures required by A Limited, there are few disclosures required by B Limited in their financial statement. So where a company has advanced or loaned or invested fund to any person with the understanding that the intermediary will lend it to other person which are the ultimate beneficiary, or they will provide guarantee on behalf of another person. So the date and amount of fund advance, so these are disclosure from A Limited's angle. So how much amount I have given to B and the date of it. अच्छा, date and amount when B has given it to C, ultimate beneficiary, date and amount of guarantee provided to ultimate beneficiary, and declaration that Foreign Exchange Management Act FEMA are not violated. ठीक है. Same way, similar disclosures are required from B's angle. So date and amount when fund is received, date and amount when fund is further provided to C, guarantee given to C, and declaration that FEMA rules and regulations are not being violated. Acha, next, if at all, under Ind AS, if at all you retrospectively apply some change in accounting policy, if you change your accounting policy, there's a retrospective application, ठीक है, or there's some prior period error you are rectifying. So there's a retrospective change due to change in accounting policy, or there's some prior period error or some reclassification happening for prior thing, then in that case you need 3 balance sheets. Acha, so if I have an error related to current year, oh, I found an error related to current year, I can rectify, it's still not approved. If I found an error related to last year, I need to change the previous year's figure appearing in current year. अच्छा, तो इस साल में जो previous year figure है, that needs to be changed. अच्छा, if I found an error relating to period before previous year, अच्छा, error is related to period before previous year, I have to restate the opening balances of previous year. Did you got it? अच्छा, तो whenever opening balance of previous year are getting changed, previous year के opening balances are getting changed, then I need 3 balance sheet, current year and previous year beginning. अच्छा, if previous year beginning वाले balances are not getting changed, then I don't need a third balance sheet. Imagine error related to previous year only, तो previous year के balances are changed, opening of previous year is not changed, third balance sheet will not be required. Fine. This was related to P&L, balance sheet. Now going to P&L. The format of P&L is similar. What was there under your division 1, same way. Only thing is, over here we don't have extraordinary item. There's nothing called as extraordinary under Ind AS. So we have profit before. We have profit before exceptional item and tax. We have the exceptional item, profit before tax and tax. Tax is current tax, deferred tax, 2 things. Acha, one more thing, under your Ind AS, we have a normal P&L, uske saath saath, there's a OCI part, other comprehensive income. Okay? Now this was continuing operation, then we have a discontinued operation, Ind AS 105 mein we'll cover it later. Now going down, OCI part. The P&L has 2 parts, one normal one, OCI. Acha, under your OCI, there are 2 things, item which will not be reclassified to P&L, item which will be reclassified to P&L. So there's a list given. That items are coming in OCI. Acha, whether it's item reclassified to P&L, not reclassified to P&L, sir, how do I understand? From the relevant Ind AS. The relevant Ind AS is told this is item reclassified to P&L, this item not reclassified to P&L, kind of that way. Acha, reclassified to P&L means what? Today it comes in OCI. I told you yearly effect comes in OCI. Accumulated balance will be as a part of other equity. Now, whenever that asset is sold off, whenever that asset or liability is disposed of, to uska accumulated balance, if it's item reclassified to P&L, then from there it will go to P&L. So SOPL mein it will come P&L mein. If it's item not reclassified to P&L, so whenever that asset is disposed of or something like that, then in that case the balance, the accumulated balance will be transferred directly to retained earning. It will not go to P&L. So check. OCI is made up of incomes and expenses which are not taken in P&L due to requirement of various Ind AS. And generally it comprises of unrealized incomes and expenses. OCI is divided in 2 parts, item which will not be reclassified to P&L, item which will be reclassified to P&L. Acha, item not reclassified to P&L means what? Today it comes in OCI, it's accumulated in other equity, later when it becomes realized. Acha, if it's item reclassified to P&L, it will go to Achha, it is not reclassified to P&L, it will go directly to retained earning, not via P&L. Achha, if it's item reclassified to P&L, achha, so today it comes in OCI, accumulated in other equity. Whenever it becomes realized, it will be transferred to P&L. Whenever it will be transferred to P&L, so it will basically come in P&L, and from P&L, it will go in retained earnings. Clear? Achha, sir, what are the list of items which are reclassified to P&L, not reclassified to P&L, that we are seeing. Achha, plus you need to give EPS on face of your balance sheet for continuing operation, discontinued operation and total. EPS is mandatory on face of P&L, not balance sheet, face of P&L. Achha, question. whether this format given over here in schedule 3, does it apply to section 8 company also? The section 8 company, do they also have to follow schedule 3? Answer is yes. Section 8 companies are not exempted from schedule 3. It's banking company, insurance companies, they are exempted from basically schedule 3. So they also will be following this part shall apply to income expenditure account, basically prepared by section 8 company. This. Okay. Now, if it's a preference share, preference shares which are redeemable, they are a liability. Preference share which are redeemable, the normal redeemable preference share are liability, the interest on that will come under, dividend on that will come under your finance cost. The dividend on preference share, dividend on redeemable preference share will be a part of finance cost. Okay? Now this is the list of items which are reclassified to P&L, not reclassified to P&L. Important. Okay, items which will not be reclassified to P&L. Which are the items not reclassified to P&L? One, change in revaluation surplus. So this is basically as per your Ind AS 16. You revalue your PP as per revaluation model. Yearly revaluation effect comes over here, accumulated in other equity. Once that asset is disposed of, the accumulated revaluation surplus appearing under other equity, it will go directly to retain earning. Okay. So this is as per Ind AS 16. Acha, remeasurement of defined benefit plan. This is as per Ind AS 19. Basically, actuarial assumptions are changed. Uske related gain loss comes. Actuarial assumptions are changed. Uske related some gain loss comes. That is remeasurement of defined benefit plan. That basically what happens yearly. Every year it goes directly to retain earning only. Yearly it goes to retain earning. Acha, equity instrument through OCI. If I have investment in equity shares which are fair valued through OCI. Acha, when are equity fair valued through OCI? I'll come to it later. If there's an investment in equity which is fair valued through OCI, yearly impact comes over here, accumulated under other equity. When that investment in equity is sold off, from there the accumulated balance directly goes in retained earnings. Then fair value change relating to own credit risk of a financial liability designated as FVT P&L. So there's a financial liability. It is designated as fair value through P&L. So normally fair value change should go in P&L. But if fair value change is due to own credit risk, my health is not good, I will not be able to pay, it's due to own credit risk, then in that case it will go in OCI. And later on, basically from there it will go to retain earnings. And share in OCI, now pay attention. If I have an associate or JV, for CFS purpose we follow equity method. Under equity method, our share of profits are to be included. So associates JV mein our share of profits are to be included. Now if they have a profit in normal P&L, our share is added in normal P&L. If they have a profit in OCI not reclassified, I'll add in OCI not reclassified. If they have a profit in OCI reclassified, my share I'll add in OCI reclassified. So this is, if they have a profit in OCI not reclassified, our share comes in OCI not reclassified. If they have a profit in OCI reclassified, our share comes in OCI reclassified. Okay. Other items which are coming in reclassified to P&L, exchange difference on translation of foreign operation. Foreign operations you translate uske balance sheet, foreign currency translation reserve. So they, once it's realized, it goes in P&L. It's item reclassified to P&L. Debt instrument through OCI, that's also item reclassified to P&L. Effective portion of gain loss on hedging instrument related to cash flow hedge, that's also basically item relating to reclassified to P&L. Fine, other things are okay. Now, any item of income or expenditure which exceeds 1% of revenue from operation or 10 lakh, whichever is higher. 1% of revenue from operation or 10 lakh, whichever is higher, needs a separate disclosure. Separate disclosure doesn't mean on face. In notes, usko alag dikha do chalega. For example, late delivery charges. If I have a late delivery charges exceeding 1% of revenue from operations or 10 lakh, whichever is higher, then under your other expense, I should have a separate heading called late delivery charges. Is it clear? CSR expense, I need to show it separately. Fine. Undisclosed income. A transaction which was not recorded in books, but whenever that income tax raid came, I have surrendered or disclosed it as income. So now whether it has been properly recorded. State whether the previously unrecorded income and asset has now been properly recorded. Uske related note. This is to be given by management only. For CSR spending, section 135, amount required to be spent. Remember, 2% of average net profit of last 3 years. Amount actually spent, shortfall, total of shortfall, reason, nature of activity, details of related party transaction, Reliance contributes to Reliance Foundation, that all data needs to be given. Cryptocurrency ka disclosure. If you are having, or if you have traded or you have invested in cryptocurrency, okay, profit loss from that cryptocurrency related transaction, amount of currency held at the reporting date, and any deposits. Okay, imagine for trading in cryptocurrency, you open an account with say WazirX. So WazirX is a platform which allows you to trade. So WazirX mein how much balance of yours is lying. That's called deposit or advance from any purpose for the purpose of trading. ठीक है. This is basically thing. Now consolidated balance sheet के लिए, in your consolidated balance sheet, what happens is, even if you're holding 80%, if I hold 80% in B Limited, when I'm consolidating, I'll include 100% assets and liability. So if I include 100% assets and liability, 20% asset liability belong to someone else, I'll show it as NCI, non-controlling interest. AS may we used to use the word minority interest. Here we use the word non-controlling interest. So NCI, where it will appear within equity but separately from owner's equity. So under equity, I have shareholders fund. Under shareholders fund, the equity share capital, other equity, then total. Then comes NCI and then comes total equity. So it is under equity separately from owner's equity. Same way, whatever profit, P&L may be, I hold 80%, but I'll include the 100% sales, 100% purchase, 100% income, 100% expense, 100% profit included. So subsidiary ka 100% profit included, 20% belongs to NCI people. So it has to be bifurcated. The profit needs to be bifurcated, belonging to owners of parent, attributable to NCI. Fine. This is to be given in notes. Important. This is only for CFS. Okay. So which entity is contributing how much? Parent, then subsidiary Indian 1, 2, 3, subsidiary parent foreign 1, 2, 3, then associates, then JV, this associates, then JV, this all. So list aa gaya. Acha, net asset, amount wise coming from each one of them and as percentage. Okay, share in P&L, normal P&L without OCI, amount wise and percentage. Acha, OCI coming from each one of them, percentage, and total comprehensive income. Total comprehensive income is nothing but P&L plus OCI. Is it clear? Acha. Now, there are certain exemptions if subsidiary is not to be consolidated or like that. Suppose if you are an investment entity, you don't have to prepare a CFS, you don't have to consolidate your subsidiary, associate, JV, provided you carry them at fair value through P&L. So there are some things. If any subsidiary, associate, JV is not consolidated, then the list of subsidiary, associate, JV not consolidated along with the reason for non-consolidation are to be given in your notes to accounts. Any doubts? Anybody with schedule 3? Any doubts? Anybody with schedule 3? Give me thumbs up. I hope you're enjoying. We are having an in-depth revision covering all chapters, everything with all important questions as well. Now, going to Ind AS 1. So we did till now introduction and schedule 3, now going to Ind AS 1. Achha, under your Ind AS 1, it's almost based on schedule 3 only, not much difference over there. So let's start. So Ind AS 1, the objective is basically to prescribe the basis for presentation of a general purpose financial statement. And why we need a basis for presentation? So that we have a comparability within our prior period and with some other entities also. And these are all the minimum requirement, extra disclosures definitely allowed. Okay, your complete set of financial statement, what does it include? When I say complete set of financial statement, see there are two words, complete set, condensed. The complete set of financial statement includes balance sheet at year end, statement of P&L, which includes your OCI. Now, under IFRS, you're allowed to have normal P&L and OCI as two separate statements. We don't have that. We have only one. You have one statement covering OCI as well. Statement of changes in equity is only for Ind AS. statement of cash flow, notes, comparative information, and you need to give a balance sheet at beginning of previous year whenever you restate your accounting policy, or you're basically rectifying a prior period error, or you reclassify the items in financial statements. Fine. Acha, now just tell me one thing. Many entities, they prepare some management report, environmental report, value added statement. They are not included in the word financial statements, and as they're not included in financial statement, you don't prepare them as per Ind AS. It's okay. A financial statement should be as per Ind AS. Fine. Now, identification of financial statement, you need to display mandatory name hona chahiye. You need to state whether it's an individual financial statement or a consolidated financial statement. So that are to be displayed. Reporting date and period. So this is balance sheet as at this date, profit or loss for year ended on this date. The presentation currency, figures in rupees, and level of rounding. This are to be basically presented. Current asset, we already discussed the definition. I'm not discussing again. Moving ahead to important question. Okay, there are two businesses. Okay, operating cycle of one business is 8 months, operating cycle of other business is 3 years. Okay, the asset relating to first business, decide as current or non-current based on its operating cycle. Assets liability relating to second business, decide current, non-current based on its operating cycle. So how do I make? So when businesses have different operating cycle, classification asset liability as current, non-current. How do I make it? It is which is relevant to that particular asset or liability. So if it's basically asset liability relating to, say for example, construction business where operating cycle is 3 years, so you classify current, non-current based on 3 years. But other business, say tire industry, we have a operating cycle as 10 months only, then current, non-current should be based on 10 months for asset related to that business. Fine. Next, fifth one, important. I'm just taking important question, otherwise we will not be able to finish in 20 hours also. Okay, on 1st April 2002, XYZ Limited has invested 15 lakh in corporate bond. Okay, you have an investment in corporate bond. It's your asset. Interest 8% per year. Interest is being paid on 1st April of each year. Acha, 1st April of each year. When I say this year's interest, they will pay next year. And principal is repayable in 3 installment. 5 lakh, 5 lakh, 5 lakh from 1st April 3. Acha, this is 1st April 2 we invested. Acha, so can I say 5 lakh I'll get back first day of next year? Acha, the first year got over. 5 lakh I'm going to get tomorrow plus interest I'm going to get tomorrow. So that too will be shown as your current asset. Remaining 10 lakh, which I'll be getting future May after after 12 months from reporting date, that will be non-current. So check out accrued interest and 5 lakh, they are current portion, current asset. Remaining 10 lakh is non-current. Okay, definition of current liability, we already discussed under your schedule 3. I'm not discussing again, but our important points we'll discuss. Pay attention. Trade payable. They've written trade payable and some accrual for employee, like employee related some accruals are there, or some other operating cost. They are generally a part of working capital used in normal operations, normal operating cycle. So even if uska payable is beyond 12 months, we consider them as current. Now, why do we consider them as current? Assuming the operating cycle is more than 12 months. The trade payable, if operating cycle is more than 12 months, they're expected to be settled within operating cycle, then they will be current liability only. That was okay. This is important. Now pay attention. Okay, now we had a loan. Of 5 years. Remaining period is only 6 months. So they are due to be settled within 12 months. Original term 5 years tha, but now they are due within 6 months. So can I say it's a current liability? Due to be settled within 12 months only. It's a current liability. ठीक है. So, अच्छा, agreement to extend the term is done, but when is that agreement done? After the year end. After year end, before financial statements are approved. After year end, before financial statements are approved, bank ke saath we have came together and bank has agreed to extend for 3 more years. See, that is after year end. 31st March pay that was not there. तो 31st March condition of refinance was not existed. So 31st March it will be a current liability only. So I repeat, there was a loan of 5 years. Now remaining term is 6 months. Balance sheet date पे remaining term 6 months. Now after year end we went to bank. Now we are renegotiating and they gave us extra 3 more years. But that was not there on 31st March. It will appear as current only. This is a non-adjusting event. I hope this is clear. Now suppose that extension criteria was already there in the loan agreement. Well, loan agreement mein there was an extension criteria that we can extend, we can tell bank to extend for 3 more years. That is at our will only. We don't need bank's permission also. If entity expects and has the discretion to refinance for at least 12 months after the reporting date under the existing facility में option hai and we expect we'll go for that option, then you classify it as non-current on 31st March. But if it is not at my discretion, it is at bank's discretion, then in that case they may allow, may not allow, we don't know. Then in that case 31st March it will be a current liability. Clear? Acha, next point is very good. There's a question many times asked relating to it. Imagine your loan taken. Whenever the loan is taken, they put some condition. Like you have to furnish certain documents, or you need to ensure debt equity ratio is minimum maintained like this. Conditions are there. Suppose you violated a condition. Before 31st March, condition is violated, loan becomes repayable on demand. It was a long-term loan, condition violated. Loan became repayable on demand. 31st March, it's a loan repayable on demand. It becomes a current liability. Achha, after year end, before books are approved, the breach has been rectified and bank has agreed not to call back the money. Achha, breach has been rectified, bank has agreed not to call back money. Now what do we do? So India mein, if loan became repayable on demand due to breach of some condition, after year end, before books are approved, if breach is rectified, bank has agreed not to demand, then we will show it as non-current liability only on 31st March because bank has agreed not to demand. तो ऐसे breach होते रहते हैं, वो चलता रहता है, bank agrees in India, so that's why it is a adjusting event in India. But under IFRS 1, it is a non-adjusting event. Under IAS 1, it is a non-adjusting event. Did you understood? So here it is adjusting event. Breach rectified after year end and bank has agreed not to call the money, we will show it as non-current. But under IAS 1, it will be shown as current only. Okay. Now moving ahead to the important question. Electricity deposit, you will be getting back whenever connection is gone. Generally connection you are not going to give up within 1 year. So generally it will be a non-current asset. Okay, tender deposit or earnest money deposit, when you are going to get back. If you're going to get back shortly within 12 months, it's a current. Otherwise, it's a non-current. GST paid under dispute, when you are thinking that it will be settled. In case you expect it will be realized within 12 months, it's a current, else it is non-current. Fine. Next one, question number 8. Next one, question number 8. Achha, OMN Limited is a subsidiary of MN. OMN has a subsidiary MN. Okay, so OMN is a parent, MN is a subsidiary. OMN has given a loan. Achha, parent has given a loan to subsidiary. Loan is required to be paid whenever demanded back by OMN. Achha, so whenever parent asks, subsidiary has to give. Achha, so whether subsidiary has an unconditional right to defer it for more than 12 months? No. Subsidiary doesn't have an unconditional right. So for subsidiary, liability is always current. Achha, so for subsidiary, they do not have a right to defer for at least 12 months, so it will be regarded as always current. Now think from parent's angle. I can call back whenever I want. Achha, so if you expect to call back within 12 months or within operating cycle, तो current or else non-current. So if, यहाँ पे if आ गया. If you expect you will be calling back within 12 months, it's current or else it is non-current. तो यहाँ पे either current, non-current. Subsidiary के लिए always non-current. I hope this is clear. Okay, question number 9, a good one. Important ones, all I'm doing. Okay, pay attention. There's a loan taken, okay, which is to be repaid within a period of 9 months from the reporting date. Reporting date say 9 months में you have to pay. ठीक है, तो as such a long term loan, now within 9 months it's payable. If after year end we went for refinance, bank has agreed to extend the term, it's a non-adjusting event. यहाँ पे prior to year end, bank has agreed they are going to give more 5 years. So prior to year end only. So now at year end I know I have to pay after 5 years. So how it will be classified? Non-current. Acha, what would be the answer if it was agreed after year end? Then it will be current. After year end hota to current hota. Acha, what if this is from one bank, new loan will be other bank. So this is one bank, so this has to be paid off, so it's current. Acha, it's not entity has potential to refinance. Bank may refinance, not necessary. Then again, it's a current because it's payable within 9 months. Any doubts? Question number 9, word prior to year end was important. Okay, going to question 10. Going to question number 10. Acha, in December 1, there's a loan agreement and the loan is payable in 3 equal installments. Okay. Amount also to be contributed by promoters similarly. If it's not contributed, loan becomes repayable on demand. The promoter has to contribute. If they don't contribute, now loan becomes repayable on demand. Okay. On March 25th, the entity approached the bank. March 25th. Acha, now see, promoter has to contribute by March 24th. 24th tak promoter has to contribute. Now when we are going to bank March 25th, so can I say that 24th ko they had to contribute, they did not contribute, we go to bank after there is a bridge already happened. And now we got a grace period up to 30th June. Acha, grace period is only for how many months? Till June. See, grace period is only till June. So can I say now if it is not met, June mein to pay karna padega. So do I get basically like at least 12 months after the reporting date? No, after reporting date I'm getting extra 3 months only. So still bank cannot demand during grace period. How to classify the loan? See, we approach bank after the bridge. The bridge has already happened. Repayable on demand, it is there. Extension is for 3 months only. Extension is currently for 3 months. Bridge has already happened. So it will be appearing as current only. Acha, suppose before bridge happens and we go to bank. Before, see, in anticipation, in February only, if before bridge happened, we went to bank. So bridge has not yet happened. And now bank has given us time till June. So now, June mein pata chalega bridge happened or not. So till June, there is no bridge only. Bridge has not happened. And whether bridge is happening or not, wo June mein pata chalega. So till June, there is no bridge only. And as there is no bridge only till June, 31st March, it will appear as non-current. Are you clear with this? 31st March, it will appear as non-current. Are you clear with this? Okay. Now, SOPL mein I told you one is a normal PNL, second is a OCI, and the total of both is called as a total comprehensive income, PNL plus OCI. If it's a consolidated financial statement, the profit attributable to owners and NCI is to be bifurcated same way. Other comprehensive income attributable to owners of parent and NCI, and then total comprehensive income attributable to owners of parent and NCI. This is to be given. Okay. What comes in your PNL section? What comes in your PNL section? We cannot have a PNL based on function. Admin expense, selling expense, वैसे headings are not there. If you check out, we don't have a heading called admin expense, selling expense, marketing expense, no. So we have a heading basically nature of expense wise. Finance cost, employee cost, they are nature of expense wise. So we are not allowed function wise, we are allowed nature wise. IAS 1 allows both. Either you can have the expense based on nature or their function, that's allowed in IAS, not under here. Format, we already did it in schedule 3. There's nothing extraordinary. There's nothing extraordinary under your Ind AS. Okay. Now, you know there's a word exceptional. Exceptional hai. So where items of income or expense are material, they are to be disclosed separately. You can disclose the nature and amount separately. Circumstances that would give rise to a separate disclosure include, okay, this is not an exhaustive list, so this is important. Circumstances that give rise to a separate disclosure of items of income or expense, separate disclosure. write down of inventory to NRV or reversal of it. Okay, PP may basically some write down done, impairment loss, disposal of PP, big PP sold off, disposal of some investment, some discontinued operation, litigation settlement, reversal of provision. These are few items that may require a separate disclosure. Now question, whether all material items are exceptional item? Whether all material items are exceptional item? No. See, all exceptional item pakka material. All exceptional item pakka material. But all material item, they are not necessarily exceptional. Material maybe there are other things to be seen and then we say whether it's exceptional or not. So uske liye incidence related thing, how frequently it happens and the amount, वो भी देखना पड़ेगा. So all material items are not exceptional, but all exceptional items surely material. Okay, fine. Information coming in OCI, we already did it. Remember, items reclassified to P&L, not reclassified to P&L, revaluation surplus, not reclassified to P&L, remeasurement of defined benefit plan, not reclassified to P&L, equity instrument through OCI, not reclassified to P&L, fair value change relating to own credit risk, not reclassified to P&L, share of OCI in associate JV to the extent it is not reclassified to P&L. Reclassified mein FCTR balance, debt instrument through OCI, effective portion of cash flow hedge and associate JV, my share, if they have it in OCI reclassified, my share will also come in OCI reclassified. Okay, now coming to question 11. Coming to question number 11, due to COVID, there's an impairment in intangible asset, huge loss is recognized. Can you show it as extraordinary? Answer is no. There's nothing extraordinary. Alternatively, can we show it as exceptional? Yeah. So see the way to write item. As per Ind AS 1, no item or income or expense shall be presented as extraordinary. Ind AS 1 requires that entity shall make disclosure and amount separately for items and expenses that are income and expenses that are material. Further, they have given example. You know, we just saw the list. Example of circumstances which will require a separate disclosure. One of such example is write down of inventory, PP, as well as basically intangible ka write down, that is also covered. Okay. If these items are material, the entity shall disclose the nature and amount separately. So further, whether these losses can be classified as exceptional, the exceptional item have not been defined. Okay, exceptional item has not been defined. So what do? So we go to accounting standard 5. Which states items of income and expenses which are of such size and nature. Item of income and expenses which are of such size and nature that the disclosure is relevant to explain the performance, the nature and amount of such item should be disclosed separately. Fine. The exceptional items are those which meet the test of materiality and the test of incidence. Exceptional items are those which meets the test of materiality as well as incidence. So these items can be classified as exceptional because they meet materiality and incidence. All material item may not be exceptional, but all exceptional item will be material. Okay, November 22 RTP question, check. Does it imply that exceptional means material? Does it imply that exceptional and material are word same? Answer is no. Check out. The exceptional item has not been defined under Ind AS. Ind AS 1 requires income or expenses which are material. They may, uska nature and amount can be shown separately. Material is something which influences the decisions of users of financial statement. Materiality depends on nature, magnitude or both. Nature of item se material hota hai, magnitude, amount wise or both. ठीक है. Now check word. All material items are not exceptional. Exceptional items are those which meets the test of materiality and the test of incidence. See, remember this line. Exceptional items are those which meets the test of materiality and the test of incidence. Some of the example which may give rise to separate disclosure, the list is given which we understood earlier also, the same list. List important hai. Okay, going to question number 13. अच्छा, how this will appear in financial statement, P&L में, remeasurement of defined benefit plan, it's a OCI, not reclassified. Okay, current service cost, this year's salary, etc. This will come in finance cost, P&L. Change in revaluation surplus, it's a OCI, not reclassified to P&L. Okay, gain loss from translation of monetary assets. See, gain loss from translation of foreign operation hota na pura, assets and liabilities of foreign operation, that comes in OCI. But I have one asset, I have a debtor receivable in foreign currency. I have a debtor receivable in foreign currency and that I bring it to closing rate. That's a monetary asset that goes in P&L. The monetary asset and liability we bring to closing rate, that goes in P&L. अच्छा, फॉरेन ऑपरेशंस उसका आप क्लासिफाई कर रहे हो, दैट इज ओसीआई रिक्लासिफाइड टू पीएनएल. ठीक है. इन्वेस्टमेंट इन इक्विटी डेजिग्नेटेड एज एफईटी पीएनएल, इक्विटी इंस्ट्रूमेंट थ्रू ओसीआई, इट्स अ ओसीआई नॉट रिक्लासिफाइड टू पीएनएल. हाँ, डेट इंस्ट्रूमेंट थ्रू ओसीआई, दैट्स ओसीआई रिक्लासिफाइड टू पीएनएल. Income tax expense goes in P&L, share-based payment cost goes in P&L. Fine. So this is item coming in P&L, item coming in OCI. ठीक है. Statement of changes in equity done. Cash flow, how do we have it? तो उसके लिए we have a separate Ind AS 7. Cash flow, we have a separate Ind AS 7. We'll come to it later. Notes. Notes are the additional things which we are preparing in addition to your balance sheet, P&L, statement of changes in equity. We have notes. Fine. Now, disclosure of accounting policy. Whatever significant accounting policies you have taken, they are to be disclosed. कहाँ पे disclose करते हैं? Your note number 1 is always significant accounting policy. So whenever I go to notes, note number 1, significant accounting policy, to disclose the significant accounting policy comprising the measurement base used. What is the measurement base used? Acha. Also you disclose the judgment that management has taken in applying the different accounting policies. ठीक है. If there is some difficulty in estimation, कोई figure estimate करने में some difficulties are coming, there is estimation uncertainty वाला thing, वो source उसके related disclosure is required. To disclose the assumptions made regarding the future, other important sources of estimation uncertainty at year end, and disclose nature of such asset or liability where there was some estimation uncertainty, उसका nature and उनका carrying amount, that needs a disclosure. Did you understood this? Estimation uncertainty related thing, nature of that asset liability, uska closing mein amount and assumptions related to that taken, they are to be disclosed in notes. Fine, moving ahead. I'm just taking, okay, general features of your financial statement. What are the general features of financial statement? One, it should show a true and fair view. It should comply with Ind AS. Second, it should be based on going concern. It should be based on accrual thing. So material items are to be shown separately. Whether I should offset revenue and expenses, as such offsetting is not allowed. Frequency of reporting is generally annually, but our first year may be shorter or longer, up to 15 months it can be there. Comparative is to be given, and you need to have a consistency. Same accounting policies you're following, that's called consistency. Okay, then now coming over here, presentation, first one. This thing all in detail, presentation of true and fair view. The financial statement should show a true and fair view and it should comply with Ind AS. Now question, we need to make a explicit statement, unreserved and explicit statement that the financial statement are in compliance with Ind AS. Acha, it is possible management feels they are complying with Ind AS, auditor doesn't feel, so still can management make a statement? Answer is yes. So entity who financials are complying with Ind AS, they're required to make an explicit and unreserved statement about the compliance in notes. There may be a disagreement with the auditor, it's okay. The auditor's view is we don't comply with Ind AS. Our view is we comply with Ind AS. We can write it that we have complied with Ind AS. Explicit unreserved statement is mandatory. Ajay sir, can I deviate from Ind AS? Extremely rare case. If law and regulation do not prohibit. What do I do? Can I deviate? You may deviate. You do some alternative treatment and you disclose You disclose which standard not followed, why not followed, what alternative treatment you have followed, and because of that, what is the change coming. Okay, so if the law and regulation do not prohibit, then you follow something else. But you disclose what? It has complied with all applicable Ind AS except this. Which Ind AS not followed? Why not followed? Treatment what you have adopted, and because of that, what is the financial effect which is coming. But if law or regulation prohibits, no, they say no, you cannot do anything else, you have to follow Ind AS. If law or regulation prohibit, then follow Ind AS only, but disclose in note according to you what is wrong. According to you, Ind AS should not be followed. Now, you have followed because law or regulation prohibit. So you have to follow Ind AS, but you disclose. Which Ind AS, nature, according to you, why it is not appropriate. You have followed it, but according to you, why it is not appropriate. So when law or regulation prohibit, what do? Management will follow Ind AS, but will disclose in note what according to them is wrong. If they do not prohibit, you follow a different treatment and give in note other things that we have not followed this Ind AS, this is the reason, and this is the financial effect. But if law or regulation prohibit, you follow Ind AS only, but given disclosure why this is not correct. Okay. Next, going concern. Don't worry, we'll take appropriate breaks, 2 breaks of 15 minutes. In this 5 hour, 2 breaks of 15 minutes will be taken. First break will be after 2 hours, 15 minutes. Then we have 15 minutes break. 2 breaks will be taken. Don't worry about it. And every 15-20 minutes, 1 sip of water so that you're able to keep yourself fresh. Now, the financial statements are to be prepared on a going concern basis. Now see, we depreciate asset over the life of asset without thinking whether the business will continue that many years or not. So we have an assumption that we are a going concern. Now question comes, if there are some doubts, if there is a material uncertainty related to going concern, it has to be disclosed by management in notes to accounts, some material uncertainty related to going concern. Now further, if after year end hone ke baad, after the year is over, now management feels will not be a going concern. So if books are not yet approved, then the current year, it's not yet finalized. After year end, before books are approved, we understand we are not a going concern, then current year should not be prepared as per going concern. If you're not a going concern, your assets and liabilities will appear at net realizable value or net amount to be paid directly. Liquidation approach needs to be followed. So check this line which is written. Few lines you should be remembering. So event that occur after reporting date, after reporting period, might indicate that entity is no longer a going concern. So we are no longer a going concern when it's indicated after the reporting period, means after 31st March. The entity does not prepare its financials on going concern if the management's post year end assessment before financials are approved indicate you are not a going concern. So after year end, before books are approved, if we understand we are not a going concern, then this current financials, the current financials cannot be prepared on a going concern basis. Fine. Now check over here, there's question number 16. You are manufacturing plastic product. Government has basically abolished, removed import tariff. So now imported plastic materials are coming which are cheaper. And as imported plastic material, China will flood everything. So they will basically put at a cheaper rate. You are a manufacturer here, your business is in trouble. Okay, you are unable to compete with the cheap imports. And because of that, basically the things are given and now you have some losses, third quarter, fourth quarter, etc. Your loss is basically rupees 4,000. Now you are lobbied with the government. You have tried to lobby with government to reinstate the tariff on plastic, and government said they'll come up with a limited tariff. Earlier it was 40%, now they will come up with 10%. And earlier your currency was deteriorating, now you feel there will be stable currency, and now with this coming, you feel you'll return to profitability. So government has basically kind of announced it will reinstate the import tariff, plus you expect now a stable thing, and now you will return to profitability. So there is a material uncertainty related to going concern. It has to be disclosed in your notes to accounts. So check over here. When management is aware in making its assessment of material uncertainty related to going concern, the entity shall disclose those uncertainties. And check out the extract of note is given. Note number 1, basis of preparation. Whether you are preparing based on going concern or not. So we have a going concern assumption followed, but there is a material uncertainty we are disclosing. On the basis of management's assessment as at 31st March 7, management is required to assess whether they are going concern or not. Auditor will come and check. Okay. The financial statements have been prepared on a going concern basis. However, management's assessment assumes that government will reintroduce limited plastic import tariff and the currency exchange rate will remain kind of constant. Provided INR do not strengthen, and management forecast 10% tariff coming back on plastic product, will return to profitability. So as at 31st March 7, our net assets are this much. If import tariff are not imposed and currency rate are not remaining kind of stable, our liability could exceed asset and we may not be a going concern, but currently we believe we are a going concern. So can I say material uncertainty is disclosed? This is to be done by management only in notes to accounts. Okay, accrual basis is fine. Materiality, aggregation. Materiality and aggregation. Each material class of similar item you show separate. If it is dissimilar, anyways you show separately. Dissimilar items you show separately, provided they are immaterial. Immaterial hai to aapne club kar diya, it's okay. You present separately dissimilar item unless they are immaterial. The dissimilar item normally we show separately, but if they are immaterial we may club it. Material items, even though similar hai, material hai, you may show it separately. So present separately each material class of similar items. Fine. And Ind AS are intended to apply only for material item. For immaterial item, if you are not following Ind AS, chalega. For immaterial item, you are not following Ind AS, it's okay. Now, can I offset incomes and expenses? Income, expense, can I offset with each other and show net? Answer is no. You cannot set off unless the standard specifically allows. So check out, you should not offset unless required or permitted by Ind AS. Like your Ind AS 12. The Ind AS 12 is telling your DTA, DTL is there, so don't show both. So DTA, DTL, you present net, provided certain conditions are given to you. Achha, if I have a debtor net of provision, is it called offsetting? Answer is no. Debtor shown as net of provision is not offsetting. Okay, come to question 19. Okay, come to question number 19. Is offsetting permitted under the following circumstances? Is offsetting permitted under following circumstances? Expense incurred by a holding company on behalf of subsidiary which is to be reimbursed. Acha, expense is incurred by holding on behalf of subsidiary. So see, if I have basically incurred some expense, something will be reimbursed. So contract hai, reimbursement hone wala hai, then you may show directly the net expense. You can book directly the net expense and you can book a reimbursement receivable. So offsetting is permitted only when it reflects the substance of transaction. In case the agreement or arrangement, the agreement or arrangement between holding and subsidiary is to be considered. If arrangement is to reimburse the cost, the same may be presented net. So I incurred 100, 80 they are going to reimburse. I can book directly expense of 20. So वो allowed होगा. अच्छा, profit on sale of asset, loss on sale of another asset. Profit on sale of one asset, loss on sale of another asset, can I offset? Achha, profit on sale of machine, another machine में loss on sale, I can show net. Profit on sale of machine, loss on sale of another machine, I can show net. But a profit on sale of machine, loss on sale of furniture, that should not be done. That should not be done. So check out over here. Ind AS 1 requires you to present net gain or loss arising from a group of similar item. Similar. Okay, the gain or loss from disposal of various PP can be presented on net basis. Profit on sale of PP, loss on sale of PP, you show net. However, if they are material, you show them separately. If they are material, you show them separately. If material item koi aa gayi, then you show them separately, or a similar item. So check out net gain or loss arising from a group of similar transaction. यहाँ पे similar word is important. So similar है, उसका profit loss you may show it net. But if something is material in that, show it separately. Any doubts? Okay, I have to receive from one party. I also have to pay to that party. I purchase from that person. I sell to that person. I have to receive also. I have to pay also. Can I show it net? That receivable payable? So normally that receivable payable cannot be shown net because the receivable might be of different date. The payable might be of different date. Still, we need to consider. Ind AS 32. Your financial asset, financial liability should be offset only when you have a legally enforceable right to set off and you intend to settle on net basis. If at all we are intending to settle on net basis, like 100 receivable, 50 payable, we'll be having net 50 only paid, but we'll receive 100, we'll pay 50 on different dates, then you cannot set off. When you have a legally enforceable right comes through agreement or mutual agreement between both of us, and we intend to set off on net basis or to realize asset and settle liability simultaneously. Understood the word simultaneously? If receive on a different date, pay on different date, then in that case you cannot set off. Okay, this was related to offset. RTP November 21 question. Frequency of reporting is fine, at least annually. Generally annually. First year may be shorter or longer. Uska reason should be disclosed in your notes. Comparative are to be given. You need sometimes a 3 balance sheets. Remember previous year opening. When we need a third balance sheet, you apply a accounting policy retrospectively, or you make a retrospective restatement of item, that is rectification of errors, or you reclassify the items in financial statement. You will need a 3 balance sheet. Only balance sheet 3 are required. P&L is not required. Third balance sheet, current year end, previous year end, beginning of previous year. Fine. Presentation mein you should have a consistency. That's okay. Coming to questions of Ind AS 1. Coming to the questions of Ind AS 1, come to question number 20. They need advice on following item. There are qualification in audit report with reference to 2 Ind AS. Acha, see, auditor has given qualification for 2 Ind AS stating we have not complied. But see, according to us, if we have complied, can we make an explicit and an unreserved statement? Answer is yes. So can management make explicit unreserved statement? Answer will be yes. Second, is it mandatory to add the word standalone before each component? Achha, when I'm preparing balance sheet, P&L, do I need to write standalone? Now see, you know there are 3 types of financial statement: individual, separate, and consolidated. Individual is basically for those which do not have a subsidiary associate JV. If I don't have a subsidiary associate JV, that my financials are called individual financial. Achha, if I have a subsidiary associate JV, so one is a separate one and second is a consolidated one. So over here, is it necessary to add the word standalone? No, it's not necessary to add the word standalone, but I need to make it clear whether it's an individual financials, a separate financials, or a consolidated one. To add the word is not necessary, but we need to disclose whether these are individual financials or a separate financials or a consolidated financials. Word standalone is not necessary. Acha, is it necessary that the financial statement you need to write it has been presented in rupees? Yeah, you remember few things to be given. Usme the presentation currency. The presentation currency needs to be written. Acha, you want to show absolute figures, full figures not allowed, rounding off mandatory. तो यहाँ पे देखो no लिखा है. So it is mandatory to round off as per division 2. And the 5th one, you have a sale transaction with 10 related party previous year में sale transaction with 10 related party. This year there are no transaction with 4 party out of 10. So 10 parties had a related party transaction last year. Out of 10, 4 में I don't have this time. So do I need to disclose about that 4 in current year? See, in current year, comparative information is given. If comparative they are there, I need to disclose about them. In comparative they are there, I need to disclose about them. The company is of the view they don't have to disclose about this 4 party. No, that's wrong. Entity shall present a comparative they are there, you are required to disclose about them. Okay, going to question number 21. Keep on replying, very important. Every 15-20 minutes have a sip of water. ठीक है, the company presents financial statement for 3 years. ठीक है, 1 current year and 2 comparative. This is internally. अच्छा, they prepare for 3 years. As such, you don't need 3 years, but they prepare for 3 years internal purpose के लिए, without furnishing the related notes. Now, during the current year, management thought, why not present a 3rd year statement of P&L also? अच्छा, तो in your general purpose financial statement, you think of giving 3rd year P&L. P&L में 3 columns. See, P&L में 3 columns as such not required. But remember, current year, previous year, वो minimum है. Minimum. The requirements given under Ind AS 1 or requirement given under Schedule 3 are minimum. So if I want to present a 3rd year in P&L, can I do it? Yes. So can management present the 3rd year as an additional comparative in general purpose financial statement? Yeah, you can do it. If you are doing it, whether it should be as per Ind AS, definitely if you are doing it, you have to show it as per Ind AS only. And last, can I just give a 3rd P&L? Can I just give a 3rd P&L without furnishing 3rd balance sheet, 3rd statement of cash flow, 3rd P&L do chalega? Chalega na. See, minimum was 2 balance sheet, 2 P&L, 2 cash flow, current year, previous year. If P&L you want to give a 3rd, you may give it, not necessary to give 3rd balance sheet together with it. Answer is yes. Okay, question number 22. Keep smiling, pay attention. Question number 22. FY12, you booked the excess revenue 10 crore. FY12, you booked the excess revenue 10 crore. However, in 2-3, you discovered it. Oh, currently it's 2-3. 1-2, previous year. Previous year, I booked the extra revenue. So can I say figures of previous year are changing? Opening of previous year not changing. Achha, error relates to previous year, not period before previous year. The error relates to previous year. So whether they are required to have the 3rd balance sheet? No. 3rd balance sheet required only if the opening balances of previous year are getting affected. So check out over here. So they have to present a 3rd balance sheet when you apply accounting policy retrospectively or make a retrospective restatement or reclassify, and there's a material impact on balance sheet at beginning of previous year. The opening balances of previous year are changing, then required. So check out over here whether they want to, is it necessary? Answer is no. Achha, can they rectify the error in the current year figure column? Or prior period error? No. I have to rectify previous year column only. The answer is no. You need to correct the previous year figure only. I cannot correct it in current year figure. Okay, next. Question 23. XYZ Limited operating cycle 18 months. Operating cycle 18 months. Pay attention. Okay, they have a trade receivable due after 15 months. They are expected to be received within normal operating cycle. If they are expected to be received normal operating cycle, it's a current asset. Okay, trade payable. Okay, they are due for payment after 14 months. So due within operating cycle. It's due to be paid within operating cycle, but we are expecting to pay. The company does not expect to pay within operating. अच्छा, तो due within operating cycle. Now see, 12 months के लिए due था. It's expected to be realized within 12 months and it's due for payment within 12 months. So in current asset, expected to be realized within 12 months. And in current liability, due for payment within 12 months. It's expected to be settled within 12 months. Due to be settled within 12 months from reporting date. वहाँ पे due था. For operating cycle, ऊपर it was expected to be realized within the normal operating cycle. Here it was expected to be settled within normal operating. Here it is not expected to be settled. It is not expected to be settled within normal operating cycle. It's not due for payment within 12 months. So none of the conditions satisfied. It will be a non-current liability. Clear? So it's not expected to be settled in normal operating cycle, and it's not due to be settled within 12 months. Due was for 12 months, operating cycle में expected word था. Okay, there's a security deposit done, and this contract is expected to be completed in 18 months time, refunded after 6 months from completion. Acha, so 18 months for completion plus 6 more months, after 24 months I'll get back non-current. Are you enjoying? Yes, no. Next, we have some security deposits received which are repayable on completion, but if the contract is cancelled, I have to pay immediately. Okay, so do I have an unconditional right to defer it? No. If they cancel it, I have to pay it. So do I have an unconditional right to defer it for at least 12 months after the reporting date? No. If they cancel, I have to pay immediately. It's a current liability. We do not have an unconditional right to defer it for at least 12 months. If they cancel contract, I need to pay it. Okay, next, these were the questions. Fine, over here, question number 24. This is important, newly added. Question number 24, newly added. You just have to prepare a balance sheet P&L. I'll take the important point here. Okay, fine. Coming to question number 24, they've given cash equivalent, we understand where it comes. Now, NCI share of profit for the year. NCI share of profit, where do I show it? So see, opening retained earning plus current year's profit minus share of NCI. Minus कोई dividend declared, remaining comes in balance sheet. So opening retained earning plus profit for the year minus NCI share of profit हो जाएगा. And minus any dividend declared, that also will be deducted. ठीक है. Account receivable is fine. Inventory at cost, inventory at fair value less cost to complete. So some inventory at cost, some at NRV. You just have to take directly the figures. You just have to take directly figures, just present. ठीक है. No adjustment, just a presentation. अच्छा, long-term debt. Long-term debt, 500 crores due on 1st January each year. So 500 crore due tomorrow only. So that 500 will be current, remaining will be non-current. Interest accrued, it is less than 12 months, it will come under your current. Acha, see, this is retained earning at beginning. Profit for the year, usme NCI share you deduct. Any dividend declared, that also you deduct. Any dividend declared, that also you deduct. ये dividend कहीं दिख रहा है? Dividend for the year, dividend for the year. Now, this is dividend payable. See, dividend payable will come directly where? Dividend payable will come directly in balance sheet. वो balance sheet में आएगा. Dividend payable. Here are dividend declared. मिला? Dividend declared, deduct from P&L. So opening retained earning, current year's profit minus NCI share of profit minus the dividend declared. That is the closing retained earnings. Okay, that is closing retained earning. This is done. Okay. Now, this is NCI's closing balance. NCI's closing balance directly comes in balance sheet. Ye closing balance hai, their share of profit would already be included. Don't do anything here. So this NCI's closing balance directly in balance sheet. Accumulated depreciation on PP, deduct from PP. Provision for doubtful receivables, deduct from receivables. ठीक है. Warranty provision, it's for 12 months only, it's a short-term provision. Environmental provision expected after so many years, the long-term provision. Provision for accrued leave due within 12 months is a short-term provision. And dividend payable comes under other financial liability. Dividend payable, ये liability है. Dividend declared, you deduct from your profit. To prepare a balance sheet, it's fine, just important was this. So check out other equity में. ये retain earning at beginning, current year's profit, NCI share of profit you deduct, dividend declared you deduct. That is important. Other things were fine over here. Closing balance of NCI will appear under equity separately from owner's equity. So let me check the balance sheet for you. Liability side, ye equity attributable to owner, share capital, other equity, and then comes NCI. So equity attributable to owner हो गया, फिर NCI and then comes total equity separately from owner's equity. Closing balance of NCI directly comes in balance sheet. Okay, NCI share of profit deduct from total profit. So from the total profit, NCI ka share and remaining will be ours, which will come in your retained earnings. So closing retained earning, how do I have? Opening plus profit for year minus NCI share minus the dividend declared. Any doubts? Anybody with Ind AS 1? Okay, so we just completed introduction, we completed schedule 3, we completed Ind AS 1. 3 things are completed. Now we are taking a break for 15 minutes. Now we are taking a break for 15 minutes, and after the break, I'll start with business combination. We are taking a break. After the break, I'll start with business combination. 15 minutes break. It is 7 hours, 7 minutes. We meet back at 7:22. We meet back at 7:22. Break. 15 minutes. Right? We're back at 7:22. Bhaiya, pen, chalo, what happened with my pen? Okay, hi, welcome back. Chalo, let's move ahead. We finished three things: introduction to Ind AS, schedule 3, and third one was Ind AS 1. This is what we have done. I think we'll need bit extra hours. So what I'll do is, instead of 10 o'clock, we'll keep it till 10:30. I repeat, instead of 10 o'clock, we'll keep it till 10:30 every day. So it's 5 to 10:30 p.m. I'll take it. It's just that I want to make sure we are finishing it properly in this 4 days. Acha, we finished Ind AS 1. Let's go to Ind AS 102. Then I'll come to business combination, come to share-based payment. And just remember one thing, it's most important is discipline. It should not happen like, okay, first 1-2 hours you attended and then you are not attending. If you're attending, make sure you attend for all 20 hours. It's very, very important to have a good discipline. Success is not by doing great things. It's just by doing small things with great discipline. Sir, bore ho raha hu. You can't get bored, yaar. You have examination. Uske solutions are what? You need to keep on replying. You have water every 15-20 minutes. Keep yourself energetic. That are all the solutions. If you come out with excuses only, things are not going to work for you. Chalo, let's go to chapter number 7, unit number 3, Ind AS 102, share-based payment. And after this, I'll go to business combination. Now, share-based payment. We know that companies many times grants shares or ESOPs to the employees. So they will be rewarded by way of shares to be given to them. They stay for a few years and will be given shares. So that is nothing but your share-based payment. Now, share-based payment under AS, there was no accounting standard. There was a guidance note issued by ICI. So guidance note ke basis pe it was accounted, but under Ind AS, we have a Ind AS 102. And if a company is required to follow Ind AS, they will be basically having Ind AS 102, and based on that, the accounting for share-based payment transaction will be done. Now, what is a share-based payment arrangement? What's a share-based payment arrangement? It's an agreement between an entity or a group entity and another party. It's an agreement between an entity or a group entity and another party that entitles another party to receive. What another party can receive? Cash or other asset which is based on the price. So cash or other asset. But kitna? Amount what? The value of which will be based on price of shares of the company or the group entity. Of the company or the group entity, or that other party gets the equity instruments of the entity or the group entity. So either. So what is a share-based payment arrangement? It's an agreement. It has to be an agreement first of all between entity or a group entity and the another party, which entitles another party to get either the equity instrument of entity or group entity, or they have an option what? Cash milega, cash or assets. Cash or assets, the value of which is dependent on what? The share price, or basically the price of equity instrument of the entity or group entity. Fine, provided specified vesting conditions are met, and your group entity includes your parent and your subsidiary, not the associates and JV. If I am going to give you stay with the company for 3 more years and I'll be giving you shares of my parent, chalega. I'm going to give you shares of my subsidiary, chalega. That all is included. Did you understood? Or I am going to give you cash, but based on the price of share, it's also covered under share-based payment arrangement. Now coming to the word share-based payment transaction. What's a share-based payment transaction? It's a transaction. It's a transaction in which entity receives goods or services. You're receiving goods or services in a share-based payment arrangement. Means either you have to give shares or you have to give cash or other asset, the value of which will depend on price of shares. या तो आप shares दो or you give cash or other asset, but the value depends on price of share. So share-based payment transaction is a transaction in which the entity receives goods or services in a share-based payment arrangement, or you don't receive goods or services, your group entity receives goods or services. You incur an obligation to settle a transaction in a share-based payment arrangement where another group entity receives goods or services. So sir, is it mandatory I only should have received goods or services? No. If your group entity has received goods or services, then also it is fine. Keep answering. ठीक है. तो फॉर अ शेयर बेस्ड पेमेंट अरेंजमेंट यू नीड एग्रीमेंट. ठीक है, एग्रीमेंट कब होता है? वी हैव डन अ कम्युनिकेशन, इट्स एग्रीड अपॉन. ठीक है. गुड्स और सर्विसेज रिसीव्ड, goods or services received from counterparty in capacity as shareholder, that's not covered. Acha, what is this? A transaction with a shareholder in capacity as a shareholder is not covered. If I come out with a right issue, I have to give them shares, they'll be giving me cash. Oh, that is not covered over here. वो covered नहीं है. Transaction with shareholder in capacity as shareholder is not covered. But imagine there's a guy who's supplying me goods. Someone supplies me goods, I'm going to give them shares. So goods will be coming in, will be giving shares, it's coming under share based payment arrangement. ठीक है. Now the fair value of goods or services coming and the fair value of shares given. Fair value of goods or services coming, fair value of shares given may be different. So don't think that, sir, the fair value of goods or services is more, the fair value of shares is less, or fair value of shares is more, fair value of goods or services is more. There might be some unidentified goods or services. ठीक है. Now, if at all goods are given as charity, if shares are given as charity, not goods, if shares are given as charity, does it fall under share-based payment arrangement? Answer is yes. So, sir, charity, what we are getting? We are getting some marketing. We are getting some marketing, we are getting some inner satisfaction. So we are getting something. Unidentified goods or services are there, we are getting something. Shares are issued, it also falls under share-based payment arrangement. ठीक है. Now that share-based payment arrangement or share-based payment transaction may be equity settled, cash settled, or a combination. Now what is the meaning of word equity? What is the meaning of word cash? I'll come to it. It can be either equity settled, cash settled, or combination of both. Now what is not covered under your Ind AS 102? Transaction with shareholder in capacity as shareholder is not covered. Then shares which are to be issued under business combination. Okay, so I acquire certain entity, I'll be giving them shares, it's shares under business combination. Ind AS 103 applies to it, it's not covered under 102. ठीक है. अच्छा, financial instrument, right, financial instrument, right or option to buy or sell non-financial item. I have a right to buy some goods at certain level. Financial instrument issued to buy or sell non-financial item which can be settled in net and which are expected to be settled in net amount. They are not covered here. Acha, so imagine financial instrument is there. Basically, to buy or sell a non-financial item. Non-financial item is like PP or inventory, which is entered for settling in net. वो purpose है उसको settle करेंगे net में. That's not covered here. But I imagine I'll buy inventory, I'll give you shares. I'll buy inventory, I'll give you shares. The inventory will come, shares will be given. That comes under your share-based payment arrangement. That falls under 102. But inventory will not come, shares will not be given. If inventory ka value has gone up, you give me differential cash. If shares ka value has gone up, I give you differential cash. If it is basically entered for settling in net amount, it's not covered over here. It will be covered under 109. ठीक है. Now moving ahead, question 1 is fine, not important. I'm taking only the important thing. Now recognition, when to record. When to record a share-based payment transaction. So you should recognize you're getting goods or services. Share-based payment transaction was entity receives goods or services, or your group entity receives goods or services under a share-based payment arrangement. ठीक है. So entity shall recognize goods or services received or acquired in a share-based payment transaction when you get that goods or services. So when to record? When you're getting goods or services. ठीक है. Now, so I'm getting goods or services, that will be debited, and what should I credit? If you are giving equity shares right now, you can credit equity share capital. If shares are to be given in future, so you write SBPR. So the corresponding increase in equity, if it is equity settled, if you have to give cash, then it's a liability. If it's corresponding, you credit equity if it's equity settled, and you correspondingly increase the liability if it is a cash settled. Now when do I say it is equity settled? If I have to give my own equity instrument, if I have to give my own equity instrument, for me it's equity, or I do not have an obligation to settle. If I don't have an obligation to settle, my parent is going to settle. For me it is equity settled. When do you say it is equity settled for you? Either you are giving your own equity instrument or you don't have obligation to settle. The equity settled कब होगा? when you're settling by own, or you have no obligation to settle. Okay? Acha. If it is basically cash settled, then in that case you show it as a liability. Now, this was when to record when you are getting goods or services. Now, what value to record? That was when to record. Now, what value? If it's a equity settled, you will recognize goods or services received at the fair value of goods or services. So, share-based payment transaction, you should measure the goods or services received and the corresponding increase in equity at the fair value of goods or services received, unless the fair value of goods or services received cannot be determined properly. So unless the fair value cannot be estimated reliably, otherwise you record at fair value of goods or services received. So imagine, I acquire an air condition, I'm giving shares. The entry will be done whenever that air condition is received. And what value? Fair value of that air condition, not fair value of shares, fair value of air condition. If that fair value of air condition cannot be determined reliably, then you take the fair value of equity instrument granted, that is the fair value of shares. Did you understand? Okay. So pay attention. In case of a ESOP, employee gives me service for certain years and I'm going to give them shares. वहाँ पे fair value of goods or services cannot be determined reliably. The employee की service के लिए I'm paying salary ना, तो other than that the fair value cannot be determined reliably. That's why over there we take the fair value of basically the options granted. Remember, for employee, so in case of employee, this standard says you use the fair value of equity granted because it is not possible to identify the fair value of services which is rendered by employee. Now this table is important. One, measurement basis, measurement date, recognition date. Okay, when do I recognize? If it's employee or other than employee, when do I recognize? When goods or services are received. The recognition date is date when goods or services are received. ठीक है, recognition date, when. ठीक है, now what value do I record? At what value? अच्छा, if it is other than employee, some goods or services received, fair value of goods or services. But if it's employee, fair value of service not available, we take the fair value of equity instrument. So for employee, fair value of equity instrument. For non-employee, fair value of goods or services which we have received. ठीक है, तो ये recognition date, when to record, what value to record, measurement date. Okay, so we have to take fair value of goods or services received or fair value of equity instrument granted, fair value of which date? That is measurement date. Fair value of which date? The fair value of which date? So fair value of goods or services received, the date on which the goods or services received, उस दिन का fair value. And for that employee, we were taking fair value of equity instrument granted. We need to take the fair value of grant date. We need to take a fair value of which date? Grant date. Grant date is the date when agreement is entered. उसको बोलते हैं grant date. जब agreement हुआ, that's the grant date. So we entered into agreement to provide ESOP. Today is the grant date. Service will come over 3 years. Now, so ESOPs are accounted based on fair value of equity instruments granted. अच्छा, वो fair value of which date? The grant date's fair value. I hope this is clear. Okay, so if it is equity settled, you record when goods or services are received. ठीक है. Now at what value? At fair value of goods or services received, unless the fair value cannot be determined reliably. In case of employee, the fair value cannot be determined reliably. We take fair value of equity instruments granted. Now, for cash settled, the entity shall measure the goods or services acquired, liability incurred at the fair value of liability, and the liability will be remeasured at the end of each year. And the difference, change in liability, will go in your P&L. Okay, now moving ahead, going to question important 1. Okay, before that we have this grant date. Okay, grant date is the date when entity and another party agree to a share-based payment arrangement. So whenever that agreement is done, that's nothing but your grant date. Achha, if agreement is subject to approval, then the grant date will be when the approval is obtained. ठीक है. Now check this question number 4, RTP May 22, a good one. Keep on drinking water and keep smiling. Okay, NAT Limited has entered into a following share-based payment transaction. 1st April 1, they granted option to employees. Okay, whenever it's given to employees, the fair value of goods or services not available, we have to take the fair value of options granted. We have to take the fair value of equity instrument. And that fair value, which date ka fair value? Grant date. ठीक है. The scheme was approved by employee on 30th June. So grant date is 30th June. Grant date is not 1st April, it's approved by employee on 30th of June. The fair value of shares of 1st April taken, no, the fair value of shares of 30th June to be taken. Okay, so check over here, we understood the grant date, when they agree to a share-based payment arrangement. Measurement date is, which date's fair value should I take? Okay, so for other than employees, whenever goods and services are received, that date's fair value. For employee, the grant date fair value. Okay, so over here the grant date is 30th June, measurement date is the grant date's fair value, 30th June, same. Okay, second, 1st April we entered into a contract to purchase IT equipment and you will be giving equity shares. Okay, so IT equipment will come, I'll give equity shares, it's a share-based payment arrangement. ठीक है, and you received IT equipment on 30th July. Okay, so now we entered into an agreement when 1st April. So grant date is 1st April. Grant date is 1st April, but when do I record it? When goods or services are received. And I have to record it fair value of goods or services received. Achha, which date's fair value? The date when you're receiving that goods or service. For employee, the fair value of grant date was taken. For other than employee, it's when goods or services received, that day's fair value, the 30th July. So grant date is 1st April. Measurement date 30th July. Grant date 1st April, measurement date 30th July. The question is about grant date and measurement date. Third one, 1st April, the share options are given to employee. Okay, the employee is given, so fair value of services not available, we'll take the fair value of equity instruments granted. And fair value of equity instrument granted, उसमें कौन से दिन का fair value? Grant date. The scheme was approved by employee on 30th June. So 30th June scheme is approved. Grant date is 30th June. Grant date 30th June. Achha, it is subject to approval by shareholder. Oh, wait. It's subject to approval by shareholder also. And shareholder approved on 30th September. As it's approved on 30th September by shareholder, so grant date will be 30th September. Employee ने approve किया, but shareholder's approval still pending. So 30th September is the grant date. And now we have to measure at the fair value of equity instrument granted. Now which date's fair value? Grant date ka, to 30th September. So grant date is 30th September, measurement date also 30th September. Any doubts? Anybody with this question? Any doubts? Anybody with question number 4? It's a good question, important one. Okay, moving ahead. Now, employee share-based payment. Now, employee share-based payment is divided in 3 parts. 1, ESOP. 2nd, ESPP. And 3rd, SAR. Under ESOP, the options, employee stock option. The employees are given a right to purchase the shares in future, specified number of shares in future at a specified price, provided some conditions are fulfilled. So their option given to employee which entitled them to purchase shares at a specified price when future may. Under ESPP, the shares are given to employees right now at a discounted rate as a part of basically IPO or any other thing. The shares are given right now under ESPP, but at a discounted rate. And SAR, it entitles employee to receive cash. Okay, so if I say that whatever is the price above 1000 rupee, that much I'll give you in cash. So they entitle employee to receive cash for an amount equivalent to excess of market price on exercise date over the exercise price. So after 3 years, you stay in the company for 3 years. After 3 years, whatever is price above 100, that much I'll give you in cash. So that's SAR. Now let's understand accounting for ESOPs, ESPP, SAR. Most important is ESOP. First one. Okay, so under ESOP, employees are going to work for you for 3 years. You're going to give them shares after 3 years. So can I say you're going to get that services in 3 years? So you need to account for the expense over a period of 3 years. You need to account for the expense over a period of 3 years. But the actual expense, see, whenever they exercise, 3 years is wasting period, 4th year they are going to exercise. So now expense I have to book in 3 years. But the actual expense, the actual benefit to employees, what? I am giving them shares at 50, and when they're exercising, the price is, say for example 80. So I am giving at 50, when they're exercising, price is 80, so that 30 is benefit. So that actual benefit to employee is a loss to the company. That is basically what company is bearing. That will be known only in 4th year. But expense is to be booked in first 3 years. That's why your Ind AS 102 says, your Ind AS 102 is saying what? Accounting for ESOP. How do you do it? Actually, there are two options: intrinsic value of option, fair value of option. We have given an option, right? So right ka value kitna? What is that right worth? Intrinsic value of option, fair value of option. Under intrinsic value of option, we consider the market price of share on the grant date. Oh, market price today is, say for example 60 rupee. I am going to give them at 50 rupee, 10 rupee benefit. So that's today's market rate. Fair value of option is what will be the market price in future when they exercise. वो सारी चीज़ है. And see, determination of fair value of option is a very complex process, not relevant in our syllabus. But under Ind AS, intrinsic value of option is not allowed, only fair value of option is allowed. Under the guidance note which was there, under AS, वहाँ पे both are allowed. Ind AS में only fair value of option is allowed. Now, how to estimate fair value of option? It will be given in question, don't go in that. Okay, the fair value of option, whatever right I gave you, right ka worth, the fair value of option determined on grant date. The fair value of option determined on grant date will be booked as an expense over the vesting period. ठीक है. So fair value of option is the loss borne by the company. It will be amortized over the vesting period. Finding out fair value is not in our syllabus. It will be given in the question. ठीक है. Guidance note allows both. Ind AS allows only the fair value of option. Fair value of option is determined on which date? Grant date. It's determined on grant date. Now under equity settled. Under equity settled, the fair value of option determined on grant date is not to be remeasured. So equity settled में the fair value of option found out on grant date is not revised throughout the vesting period. But under cash settled, SAR, under cash settled, we show it as a liability. Liability I need to remeasure every year. If it is cash settled, then in that case, the fair value of option will be remeasured every year, and the difference, whatever is coming, will be going in your PN. So, वहाँ पे remeasure होगा every year. Under equity settled, fair value of option is not remeasured. Under cash settled, the fair value of option is remeasured. ठीक है. Now, the expense to be booked. We are booking expense over a period of 3 years. Based on fair value of option determined on grant date. Now see, what will happen is every year few employees will leave. And those who will stay for 3 years, they'll get the benefit. First year someone left, I have the actual data. But second and third year someone will go. I don't know. So uska estimated data I have to take. So expense will be based on latest information, latest estimate which are available while booking an expense. So when I'm booking expense at the end of first year, I have the actual data, how many left in first, but how many will go in second and third, I'll take estimate. Now, when I'm booking expense in second year, I have the actual of first and second both. And how many are expected to go in third, I'll take the estimate. Now, when I'm booking expense in third year, I have the actual of first, second, third, I'll use actual of all. So you use the latest information, latest estimate at the time of booking an expense. Did you understood? An expense is to be booked based on number of employees expected to fulfill the vesting condition. Suppose 100 employees are there, first year में 10 have left. So first year में 10 left. Now how many will go in second and third? I'll take the estimated 15. So now I'll book expense for 75 employees. Now when I come to second year, 5 actually left. So first year 10 left, second में 5 left. How many will go in third? I'll estimate. And estimates can change. Now I'm expecting 5 more will go. So now I'll book expense for 80 employees. The first year I booked expense for 75. But now I'm booking expense for 80. It may go up or down both. Expense is based on estimated number of employees who are expected to fulfill vesting condition. And how do I find expense for each year? How do I find expense for each year? Expense to be booked till date minus the expense already booked in previous year. Okay, if I'm booking expense in first year, the expense to be booked till date already booked will be nil. When I'm booking expense in second year, the number of employees would have changed. The total expense would have changed into 2/3 and minus already booked, I'll deduct. So that way the expense for each year is to be found out. Now coming to journal entries for ESOP. What are the journal entries? Whenever we grant the option, see, expense is to be recognized whenever that goods or services are received. On grant date, goods or services are not received, so no entry. Acha, first year over, we got some service, the expense you book, employee benefit expense. Now, shares are not to be issued right now, they are to be issued in future to SBPR. Shares are to be given SBPR. If it's cash settled, it will be SBPL. The employee benefit expense to SBPR, and employee benefit expense will go in your P&L. SBPR ka balance will appear under your reserves and surplus, that is your other equity. SBPR balance will appear where? Under other equity till basically the shares are allotted or that options gets lapsed. Okay. So whenever options are exercised later, the SBPR will get converted into equity share capital securities premium. If the options are not exercised later, the balance of SBPR will get reversed and transferred to retained earnings. Acha, future mein, whenever options are exercised in fourth year, we are not concerned with the actual price prevalent that time. Again repeat, we are not concerned with the actual price prevalent that time. The shares are treated to be issued at what? The amount which we are getting plus the loss which we have borne. Okay, the amount, suppose employee is giving me 50 rupee and we have booked 30 rupee, 10, 10, 10 each year. So we will make the entry as if shares are allotted at 80. Actual market price may be 120, maybe 150, doesn't matter. Actual market price keeps on fluctuating every minute, every second. So ignore that. Okay, so bank debit, whatever we are getting from employee, SBPR debit, expense was booked to SBPR tha, so SBPR mein it was lying, SBPR now goes away to equity share capital to securities premium. We are not concerned with the actual market price at that time. Acha, if suppose the options were wasted means the employee was there for 3 years, we have booked the expense, now he is not taking the shares because he has to pay exercise price, he doesn't have. As he is not paying, so the options are getting lapsed. If wasted option gets lapsed, we already booked expense, it's lying in SBPR. Now it's not required, so SBPR ko debit karo, we reversal, we don't take in P&L, it goes directly to retained earnings. Acha, unwasted option in between few employees leaving, that automatically gets adjusted while we are booking expense. The unwasted option getting lapsed automatically gets adjusted. Wasted option getting lapsed, you have to pass a specific entry at the end. Okay, moving ahead. Types of condition. Keep smiling. Okay, now you remember the definition, provided certain wasting conditions are fulfilled, aisa likha tha. So now conditions are divided in two parts. Wasting, non-wasting. Wasting condition further divided into service condition, performance condition. So conditions divided in two parts, wasting, non-wasting. Wasting further divided as service, performance. Performance further divided as market related, non-market related. Okay. Okay, the first of all, under wasting we have a service condition. Service condition means employee has to serve for a certain number of years, that's called as a service condition. Okay, performance. Performance is divided again into two parts, market related, non-market related. Under market related, it is based on share price. If I say whenever share price reaches 100, that's called market related. Whenever my share price reaches 100, that's market related. Non-market related is internal performance. Internal performance, sales reaching this level, profit reaching this level, that's basically production reaching this level, capacity utilization reaching this level, that's non-market related. Okay, now market related and non-market related. Now imagine if I say that the shares will waste, the options will waste to you whenever market price becomes 100. You see, when market price of share becomes 100, I don't know. And it's not purely dependent on me, it depends on market condition also. If the markets are doing well, even though we don't earn, even though we are not making profit, even though our profits are not jumping, still share price would have gone up. Like currently euphoria is there, the stock market is at kind of all-time high, so everything is going up. So the thing is, when market price will reach 100, we don't know, we estimate. When market price will reach 100, we don't know, so we estimate. Imagine initially we estimated market price will become 100 after 5 years. So we are booking expense over 5 years. Okay, when market price will become 100, we don't know, we estimated. Suppose we initially estimated on grant date, we estimated will reach after 5 years. So you book that expense over 5 years, don't change the estimated wasting period in between. Now sir, why don't change? See, market you cannot predict. So internal performances you can predict. Market mein share price will go up or down. Even though company is doing well, share price may go down due to some other factors. Imagine that Iran and Israel's war comes up. So even though your company does well, market will fall. So there's no point breaking your head into something which you cannot predict. That's why if it's a market related condition, whenever share price becomes 100, so you try to estimate on day one when you think share price will become 100, say after 5 years. So you book the expense over a period of 5 years. So if the performance condition is a market condition, the estimate of the length of expected wasting period you determine on grant date, it will not be subsequently revised. But if it's a non-market related to internal performance, when sales becomes this much, when profit becomes this much, when production becomes this much, वो आपके हाथ में, then in that case, if at all you say that whenever sales crosses 100 crore, options will waste. So day one you think when sales will cross 100 crore, you thought 5 years. Okay, so you started booking expense over 5 years, but now after 1 year you feel no, it won't be 5 years, it will come in 3 years only. So over there the estimated wasting period can be changed. So if performance condition is not a market condition, if it's non-market condition, the entity shall revise the length of estimated wasting period. वो revise कर सकते हो, because here it's in your head. You can predict. This is something which cannot be predicted. Don't break your head into that. Okay, the simple word, if performance condition is a market related thing, the estimated wasting period determined on grant date is not revised. But if it's a non-market condition, the estimated wasting period determined on grant date will be revised if it is required every year. ठीक है. Now one more thing, under wasting condition, if it's basically service condition, employee has to stay for that many years. If it's a performance condition also, still employee has to stay. Employee has to stay till that market price reaches 100 or till that turnover reaches 100 crores. So can I say service condition is always linked with performance condition? The service condition is always linked. Okay, now going to non-wasting condition. Now non-wasting condition are all other condition. They are not service condition, they are not performance condition. They are not service condition, they are not performance condition, they are all other condition. They are also to be fulfilled in order to get that share-based payment. तो उसको भी fulfill करना पड़ेगा to receive the share-based payment. But one thing you remember, under your non-wasting condition, the service condition is not linked. Imagine you put up a performance condition that whenever sales reaches 100 crore, but you may leave after 1 year. आपने 1 year के बाद छोड़ दिया तो भी चलेगा. Still, whenever sales reaches 100 crore, you will be entitled for option. So can I say here, even if you are not there as an employee, still you are entitled. If service condition is not linked, then it will fall under non-wasting. Performance condition में service condition always linked. If service condition not linked, then it will fall under non-wasting. Plus any other condition. Inflation becomes this much. Inflation becomes this much. That's not internal. That's not market price. That's not staying for this many years. So that comes under your non-wasting. All other conditions. ठीक है. Now just try to understand. If it's a service condition, employee has to stay for how many years? 3 years. Employee has to stay for how many years? 3 years. ठीक है. Now, under your service condition, what happens if he doesn't stay? He has to stay for 3 years. What happens if he doesn't stay? The number of options expected to waste. Initially, we thought all 100 employees will stay. But now we are thinking, no, only 95 will stay. The number of options expected to waste, that is affected. So because of service condition, the number of options expected to waste, that will get affected every year. Understood? Okay. Now, non-market related performance condition. Initially, we thought sales 100 crore will reach in 5 years. But no, now we feel it will be 4 years. Now we feel no, it will be 3 years. So this will affect the wasting period. So service condition affects number of options expected to waste. Non-market related performance condition is affecting what? The estimated wasting period, initially we thought 5, but अब वो change होके it becomes 3 also. Acha, if it's a market related performance condition, we don't change the wasting period estimated on day 1. Market related, we are not changing the thing. Now pay attention. Can it happen that market price never becomes 100? Yeah. The probability that market price may not become 100 is considered while determining the fair value of option. So market related condition will affect the fair value of option ka determination, which we don't determine, experts will determine. So while determining fair value of option, experts will consider into picture the market price may never become 100. So they will consider that. Okay? And in non-wasting condition also, it will affect the fair value of option, which will be considered. The non-wasting condition will be considered by the experts while determining fair value of option. So try to understand which condition affects what. Okay, service condition, this will affect what? The number of options expected to waste. Okay, so this will affect the shares expected to waste. This will affecting the number of options expected to waste. Yes. Would it affect the fair value of option? No. Acha, performance condition, which is non-market related. Non-market related, initially we thought will reach 100 crore in 5 years. Now we think no, it will be in 3 years. So estimated wasting period, the total wasting period, is it affected? Yes. Would it affect fair value of option? No. But for market related and non-wasting condition, their effect will be considered by expert while determining fair value of option. So यहाँ पे while determining, would it affect the fair value of option? यहाँ पे yes, यहाँ पे no. I hope this is clear. Any doubts? Impact of condition? Any doubts? Impact of condition? Okay, moving ahead, variation in wasting period. Okay, variation in wasting period. Now see, wasting period we thought initially 5 years. Service condition with the fixed. Service condition, the wasting period is fixed. Under your non-market related performance condition, whenever sales becoming 100 crore. Initially we thought 5 years. Now I think no, it will be 3 years. So can I say there's a variation in wasting period? This will be only under non-market related performance condition. So value of option is amortized over the estimated wasting period. The initial estimate of wasting period would be reviewed and revised if necessary at the end of each accounting period. But if it's a market related performance condition, so it will not be revised. Okay. Now coming to question number 8. Now check 100 shares to each of 500 employees, and the employee should remain in service during the wasting period. How they will waste? If earning increase by 12%, they are going to waste in first year. Achha, if earning increase by 20% or more over 2 years, so it will waste in second year. And if earning increase by 22% or more, then 3 years. Achha, imagine. Now first year mein earning increase by 10. Is it 12? First year mein earning increase by 10. Is it 12? No. So I understand they are not wasting in first year. Now you are in first year. You have actual of first. You don't have data of second and third. So now it may waste in second year or third year, I don't know. Now, pay attention. Assuming second year also will have the same earning. So currently we have 12, next year also suppose we have 12. So can I say total 24 ho jayega? Is it more than 20? Yeah, it's more than 20. So we are expecting. So when we are at the end of first year, we are expecting the total wasting period to be 2 years. Assuming same earning will continue. So when we are at the end of first year, we are expecting a total wasting period 2 years. It's a non-market related performance condition, earning increase, internal. ठीक है. अच्छा, first year में 29 left. You total 500 में से 29 gone first. And second and third, how many are expected to go? You take estimated. 31 will leave in basically 2002. We are expecting wasting period 2 years. First year mein 29 left. How many are expected in second year? Only consider that. So 440 we are expecting will be getting the shares at the end of second year. So if you just check the solution, total estimated vesting period when we are booking expense in first year, it is 2 years. Did you understand? Okay, so now first of all, whenever we are solving question under this chapter, we have a table prepared, expense to be booked for each year. Number of options expected to waste. How many options are expected to waste? Total 500 were there, 29 already left. We are expecting wasting period 2 years. How many are expected to leave in second year? 31. So this many employees, per employee 100 option, so 44,000 options are there. Now it's equity settled. तो फेयर वैल्यू ऑफ ऑप्शन डिटरमाइंड ऑन ग्रांट डेट इज कैश सेटल में रिवाइज होता है, यहाँ पे नहीं होगा. तो मल्टीप्लाई बाय फेयर वैल्यू ऑफ ऑप्शन 122, इट्स नॉट रिवाइज्ड. तो टोटल एस्टिमेटेड एक्सपेंस व्हेन वी आर इन फर्स्ट ईयर इज दिस. टोटल वेस्टिंग पीरियड 2 years to be booked till date, half already booked will be 0. Now when I come to second year, what happened? Okay, when I came to second year, we understood the earning increase is only 18%, 2 years together. Oh baap re. It is 2 years together, 18, not 20. So now wasting period is not 2 years. So now I feel wasting period will be 3 years. Okay, so earlier we thought wasting period will be 2 years. Now, this is changed to 3 years. Did you understood this? Now, how do I book expense? We are in second year. Out of 500, 29 already left in first. 29 actual is left in second. In third, how many are going to leave? I take the estimate. So when I was in first year, I took estimated of second. But when I'm in second year, I take the actual of second only. So this many employees into 100 option, this many options, 122 fair value is not remeasured under equity settled. Now estimated vesting period is 3 years. As a third year mein, the conditions are satisfied, it actually remained 3 years. I hope this is clear. Okay, we are required to find out expense for each year and journal entry. Okay, journal entry. We are booking first year, second year, third year expense. Okay, when you book an expense, employee benefit expense to SBPR. Expense goes to PNL, but ICAI doesn't pass entry for that, will not pass. Expense to SBPR, expense to SBPR, expense to SBPR. And then, whenever they're exercising, assuming everybody exercises, if everybody exercises, SBPR gets converted into capital. Acha, exercise price not given, that's why bank debit is not taken. Otherwise, bank debit will also happen. The exercise price not given, amount received from employee at the time of exercise is ignored. So SBPR debit to equity share capital. If face value was given, that much would have gone in capital, remaining would have gone in securities premium. Any doubts? Question number 8. Okay, going to question number 11. Going to question number 11. An entity P issues a share-based payment plan to its employee. Number of options are 100. Fair value is 25. Grant date wala not remeasured under equity settled. Market condition. Whenever share price reaches 30. And expected hai 4 years. So I'll take the vesting period as 4 years. I'm not going to remeasure or revise it. It's a market related, don't try to break head into something which you don't know. So whenever share price reaches 30 rupees, we expect it will reach 30 in how many years? 4 years. Book it over 4 years. ठीक है. Now scenario, what if it is getting fulfilled in third year only? Okay, we are booking over 4 years, but at third year में price reach, so book the remaining expense in third year itself. The first year we booked based on 1/4. Second year we booked based on 1/4. थर्ड ईयर में हो गया तो नाउ बुक द रिमेनिंग. अच्छा, सपोज इफ इट इज फुलफिल्ड इन फिफ्थ ईयर, तो डू वन थिंग, यू आर बुकिंग एक्सपेंस इन 4 years. फर्स्ट ईयर 1/4, सेकंड ईयर 1/4, थर्ड ईयर 1/4, फोर्थ ईयर 1/4. फाइन, book that only. Don't book in 5 years, 4 years only. Now the balance of SBPR will remain. The balance of SBPR gets converted into capital in 5th year when the criteria is satisfied. It's not lapsed. Lapse हो गया तो बीच में it will go to retain earning. It's not lapsed, so keep SBPR balance till 5th year. Okay, so check the solution over here. Question number 11. So always when you're writing, you need to write theory. Don't think that, sir, I just write down the practical part, fast chalega. No, theory has to be written. See how it is written. As per Ind AS 102 and share-based payment, market-related performance conditions are considered while determining fair value of option on grant date. Such fair value of option will be amortized over the estimated vesting period, which is estimated on grant date, and the estimated vesting period will not be revised and reviewed every year under market related performance condition. It's not to be revised, but if that condition is fulfilled before the estimated period, we thought 4 years and it's satisfied in 3 years only, the remaining expense will be charged off immediately. Then you book all remaining in 3rd year only. And if it takes a longer time, we thought 4 years and it got satisfied in 5 years, the book expense in 4 years only. Keep SBPR because it is not lapsed. 5th year when it is fulfilled, it gets converted into capital. Then expense will be booked over the original estimated vesting period only, that is 4 years. Okay, in your case A, we were booking 1/4 expense each year. We booked in 1st year, 2nd year, 3rd year, it got fulfilled, book remaining in 3rd year. In case B, we booked expense in 1st year, 2nd year, 3rd year, 4th year, 5th year expense will be nil. But I will continue SBPR because it's not lapsed. And then the SBPR will get converted into capital. I hope this is clear. Okay. This was question number 11. Moving ahead to the graded vesting. Okay, Bhavya is telling, sir, can you please wait 1 minute to take a snapshot of the solution written? Dear, this all things have been done in class. Those students who have attended my class, they already have the solution. If someone has not attended my class, I'll recommend you to keep open the material of the faculty or ICI material open. This all questions are there in ICI book, don't worry about it. For me, whenever I prepare material, I ensure that all ICI questions, RTPs, suggested answers, everything are covered in a material. So my material is always kind of exhaustive. A snapshot wala thing will not be possible. I cannot be waiting for that. If you want, you can take it, or later on. See, YouTube video is available only to you. You can just go back and take it later on. You can just note it down. This question ka solution I need to take, or you can just also write down the timings as well, whatever is the video ka timing currently. But don't wait, don't tell me to wait, otherwise we won't be able to complete it. Now, going to a graded wasting. Now, what is this graded wasting? Suppose I tell you, I'll give you 100 option. Employees are given 100 option. Out of 100, 40 will waste at the end of 1st year. Another 40 will waste at the end of 2nd year, and 20 will waste at the end of 3rd year. You stay for 1 year, 40 will waste. Another 1 year, another 40 will waste, and another 1 year, 20 will waste. This is called as a graded wasting. 40 wasted at the end of 1st, another 40 at the end of 2nd, and 20 at the end of 3rd. Now, sir, how do I account for a graded wasting? So, under graded wasting, you are having over here kind of 3 things. First one, wasting at the end of 1st year. Another 40 wasting at the end of 2 years, and another 20 wasting at the end of 3 years. Treat them as a separate plan. So based on wasting date, the plan is segregated into different group. Each of the group is treated as a separate plan. And now, fair value for those which are going to waste at the end of 1st year, those which are going to waste at the end of 2nd year, those which are going to waste at the end of 3rd year will be different. So whenever I'm estimating what will be the price after 1 year, what will be the price after 2 years, what will be the price after 3 years will be different now. So you will be already given in question. The fair value of option which will be wasting at the end of 1st year, uska fair value ye hai. Fair value of option which will be wasting at the end of 2nd year is this. And fair value of option which will be wasting at the end of 3rd year is this. It will be already given to you. Now, first one, it is basically wasted at the end of 1 year only. So uska wasting period is 1 year. Now, another 40 which are basically to be wasted at the end of 2nd year, usme wasting period is 2 years. So book it in 1st and 2nd year both. And those 20 last way which are to be wasted at the end of 3rd year, wahan pe wasting period is 3 years. So for group 1, the wasting period is 1 year. For group 2, the wasting period is 2 years. For group 3, the wasting period is 3 years. Treat them as a separate plan and account it accordingly. This was a question given in RTP November 22. Pay attention. ICI book doesn't have anything about graded wasting. You open up ICI ka module, it doesn't have anything. This was given in RTP. Now, total number of employees are 400, nominal value per share is 100, and number of options given is how many? 60. Now, how they are wasted? Okay, 20%, 12 will waste at the end of 1st year, 24, 40%, 60 of 40% is 24. 24 will waste in second year, another 24 will waste in third year. Okay, so I understand 12 are wasting in first year, 24 wasting in second year, another 24 are wasting in third year. Fine. So year 12, 24, 24. Okay, for group 1, 12. For group 1, 12, wasting period is 1 year only. How many left in first year you already know? Ho gaya. How many left in first year you already know. And they already given you fair value of option for group 1 is 10, group 2 is 12.5, group 3 is 14. So how many left in first year actual available, and iska wasting period is only 1 year. So how many will go in second and third year is not counted here. Iska wasting period is only 1 year for group 1. Okay, this many left in first year, this many are there, fair value iska 10 hai, you book it in 1 year only, fully booked now. Okay, now group 2, 24 option, their wasting period is 2 years and unka fair value is 12.5. Acha, first year mein 40 left, expected to leave in second year because 2 years wasting period, expected to leave in second year is considered. Okay, so this many options are expected to waste 12.5, total estimated expense I have to book in 2 years, currently book half and remaining will come in next. So ye ho gaya group 2. Now group 3, uska fair value given is 14. ठीक है. Now in group 3 the wasting period is 3 years. The first year में 40 left. How many will go in second and third year? Estimated data is taken. Now when you come to second year, actual of first, actual of second, estimated of third, and when you come to third, all actuals are available. So for group 1 expenses only in first year, for group 2 expenses in first and second year, and for group 3 expenses in first, second and third. So what is the total expense in first year? This plus this plus this. Group 1 ka first year, group 2 ka first year, group 3's first year. ठीक है. What is the total expense in second year? First, group 1 is not there in second year, group 2 and group 3. And what is the total expense in third year? There is no group 1, no group 2, only group 3. Did you understood this? This is graded wasting. Okay, moving ahead, we go to modification to ESOP. Now many times the terms of ESOPs are modified. Initially we told you we are going to give you at 50 rupees. Initially we told we are going to give you at 50 rupees. Market mein now rates have gone down. Now share is available in market at 20 rupee. If share is available in market at 20 rupee, would anyone buy at 50 rupee? Nahin. So now I'm changing and making, instead of 50, I'll give you at 15. Instead of 50, now I'll give you at 15 rupees. So modifications are done. Now what happens is, due to modification, the fair value of option may go down also, the fair value of option may go up also. If modification is done in favor of employee, if modification is done what? In favor of employee, price reduced, exercise price reduced, the fair value of option goes up. So there was an option where I was telling I'll give you at 50 and now I'm saying there's an option I'll give you at 10 only. So can I say this will give more benefit to employee? Giving at 50 rupee and giving at 10 rupee, the 10 rupee wala will give more benefit to employee. So whenever that exercise price is reduced, the fair value of option, the right ka value goes up. So whenever exercise price reduced, fair value of option goes up. Whenever exercise price increased, the fair value of option goes down. Generally you cannot modify which is detrimental to employees, वो SEBI doesn't allow, but unlisted company में SEBI not applicable. So for unlisted company, private companies, it may happen that you may change terms which are not favorable to employee also. So when it's favorable to employee, the fair value goes up. When it's unfavorable to employee, the fair value of option goes down. ठीक है? ठीक है. So you might modify the terms and condition. If you modify, what they're telling, if you modify, you have to record at minimum the cost of original award as if it is not modified. So originally जो cost आता था, that तो you have to book only. So simple words, if you do some modification which is against employee, if you do some modification which is against employee, exercise price increased, the fair value of option goes down. Fair value of option goes down, still you have to book the original only. So if at all you do something which is detrimental to employee, the fair value of option is going down, you still have to book the original fair value only. But if suppose modification increases the fair value of option, if I reduce exercise price, beneficial to employee. If I reduce exercise price beneficial to employee, fair value of option goes up. So now in that case, they are telling the incremental fair value. The incremental fair value, you book it over the remaining vesting period. And now how do I determine the incremental fair value? The incremental fair value is found out as how? The fair value of that modified option today minus the fair value of original option today. So there was an original option, I'm going to give you shares at 50 rupee. But the fair value was determined on grant date. Normally we don't remeasure or not find the fair value again, but whenever there's a modification, you have to find the fair value of original option today. So how do I find out additional cost due to modification? The fair value of modified option today minus the fair value of original option today. The original option का fair value was, say for example 30, but वो grant date fair value था. That option का today value will be different. Imagine that option only right to buy at 50 rupee. Today uska value is 5 rupee only. So the day when I granted uska fair value is different. Today uska fair value is different. So how to find incremental fair value? So the option which was granted to you today is worth 5 rupee. I am giving a new option which is worth 8 rupee. The option which I had granted, जो पहले grant किया था, उसका worth today is 5. I am giving a new one which is worth 8. The extra benefit given is 3. That way you need to find out. Now, how to account for this? Original जो expense था, you continue booking as it is. Incremental जो 3 rupee आया, that you book it over the remaining vesting period from the date of modification to the vesting period completion. Okay, the check over here. Question 13. 150 share options to 1000 employees, service condition 3 years, fair value of option on grant date is 129. ये grant date है. To find out incremental fair value of option, ये नहीं होगा. Incremental fair value due to modification, this is not considered. 35 employees left, 60 are expected to leave year 1 में. Now we have repriced it. Because the fair value fell to 50. So what was the value of the right? The value of right which I had given you was 129 or right. The right was worth 129 on grant date. But today the right is worth 50 only. That right was worth 129 on grant date, but that right is worth today 50 rupee. And now I'm giving you another right which is worth 80. So today the right which you are having is worth 50 rupee today. I'm giving you another one which is 80. So incremental expense is 30. So what is the incremental fair value due to modification? 30. Okay, so this 30 rupees to be booked over the remaining vesting period. Now we assume that this has happened at the end of first year. The end of first year में हुआ. The end of first year to end of third year. So in second and third year इसका expense will be booked. Now original 129 which you are booking, the original 129 will continue as it is. So book original 129 over 3 years and additional 30. Additional this 30 over second and third year. That is in 2 years. So check out over here. Always write theory. Always write theory. This question 13, check. So as per Ind AS 102 on share-based payment, if modification increases the fair value of option, the incremental fair value is recognized as an expense over remaining vesting period. So in current case, modification is done at the end of first year. The incremental fair value will be recognized over the remaining 2 years. And incremental fair value is coming 30 rupees. Now, first we are booking original. Original will remain as it is. 129, you book it over 3 years, वो same रहेगा. And then comes additional. Additional, you are booking it not in first year, only in second and third. 30 rupees. वो उसका जो आएगा वो second and third year में it has been booked. Did you understood? And the total expense what we have booked is 129 plus 30. Total expense what we have booked is 129 plus 30. Okay, coming to question number 14. Okay, 1st April 1,000 options are granted at 2,000 to 2,000 employees. They will vest on March 4. 1st April से March 4, 3 years. ठीक है. 1st April we estimated 1,800 employees will fulfill. The estimate was changed to 1,850. Then it is basically 1,840. Fine. The fair value of option on grant date was 1.2. वो ग्रांट डेट का 1.2 था. September 2 में the fair value was only 0.9. अब हमने चेंज किया, we repriced and now the fair value increases to 1.05. Okay, the options which were given to you, today is worth 0.9. Don't say sir they are worth 1.2. They were worth 1.2 on grant date. Today they are worth 0.9. 0.9 की जगह I'm giving a new one which is 1.05. तो 0.15. 0.15 is basically the incremental fair value which I have to book over remaining vesting period. Yes, September 2. तो I assume it 30th September. तो September 2 से March 4 तक, March 4 और March 3 which was March 4. तो September 2, तो it's 1.5 year. तो this additional expense I have to book it over 1.5 year. तो check out first original expense I'll continue booking over 3 years which was 1.2. Additional 0.15 I'm booking over 1.5 year. ये 1.5 दिखा, यहाँ पे half year, यहाँ पे 1 year. यहाँ पे half year, यहाँ पे 1 year. This is 1.5 year. Okay, moving ahead. Cash settled share based payment arrangement, or this is called SAR, stock appreciation right. Cash settled share based payment arrangement, or we call it as SAR. SAR entitles the employee to receive cash. कितना cash? Excess of market price of share on exercise date. Whenever they're exercising, whatever is price above 100, excess of market price of share on exercise date over the exercise price. So say exercise price 100, over and above 100, whatever it is, I'll give you that much in cash. Acha, whenever cash is to be given, can I say it's a liability? And if it's a liability, if it's a share-based payment liability, the fair value has to be remeasured every year. So accounting for SAR is done in a similar way as ESOP. Only thing is, instead of SBPR, we use the word SBPL. And another thing, the fair value will be remeasured every year. Otherwise, it is same. So check. So accounting is similar to ESOP, except SBPL is prepared instead of SBPR, and fair value remeasured every year. And liability will appear under liability. Oh, SBPR was coming under your other equity. Okay, so over here, this question they have given you whatever is the price over and above 125, that much I'm going to give you in cash. ठीक है? You have to stay for how many years? 3 years. The SAR is exercisable after 31st March 11, but till June. Okay, 31st March 11 tak you can't exercise. 3 years is wasting period. Then after that, 3 months mein you can exercise. The fair value 8, 9, 9, 10, 10, 11. The fair value of SAR is given. You need to remeasure it. So check out. यहाँ पे ये fair value is changed. Everything else is same as ESOP. Only this fair value is changed. Now next question, 16th one, important. Pay attention. Next question, 16th one, important. Pay attention. And one more thing. In the last question, we had booked till 24. तो पहले 21, 22, 23, 24, तो till end, can I say 31st March तक 24? Now, the people exercised in June. अच्छा, we have booked expense 24. When they exercised in June, the price is 25. So extra 1 rupee you book it at the time of exercise. 24 becoming 25, वो आप book करो at the time of exercise. If it was equity settled, if it was not cash settled, equity settled, the fair value of option determined on grant date is not remeasured. And whenever the employees are taking shares, we are not considered with the actual market price. यहाँ पे 24 है, but whenever they're exercising, I have to pay them how much rupee? 25 rupee they have given. The extra 1 rupee still to be paid, that will be booked at the time of exercise. Okay, now 16th question. 16th question. XYZ Limited issued 10,000 share appreciation right that vests immediately. Question has given you it vests immediately. ठीक है. Now practically question is wrong. Why practically question is wrong? I tell you. यहाँ पे they've written it vests immediately, and then they are telling it is expected 95% will exercise, 92% will exercise, and finally 89% exercised. See, if it has already vested, why anybody will leave it? If it is already wasted, why anybody will leave it? So actually question galat hai, but you solve it based on what is given. So that waste immediately. If it waste immediately, book full expense immediately. So 10,000 SAR, what is the fair value today? 95. What is the fair value today only? Book full 10,000 into 95 immediately. So check solution. Information given in question is practically not possible. First line says it waste immediately, while sixth line says 89% employees exercised SAR. Acha, if SAR waste immediately, all employees will definitely exercise. SAR mein kya hai? Over and above market exercise price, whatever is price there, I can claim cash. I don't have to pay anything na. So as they don't have to pay anything, the differential amount they are getting in cash, so definitely everybody will take. We'll solve the question based on information given. It's waste immediately 10,095. Immediately book it. So wasting period hai nahi, wasting period 0. Immediately booked 950. 950 immediately booked. It's not yet paid. It's not yet paid. Now, then they are telling 95% are expected, then 92% are expected, eventually 89% it is wasting. To take that way. And as it's SAR, the fair value is to be remeasured. We started with 95, then 112, 109, 114. So we already booked, and see, wasting period hai nahi. So whatever comes fully is to be booked. Already booked was this, remaining you book right now. Fully is to be booked, already booked was this. Now there's some reversal coming. And now, whenever it's SBPL may fair value going up and down, extra expense coming or reversal coming goes in P&L, not in retained earning. SBPL में यहाँ पे जो reversal भी आया, that will go in P&L, not in retained earning. Did you understood? So SBPL going up or down would always go in P&L, not in retained earning. See, these are notes which we write, which always helps you to understand the questions in a better way. Okay, moving ahead, question number 17. Okay, 17 is a good one. Pay attention. 10,000 share appreciation right to 40 employees are there, and 1st January 05 given, based on 31st December, 2 years. 2 years, okay. And management had thought how many employees are going, 10% will leave during 2 years. We estimated that, and fair value 11 tha on grant date ka fair value. Expense is booked at the end of first year. Seedha first year lo grant date fair value koi relevant hi nahi hoga yahan. Okay, now we are booking expense at the end of first year, and then at the end of second year we'll take that. Now 10% employee left before 2006, at the end of 2006 same raha. Acha, 2 years is wasting period. Exercise can happen later also. ठीक है, तो 2 years wasting period है. Wasting period 2 years, book it over 2 years. Book it over 2 years. First year and 12 है, second year and 8 है. तो check out the solution. Okay, तो first year 36 employee, 1012 rupee, half should be booked. Second year 36 employee, 1000 into 8, this should be booked. Already booked is 216, remaining 72,000 booked. Did you understood this? The first and second year done. Now exercise pending, but see, still it's not yet exercised. Whenever they're exercising, its fair value is different. I have to pay that. So again it is to be constantly remeasured. Now coming over here, 31st December 7, we have booked 8 rupee till now. We have booked 8 rupee till now. 31st December 7, when the intrinsic value was 10, intrinsic value 10 tha means the differential is 10, I have to pay 10. 6 employees exercise option. Okay, 6 employees exercise, we have booked 8, we are paying 10, extra 2 rupee to be booked. And remaining, they are exercising next year. Okay, remaining are exercising next year, I have to bring it to closing rate 13. Okay, then now third year mein, how do I book expense? Third year mein, how do I book expense? Pay attention. 6 employees, when they exercise, price was 10. I have booked expense of 8 rupee. Pehle 12 tha, fir last mein basically based on 8, the expense is there. Now when they are exercising, 10 is paid to them. So for them, 2 rupee you book it. So for 6 employee, 2 rupee you book it. And for remaining 30 employee, 8 becomes 13. So I have to book 5 rupee. So yahan pe 2 rupee booked, yahan pe 5 rupee booked. And now for 30 employees, 6 employee it's paid. For 30 employee, 13 rupees is booked. 13 rupees is booked, and whenever they are taking intrinsic value is 12. Oh, so for that 30 employee next year, I had booked 13 till now, they are paid 12, 1 rupee reversal comes. For 30 employees, 1 rupee reversal comes. So this is expense for each year. Now liability for each year. First year end 216 वो SBPL में था. Second year end 288 था. Now 6 employees gone. 6 employees gone. For 30 employees I have 13 rupees booked. 30 employees 13 rupees booked. This is there. And last May all are paid off. It is nil. Did you understood? Did you understood question 17? A very good one. Okay, 18th question. There are 400 stock appreciation rights given to 75 employees. Fair value is 200. Stock appreciation right. Okay, cash settled. And fair value each year end is given to you. Each year end is given to you. First year end, second year end, third year end, fourth year end. What will be the difference if at the end of second year you modify to 3 years service? अच्छा तो पहले तो solve as if it's a 4 year, तो normal question, nothing to be done. Fair value revised, that's the only thing. Okay, so check over here. Okay, first if wasting period is 4 years, so 75 employees are there, 400 options are given, there's no change in employees, so it is remaining same. Only thing is it's a SAR, the fair value keeps on changing, expense to be booked till date, 1/4, यहाँ पे 2/4, 3/4 nil, तो ये हो गया. Now there's another question. What is another question? What if at the end of second year the total number of years is changed to 3 years? If total number of years is changed to 3 years, it's a liability na. So liability will be measured accordingly. So whenever you get to know second year end में I get to know now it's not 4 years, it's 3 years. तो second year end when you're booking expense, book it accordingly. तो ये यहाँ पे ये change हो गया बस. So when I was booking in first year, I thought total wasting period 4 years, I booked accordingly. But when I come in second year, I understood now it's not 4 years, it's 3 years only. So I'll book it accordingly. Total is 3 years. I have to book 2/3. Already booked this. I have to book 2/3. Already booked is 1575. Remaining will be booked. And now remaining. The only thing is now यहाँ पे it becomes 3 years. Sir, can't I treat it as modification to ESOP? Dear, वो modification ESOP में था. This is not ESOP. This is basically SAR. And यहाँ पे anyways remeasurement happens. So now you know 3 years ही है. Second year end में you understood. So when you're booking second year expense only, that time only you book based on 3 years total period. So 2/3 should have been booked. Already booked, you deduct. Remaining you book it right now. So check out, note. This all ICI book doesn't have it. Our material only has it. As at 31st March 3, wasting period is reduced to 3 years. It will be treated as variation in wasting period. While booking expense on 31st March 3, we use the latest information, so we take 3 years. We cannot account it like modification because we don't have a fair value of modified option, fair value of original option today. And modification accounting comes under ESOP. This is anyways SAR where we have to remeasure the liability every year. Clear che? Okay, next is basically your when entity has a choice of settlement. Once this chapter gets over, again we'll take a break, don't worry. This chapter over, we'll take a break, then we'll do business combination. Okay, when entity has a choice of settlement. Now see, what happens is, sometimes whether they want shares, whether they want cash, option is given. Okay, so if entity can choose the settlement, okay, if company decides whether to give shares or cash, if I want to give shares, I can give shares. If I want to give cash, I can give cash. If it is with me, the whole award either will be equity settled or cash settled based on what I am thinking. If entity means the company. If company has a choice of settlement, I know I don't want to dilute equity. I know I'm going to give cash only, so treat it as cash settled only. But if I know I have a cash crisis, I'll be going for shares only, then treat it as equity settled. So whenever entity has a choice of settlement, company has a choice of settlement, not the other person. The company has a choice of settlement, the whole award either is equity settled or cash settled, accounting on what you want to do, what you plan to do. Achha sir, अलग हो गया बाद में, वो डिफरेंट, I'll come to that later. So now an entity has a choice of settlement. ठीक है? Come to question number 19. Okay, let me just take the theory later and then I'll come back to 19th. Let me take the theory and then I'll come back to 19, 19, 20. इसमें वो कहाँ गया दूसरी theory? There'll be some more theory. Where is the theory? Achha, here. That was entity. Okay. Now, when counterparty has a choice of settlement, the other party. So normally what happens is entity will not have a choice of settlement. If entity has a choice of settlement, they have to account either fully as cash settled or fully as equity settled, depending on what they plan to do. Okay. But when counterparty has a choice of settlement, other party. Now, whether other party will go for shares, whether other party will go for cash, I don't know. I don't know and I can't predict that. वो other party, उसके mind में क्या है, I don't know. So then in that case, when other party has a choice of settlement, it is treated as a compound instrument. It is treated as a compound instrument. I need to bifurcate liability component, equity component. Now, how do I bifurcate? Okay, if alternative is given to other than employee, if it is not employee, other than employee, the goods and services are received. He may take shares, he may go for cash, anything. So other than employee हो गया. So goods or services coming in, fair value of goods or services. Goods or services coming in, fair value of goods or services. ठीक है? And if he goes for cash, what cash is to be paid? Difference will be the equity component. So in that case, PP को debit करो, fair value of PP. Liability is the fair value of liability, cash to be paid, and balancing becomes SBPR. Now, I don't know whether it will go for cash or shares. This will be later on decided. Later on, if he goes for cash, SBPL will be paid. Later on, if he goes for cash, SBPL will be paid. And SBPR will be transferred to retained earnings, not required. Achha, if he goes for shares, later on, if he goes for shares, so SBPL also convert into capital, SBPR also convert into capital. So if he goes for cash, cash will be paid, this will be transferred to retained earning. But if he goes for shares, both SBPL, SBPR will get converted into capital, securities premium. Okay? Okay, so this is other than employee. But if it is employee, Achha, if it is employee, what do we do? So I don't have that fair value of goods or services, wo hai nahi. So if it is employee, what do we do? Then if counterparty has a choice of settlement, counterparty is an employee. So what do we do? Day one, grant date. Grant date ko determine the fair value of option if he goes for cash settlement. And same way determine the fair value of option if he goes for shares wala settlement. Generally, fair value of option under share settlement will be more. So why? Reason, if he goes for shares, I'll give him some more shares. If you want cash, I'll give you cash for 10,000 share. But if you want shares, I'll give you 12,000 share. So cash chahiye, so I'll give you cash related to 10,000 share. But if you want shares, I'll give you shares related to 12,000. And but wo shares mein thoda lock in hoga. You can't sell it for certain years. So on day one, so if it is given to employees on grant date, measure the fair value on the assumption if all of them go for cash settlement, all of them go for equity settlement. So grant date ko fair value under cash settlement you find, fair value under equity settlement you find. And I told you fair value under equity settlement will be more. So whatever is fair value under cash settlement, that becomes your SBPL liability. वो liability हो गया आपका. And extra fair value coming under equity settlement, extra fair value coming under equity settlement, that will be the equity component if he goes for shares. ठीक है. So day one, assuming if he goes for cash based on fair value on grant date कितना आ रहा है, and if he goes for shares based on grant date's fair value कितना आ रहा है, cash wala treat it as liability component, extra coming under share settlement will be the equity component. Liability component will be accounted like SAR, equity component will be accounted like SBPR. हाँ, तो वो ऑप्शंस की तरह, that is your options की तरह it will be accounted. तो under SAR cash component that will be remeasured, under ESOP that will not be remeasured, the equity component. Check the question over here. Last में what happens, I'll come to that. So check this question. 1st January, you gave an option to KMP, either take cash equivalent to 1000 share. If he wants cash, it will be based on 1000 share, or you can take 1500 shares. If you want shares, I'll give you 1500 shares. So can I say here's an option? And see, I don't know what he will do. That will be known after 3 years. So on counterparty, questions will always be on counterparty. Entity as a choice of settlement, fully cash settled or fully equity settled based on what company plans to do. But a counterparty, what he will do, I don't know. That's why compound financial instrument. It's accounted like compound instrument. Okay, so now minimum service is 2 years required, and shares you have to keep it for 3 years. So if you go for shares, you have to keep it for 3 years. Restriction आएगा उस पे. ठीक है. Now fair value of share with restriction and grant date fair value. See, if you are going for cash, वो restriction आने वाला नहीं है. So now, what is the fair value of option on grant date? Assuming you'll go for cash. 1000 into 113. If you are going to go for cash, 1000 into 113. 113. Achha, if you go for shares, 1500, and this shares have a fair value not 113, restriction wale 102. So 1500 into 102, this is coming 153. Did you got 153? Okay, so if they go for cash, grant date ka fair value will become total 113. If they go for shares, grant date ka fair value is becoming 153. So 113 you account it like SAR, extra 40 you account it like ESOP. So check over here. Okay, question number 19, the liability component. Liability component is 113 coming, equity component, the extra amount 153 minus 113, 40,000. This 113 accounted like SAR, this 40,000 accounted like ESOP, not to be remeasured. Acha, to ab now we account for liability component, 1000 SAR is there. Acha, now wo 113 was on grant date. अब तो remeasure करना है. हाँ, तो for determining equity component, liability component, I consider the fair values on grant date. Now when I'm booking, liability component is to be remeasured. यहाँ पे 120, 132 it's taken remeasured. And equity component, basically it's not to be remeasured. That 40,000, book it over 2 years, 20 and 20. Now total expense to be booked under liability component this, equity component this is a total expense to be booked. First year, second year. Okay, the first year we're booking 80, second year we're booking 92, 80 and 92 booked. Okay. Liability component goes to SBPL, equity component goes to SBPR. So now we have a SBPL also, we have SBPR also. Now what if they go for cash? If they go for cash, SBPL is paid. Okay, if they opt for cash, SBPL to bank. Now what happens to SBPR? ये SBPR का क्या करे? SBPR is not required, transfer it to retained earning 40,000. So it's transferred to retained earning. So as employees, a choice of settlement on grant date, we do not know what they will do. We cannot account completely as liability or completely as equity. We are accounting as compound instrument. Okay? Now, someone asked me, sir, what if employee would have gone for shares? If employee would have gone for shares, what do we do? See, part was liability, part was equity. Fully equity tha hi nahi. And liability was remeasured. Remeasured kar karke, the liability is 132. And equity mein we had 40. The total we are having 132 plus 40, both. So 132, transfer it to capital securities premium. This 40 also, transfer it to capital securities premium, both. So if employee had a choice of shares, if goes for shares, so that SBPL is converted into capital securities premium. SBPR converted to also, they also go in securities premium. Old ICAI material. Old ICAI material, this SBPR ka balance, they were taking it in retained earning. New ICAI material, if they go for shares, If they are going for share, SBPL as well as SBPR, both are converted into equity share capital or securities premium. The old syllabus ICI book, they were crediting retained earning instead of securities premium, which was wrong. वो गलत ही था, this is correct. अच्छा, तो if they go for cash, SBPL paid, SBPR converted to retained earning, reversed. If they go for shares, SBPL, SBPR, both equity share capital, securities premium. Is it clear this point? Is it clear this point? Okay, next question is actually similar. 20th one, I'm not doing it. Going ahead to the next one, cancellation and settlement. Okay, now what if your ESOPs are cancelled in between? Okay, if you cancel the ESOP, it's treated as accelerated vesting. I repeat, if you cancel your ESOP, it's treated as what? Accelerated vesting. The remaining expense, you book it immediately. So cancel kiya to bhi, remaining expense, you book it immediately. And when you cancel, can I say you'll pay something? Upon cancellation, some payment will come. Okay. So you have booked the remaining expense right now. So you booked something in first year, now second year, you cancelled, all remaining expense booked in second year. Okay. Now upon cancellation, you are paying something. So what do we do? Pay attention. Whatever amount is paid up till the fair value of option on the date of cancellation. Whatever you pay up to the fair value of option on the date of cancellation today. आज जितना fair value है, that much you are paying, that much you debit to SBPR because you had credited SBPR. Extra you take it in P&L. So even though SBPR balance is there, whatever you pay till the fair value on the date of cancellation, whatever is fair value on the date of cancellation, that much you debit to SBPR, extra will go to P&L. To check. So you should account for cancellation as an accelerated vesting. The remaining amount is booked immediately. Any payment which you are making to them is debited to SBPR to the extent of fair value of option on the date of cancellation. Extra payment recognized as expense immediately. Acha, if it's a liability, if it's not equity, it's a liability, so on the date of cancellation, remeasure liability. And whatever is fair value on the date of cancellation, that much you pay, debited to SBPL, extra you pay goes in P&L. We remeasured it, we brought to today's value. If I pay that much debited to liability. If I pay more, extra will go directly to P&L. If I pay less, the remaining amount of liability no longer required, it will get reversed, that will also go in P&L. Clear? Okay, check the solution. We have question number 22. Question 22. 2000 share options were given to 10 directors and they had to stay for 3 years. The fair value estimated was 130 on day 1. And number of directors which we were expecting they will fulfill the criteria is 8. Second year mein, the management decided to cancel it. Management decided to cancel and fair value at the time of cancellation is 90. The fair value of option when we are cancelling is 90. Compensation was paid to 9 directors. Now coming to first of all the expense booked. Okay, now pay attention. As per Ind AS 102 on share-based payment, at the time of cancellation or settlement, the unamortized value of option is to be booked immediately. Now we are booking over how many years? 2 years. Okay, first year may we book based on how many you are expecting? 8. 8 will remain. So 8 directors into basically amount. We were booking over 3 years. Initially it was 3 years. So this is already booked 693333. Second year when I come, understand I have to pay to not 8, I have to pay to 9. Ye 9 ho gaya. And it wastes immediately. So now total wasting period is not 3 years. Now it become 2. As options are cancelled, all remaining has to be booked right now only. So now my total expense 2340 already booked is 69. So 1646 I'm booking right now. Okay, now total in my SBPR. So first year I booked this much, remaining I booked in second year. Total in my SBPR is 2340. Total in my SBPR is 2340. Okay, now I'm making payment. To 9 directors I'm paying 95 rupee. Okay, check, question is already given you. Fair value is 90. we are paying them, agreed to pay 95. Market price कुछ काम का नहीं है. Fair value of option today is 90. We are paying them 95. Okay, you are paying them 95. तो 9 directors को 95 you are paying. 9 directors into 2000 option into 95. 1710. Okay, you paid 95. What is the fair value on the date of cancellation? What is fair value on the date of cancellation? 90. So even though you paid 95, 90 is debited to SBPR. So yeah, 90 is debited to SBPR. Extra 5 rupees recognized in PNL. Sir, I have a SBPR balance now still. Whatever they're telling, do it that way. So first of all, whatever was the remaining expense is booked immediately in second year. Remaining all is booked in second year. Now up to the fair value on the date of cancellation, 90 is debited to SBPR. Extra 5 went in PNL. Now in our SBPR there was 2340. Out of 2340 only 1620 has gone. Remaining 720 is still there in SBPR, no longer required. That you transfer to retained earning. So 720 will go to retained earnings. Did you understood? This was cancellation. Only one question is there, a good one. Okay, next one is ESPP. Next one, employee stock purchase plan. Under ESPP, the shares are issued to employees right now. Under ESPP, the shares are issued to employees right now only, but at a discounted price. As the shares are issued right now, there's nothing called SBPR. We are giving right now. The entry is done whenever that shares are issued directly to bank debit. We gave them a discount. The employee benefit expense debit, bank debit, employee benefit expense debit, to equity share capital, to securities premium. Okay, now pay attention. Group share based payment plan. Group share based payment plan. Five more minutes, then we are taking a break. 5 more minutes, then we have a break, then we'll go to the next chapter. One more chapter we'll do, business combination. CFS we will not be able to do today. Kal karenge, don't worry. And if time shortage comes, I'll extend the timings. Okay, now coming to group share based payment plan, what happens is, imagine you receive goods and services, your parent is paying. I am receiving goods or service, my parent is giving their shares, or parent is giving cash based on the price of shares. So that's group share based payment. Now, how do I account under group share based payment plan? Pay attention. First of all, each party has to see. You as well as parent, you are receiving goods or services, expense comes in your book. You are receiving goods or services, the goods and expenses comes in your book. Parent is giving shares, so in parent's book there will be SBPR coming. Now, whether it's a equity settled or a cash settled, you have to see yours. आप ये देखो, if you are giving your own share or you don't have an obligation to settle. If you are giving your own share or you don't have an obligation to settle, for you it is equity settled. तो आपको ये देखना है what you are doing. Are you giving your share? Or if I don't have an obligation to settle, then for me it is equity settled. ठीक है. Okay, the entity receiving goods or services, when you are getting goods or services, for you, whether it's equity settled or not, so you need to see whether you are giving own shares or you have a no obligation to settle. That you need to check out. Now, if imagine parent issues shares, if parent is issuing shares for share based payment of subsidiary, the subsidiary gets goods or services, then subsidiary's book expense comes. This subsidiary ki book mein expense is coming, but parent is giving shares. So SBPR will come in parent's book. Now if parent pays for you, it's treated as parent is investing in subsidiary. If parent pays for you, it's treated as additional investment by parent in subsidiary. So आपने expense debit किया, parent has credited SBPR. Now parent will treat it as investment in subsidiary, because see, you're not going to pay. If you're going to pay money, so I can't write over here, यहाँ पे I write to parent, they write subsidiary debit. See, they cannot debit subsidiary because it's not to be paid by us. They are paying on our behalf and we'll never pay back. वापस नहीं देने वाले. It's treated as investment in subsidiary. So they will write it as investment in subsidiary, will write it as capital contributed by parent. In your SFS, In your SFS, this investment in subsidiary appears under investment. Capital contributed by parent comes under other equity. CFS mein it gets knocked off. CFS mein it gets knocked off. So subsidiary getting goods or service expense comes there. Parent is giving shares, SBPR comes there. Now parent pays for subsidiary, it's treated as investment in subsidiary. ठीक है. Now suppose subsidiary is giving shares for services received by parent. If parent is getting goods or services, expense comes in parent. Subsidiary paying, so SBPR comes in subsidiary. Now subsidiary paying for parent, I cannot say subsidiary invested in parent. Parent paid for subsidiary, parent invested in subsidiary. Subsidiary paid for parent, assume it's a dividend paid to parent. They've already invested with us, so now we are paying dividend to them. Okay, so subsidiary paying for parent, it's treated as dividend paid to parent. So SBPR यहाँ पे create हुआ, dividend paid, यहाँ पे it's dividend received. Dividend paid, it's kind of appropriation, comes directly in other equity. A dividend received will be income coming in P&L. In SFS, CFS mein this will get knocked off. If parent pays for subsidiary, treated as investment in subsidiary. Subsidiary pays for parent, it's treated as dividend paid to them. Did you understood? Okay, going to question number 25. A parent grants 200 share option, 200 employee. Parent grants 200 employee of its subsidiary. Acha, so parent is paying. So expense comes in subsidiary's book. Parent is paying, so SBPR will be in parent's book. Acha, fair value is 30. You estimate 80% employee will complete 2 years, and at the end actually 81. And parent does not require subsidiary to pay for this. We don't want subsidiary to pay for this. That's why we'll treat it as investment in subsidiary. Give journal entry. Question number is which one? 25. Pay attention. Question number is 25. Okay, check over here. Check over here in your question number 25. Okay, the number of options expected to waste. First it was 80 employees. Actually it became 81. This is the fair value of option, not to be remeasured. It's equity settled. Total estimated expense to be booked over 2 years, 1/2 yahan pe, so this is the expense. Now what will be the entry in the books of parent? Okay, subsidiary will book a expense. Parent is to give shares, so parent will credit SBPR. And would I be getting money from subsidiary? No. If I'll be getting money, I'll debit subsidiary, but I'm not getting anything, so it is investment in subsidiary. So parent will write investment in subsidiary to SBPR, investment in subsidiary to SBPR. SBPR gets converted into capital. Subsidiary will write what? Employee benefit expense. They will book expense to capital contributed by parent. Expense to capital contributed by parent. Did you understood? This was question number 25. Going to 26th also. Going to question number 26. A parent company P grants 30 shares. 100 employees. 30 shares, 100 employees. They have to stay for 3 years. They have to stay for 3 years. Year 1 and 2, it's expected all employees will remain. And actually none is left. All have remained. Okay. The fair value of option on grant date is ₹5. What is the fair value of option on grant date? ₹5. It will not be remeasured, equity settled. S agrees to reimburse P over the term 75% of the expense. Acha. So 75% the expense over the term they are reimbursing. Acha. So now tell me, if parent is paying for subsidiary, but 75% I'll get, for remaining 25% investment in subsidiary will be there. For remaining 25% investment in subsidiary will be there. So check out over here, question 26. Your total estimated expense, 100 employees, 30 option, ₹5, 15,000. And employees are remaining same every year, so you can book it on SLM basis 5,000 every year. You can book it SLM basis 5,000 every year. Employees are remaining same, that's why. Okay, so out of 5,000 every year, over the term means every year they are paying 75%, 75%, 5,000 ka 75%. So 3750 I'll get it. 3750 I'll get it. So now in parent's book, bank debit 3750, investment in subsidiary is 1250 and 2 SBPR is 5000. So bank debit 3750, investment in subsidiary 1250, to SBPR is 5000. Every year same entry will come, and after 3 years SBPR gets converted into capital. Now in subsidiaries book, expense is 5000. We paid 3750 and capital contributed by parent will be 1250. Did you understood this? Okay, last point over here is accounting for reload feature. Now what is this reload feature? We have granted some option. If employees can exercise that option, employee has to pay the exercise price. Okay, for the exercise price rather than cash, they are giving us the shares of company only. The employees already had certain shares. Employee already had our shares. These are options given to them. For the exercise price, they are paying not by cash but by the shares of company. So whenever the exercise price is met by the shares, they give me the shares of my company only, then automatically they will be entitled for that much new options. That's called reload feature. So reload feature is a feature that provides an automatic grant of additional shares whenever the option holder exercises the previously granted option using entity's share. So they had to pay me exercise price. Rather than giving cash, they are giving me my shares only. So whatever shares they have given me, that much they will get automatically new option. That's a reload feature. So how to account? That is treated as a separate option altogether. So reload feature shall be accounted like a new option only. This is your chapter of Ind AS 102, share-based payment. Any doubts? Anybody? Any doubts? Anybody? Okay, again we take a break. So now we are taking a break, 15 more minutes. It's 9 hours 5 minutes. It is 9 hours 5 minutes. We are meeting back at 9:20. It's 9 hours 5 minutes. We are meeting back at 9:20 and we'll finish one more chapter, business combination. Just a minute. We are meeting back at 9:20 p.m. Okay, so we are done till now. Introduction, Ind AS 1, Schedule 3, Ind AS 102. And now we have to do Ind AS 103, that's business combination. After the break, see you at 9:20. Enjoy your break. Okay, hi, welcome back. We finished Introduction to Ind AS, Ind AS 1, Schedule 3 and Ind AS 102. One more standard to be done. We are doing one chapter, that's your business combination, Ind AS 103. So consolidated financial statement, we are not able to do today, we'll do it tomorrow. Don't worry about it. Again, just one more thing. I want feedback from all of you regarding this marathon, how you are enjoying it. Please keep on writing. The more you keep on writing, more you will love the lectures. Pay attention. Let's move ahead. Okay, Bhaskar is telling, sir, please do marathon for CA Inter Advanced Account. Dear, this year for CA Inter, it's not possible, but definitely I'll try for that next November batch. Because today is 23rd, 24th, 25, 26 is already CA final. Now, coming to chapter of business combination, chapter number 12, keep your books open. Okay. Now, what do you mean by the word business combination? It's a transaction in which acquirer obtains control over another business. Okay, acquirer obtains what? Control over what? Another business. Another business kiska? Acquiry. So we are getting control. Now control comes basically by way of two ways. One, you acquire their assets and liabilities, or you acquire equity interest, significant equity interest. If I acquire more than 50%, generally, I'm not exactly meaning 50% right now, but imagine I acquired 60% in B Limited. Can I say I'll have a control over B Limited? So one is you acquire their assets and liabilities, that entity is shut down, that way it comes. Second is by way of acquiring a significant equity interest. Okay. Now whenever you are acquiring net asset, under AS it was accounted under AS 14, and when you are acquiring a significant equity interest, that's becoming a subsidiary of yours, it was accounted as per AS 21 under your AS, but here both are covered under Ind AS 103, both are said to be business combination because you are getting control over another business. Okay. Now, if it becomes a subsidiary, accounting will not be done as per 103, we'll have Ind AS 110 which is on consolidated financial statement, but both are covered under the term business combination. Now control can come how? Okay, I'm acquiring net assets or I'm acquiring significant equity interest, but I have to pay something. Either I give cash, or I issue equity shares, or I issue debentures kind of thing, or by more than one type of consideration, or it can be without consideration also. Oh, so I get control without consideration? Possible. How? It is covered later. So don't think about it right now. Now the word written was acquirer obtains control over another business. Okay, so for a business combination, the another entity which you're acquiring, wo business hona chahiye. That has to be a business. Now, what do you mean by the word business? The business is an integrated set of activities and asset. It's an integrated set of activities and asset capable of being conducted and managed. Okay, activities are conducted, assets are managed. So it's an integrated set of activities and assets capable of being conducted and managed for the purpose of providing goods or services to customer, or for generating investment income, or for generating other income from ordinary activity. So some activities, assets capable of being conducted, managed so as to generate income from ordinary activity. And business will generally consist of input, processes, output. So input, process applied to output that have a ability to create, a process applied to that input that have a ability to create output. Now see the word written. So as per your Ind AS 103, business consists of input and processes applied to those input which have a ability to create output. Means as of today output is not mandatory. As of today you need what? For a business, input required and you need substantive process. So at minimum, input required, substantive process required. If output is there today, well and good. If it's not there today, chalega. Okay, fine. Moving ahead. The word substantive process is okay, not much relevant. Okay, the input, process, output. At minimum, you need input and you need a substantive process. Acha, let me just take the word substantive process. Substantive process means what? Substantive process means what? Chalo, we say process substantive. So suppose today output is not there. If today the output is not there, the process is said to be substantive if it is critical to develop or to convert the input into output. The process is critical. If output is not there, process is critical to develop the output. And two things, and the input are both organized workforce and other input. So input is including the organized workforce. Achha, if already output is there today, when do I say the process is substantive? The process is critical to continue the output. Achha, यहाँ पे word लिखा था to develop the output. Here the word written is to continue the output, and your input includes your organized workforce. Or यहाँ पे there's a or written. So when do I say it is basically a substantive process? So we say that it significantly contributes to ability to continue producing output, and it is scarce, unique. The process is kind of unique or scarce and cannot be replaced without significant cost. Then also we say it is a substantive process. Simple words me, if output is not there today, the process is critical to create the output. An input consists of organized workforce and other inputs. Okay, if output is already there today, when do I say it's a substantive process? The process is critical to continue producing the output, and input includes your organized workforce, or the process is kind of unique or scarce, cannot be replaced. Okay. Now, there's a word called concentration test. What is a concentration test? Now, I told you for a business combination, there has to be a business. Now, imagine from a business, the assets are coming. Now, total assets are worth 1,000. Just imagine, total assets are worth 1,000, but in 1,000, 950 is only building. Okay, when I acquired someone's business, वहाँ पे 1,000 rupees asset, but 1,000 में से 950 is only building. So tell me, reality में, did you purchase a business or did you purchase a building? So out of 1,000, 950 is only building. So that is called as a concentration test. It's an optional one, not mandatory. It's an optional test. If concentration test is met, it is not a business. I repeat, if concentration test is met, वो business नहीं है. अच्छा, if concentration test is not met, it may be a business. I'm not telling it is a business. If concentration test is met, it is not a business. The concentration test met, it is not a business. Okay, if concentration test is not met, it may be a business. So further assessment is required. Now, what do you mean by the word concentration test? So concentration test is met if substantially, now substantially word is not defined, we assume generally more than 90%. All of the fair value of gross asset acquired, is concentrated in a single identifiable asset. Out of total assets coming, 1,950 is building. So then we say concentration test is fulfilled. So that's basically the concentration test. So now steps for concentration test. 1, we need to find out the fair value of gross asset acquired. Whatever gross assets coming in, uska fair value. Then single asset, identifiable one, that is how much. If single asset constitutes a substantial portion of fair value of gross asset, then this is satisfied. Now, how do I find out the gross asset? Okay, now to find gross asset, what they're telling. See, whatever you are paid plus the fair value of NCI. Whatever I paid plus fair value of NCI, and if I already had something, uska bhi fair value. Okay, the amount paid right now plus the fair value of NCI plus the fair value of equity interest held, that's the full value of business. Asset and liability, but I want only gross asset. So that is assets and liability. I want only gross asset, add back liability. So वो net asset था, liabilities have been deducted. I want only gross asset, add back the liability. The fair value of consideration transferred, what you are paying right now, plus उसके अंदर NCI का fair value plus the fair value of previous equity interest held. Now that is net assets. Okay, I bought 60% right now. 20 I already had and 20 is NCI. So 60% के लिए I paid this, 20 NCI का fair value this, and 20 already I had उसका fair value this. So total that is your gross asset. That is your net asset. उसमें liabilities deduct हो गया, it's business का value. Add back liability. So now if I do A plus B, that is a gross asset. Now they are telling usme don't include cash and cash equivalent, don't include DTA and goodwill arising from DTL. goodwill arising from DTL is not to be considered. So if there's a DTL, there's simple option. If you consider DTL as a liability, तो goodwill arising from DTL have to remove. तो यहाँ पे you consider basically liability में DTL added back. तो यहाँ पे because of DTL what happens? I took a liability, net asset goes down, PC is same, goodwill goes up. So here if you consider DTL as a liability, यहाँ पे goodwill on DTL will come up, that was to be deducted. तो यहाँ पे add किया, यहाँ पे deduct, और ignore DTL while calculation. So don't take DTL as liability. If you're not taking DTL as liability, goodwill on DTL will not come only. So either if you're taking DTL in step 2, in step 3, goodwill from DTL is to be deducted, same amount. If you're not taking DTL in step 2, nothing to be done in step 3 also. ठीक है. So this was your gross, basically your net asset. Add back liability, it becomes your gross asset. Remove cash and cash equivalent DTA. I'll not take DTL under liability only, the goodwill from DTL not to be deducted. Okay, check this example given. Entity A holds 20% in B. You already hold 20. You acquire further 50% by paying 300 crore. ठीक है. Okay, building, cash and cash equivalent, financial liability, DTL. Don't consider DTL as liability in step 2. So goodwill from DTL, step 3 में nothing to be done. Fair value of entity B is 400 crore. NCI is 30%, 120. And fair value of previous equity interest is 20%. अच्छा, तो for current 50%, I'm paying 300 crore. Okay, already 20% I had, it was 80. Plus NCI 30% is 120. Okay, so 300 plus 120 plus 80 for all 100%, entire business, 300 plus 80 plus 120, can I say it becomes 500? Okay, that 500 is for entire business, assets, liability, both. Add back liability. I want gross asset, so I add back only 800. So ये 500 था, I'll add back the liability 800, total will become 5800. ठीक है. अब assets में cash DTA not to be taken, cash 200 I'll remove. Okay, so gross asset becomes 1100. 500 plus 800 minus 200. अच्छा, out of 1100, can I say 1000 rupees building? Out of 1100, 1000 rupee तो building है. So gross asset coming in is 1100, उसमें building is basically 1000, 91%, I say it's substantial. So actually, out of the total gross assets coming, substantially all of that is concentrated in only one thing, building. So it's actually not a business acquisition, it's kind of a building acquisition. So concentration test is met, it is not a business combination. Any doubts? Anybody with this? Any doubts? Anybody with this? Keep replying. Any doubts are there? Ask it. Okay, now what is not covered under 103? What is not covered under 103? This accounting standard does not apply to joint arrangement. Whenever there is joint control, it comes under Ind AS 111. The joint arrangements are not covered. And number 2, if at all you are acquiring something which is not a business, like just now we saw, concentrated in a building, so it's not a business combination, it's an asset acquisition. Accounting will not be as per 103. Okay, question number 1 was whether it's a business combination or not. Simple question, not important. I'm just taking important questions in class. Okay, question 2 is also fine, nothing much. 3 also fine. 4 also fine, not important. Okay, the next point, if it is a business combination, if it is not a business combination, accounting is not covered over here, it's just an asset acquisition. Whichever asset you are acquiring, that Ind AS will be applicable. If you are acquiring a PP, so PP wala Ind AS 16 will get applicable. If you are acquiring an intangible asset, Ind AS 38 will be applicable. If it's a business combination, it falls here. Acha, if it's a business combination, it's accounted using acquisition method. Acha, under acquisition method, 1, we need to identify the acquirer. We need to determine the acquisition date. Okay, then we need to recognize assets, liabilities. Then we also have to have the NCI, non-controlling interest. That all will be kind of recognized, and we also have to find out goodwill or gain on bargain purchase. So identify acquirer, determine acquisition date, recognize, measure the identifiable assets acquired, the liabilities assumed, non-controlling interest, and lastly you measure goodwill or gain on bargain purchase. Now, how do I identify the acquirer? Acquirer is an entity that obtains control over another entity. Acquirer is an entity that obtains what? Control over another entity. Now, how do I determine control? किसको control बोलते हैं? तो Ind AS 110 has given a definition of control. Ind AS 110 has given a definition of control. So they say investor controls investee if and only if all the conditions are fulfilled. Investor controls investee if and only if all the conditions are fulfilled. Which are the conditions? One, you have a power over investee. You have a power. Right, basically you're able to take decisions unilaterally. If I'm able to take the decisions unilaterally, I have a power. You have exposure or right to variable return from your investment with the investee. So you have exposure or a right to variable return from your involvement with the investee, and you can use your power to affect the amount of return. Okay, so one, you have power over investee. Two, exposure or right to variable return, and you can use your power to influence the return. Now, did they say anywhere you hold more than 50%? No. So over here under your Ind AS, you may have a power by holding less than 50% also. You hold 45%, decisions are taken in a meeting, others are small shareholders, they don't come in a meeting. Others are small thousands, lakhs of shareholders. They are not coming in a meeting. So whenever in a meeting is there, you hold 45%, majority, meeting में those who are present, उसमें you have majority, you are able to take the decisions whichever you want. So sometimes with 45% also you may have a power over investee, you have a right or exposure to variable return, and you can use your power to influence return. All three criteria satisfied. So under Ind AS, even with that 45% also you may have a control. ठीक है. Now, acquisition through payment of cash. Okay, if you are acquiring by paying cash, the party paying cash will be the acquirer. So it is usually the party which pays cash. Okay, acquisition through equity share. So generally the party which issues equity share. Okay, so I take over your business, I'm giving you equity share. The party which issues equity shares will be the acquirer, but there's also a concept called reverse acquisition which will come up later. Now, this is important. As per Ind AS 103, facts and circumstances shall be considered in identifying acquirer. As per Ind AS 103, some facts and circumstances are to be considered when you're determining acquirer, and that includes one, the relative voting right in the combined entity. In a combined entity, who has a majority voting power? So usually the one which has a majority voting power, that is the acquirer. A Limited, B Limited are combining. But now in AB Limited, A Limited shareholder holds 60%. So in AB Limited, A Limited shareholders are holding 60%. So effectively, it's not A and B acquired by AB, it is A Limited acquiring B Limited. ठीक है. So usually the combining entity whose owners receive the largest portion of voting right. अच्छा, existence of large minority. अच्छा, if none of the owner are having a significant voting right, तो who is the largest minority? किसके पास largest minority है? अच्छा, who controls the composition of governing body? Who controls the composition of senior management? So acquirer is an entity which controls, who is able to appoint that senior management, who is able to appoint the composition, who is able to control that composition of board members. Achha, terms of exchange. Acquirer is someone who will generally pay premium. Okay, I pay extra. The acquirer is usually the one who pays premium. An acquirer is usually the one who is bigger in size. The bada hoga, generally the one bigger one is basically acquiring a smaller one. The usually, that's why everywhere the word usually is written. Clear? So certain facts and circumstances are considered while determining basically the acquirer, and this is important. Now moving ahead, question number 5 is fine. Going to question number 6. Sixth as such is easy, but just pay attention. Okay, ABC Limited incorporated a company Super Limited to acquire 100% shares of Focus. Okay, so ABC has incorporated Super to acquire 100% shares of Focus. Super took a loan from bank. The loan fund are used by Super to acquire the Focus. The Super has acquired Focus by taking a loan. Post the acquisition, Super has the ability to elect, appoint, remove majority of the members of governing body. So can I say Super has a ability to elect, appoint, remove majority of governing body of Focus? The Super has a control over Focus. Okay, who is the acquirer? Answer is Super. Now, important was not that. Everybody knew answer, but how to write the answer? How to write the answer? So, as per Ind AS 103, we are required to identify the acquirer. Acquirer is an entity that obtains control over another entity, and for that, Ind AS 103 has given certain facts and circumstances which are to be considered for determining acquirer. So, you have written all that facts and circumstances. And then you say Super has ability to elect or remove, appoint majority of the members of governing body, and that's why Super will be identified as acquirer. Did you understood? Okay, that was acquirer. There can be a concept of reverse acquisition, which I'll come to it later. Now coming to acquisition date. Okay, we'll finish it by 10:30. This chapter we need to finish today. Okay, coming to acquisition date. Acquisition date is a date on which acquirer obtains control over acquiree. It's a date on which when you obtain control over acquiree, it is generally the date when you pay consideration. When I pay consideration, I'll get control over you. But it may be before or after also. So generally it's the date when you are paying consideration, when you legally transfer the consideration, but it may be before or after also. Sometimes you got the control over assets and liabilities and you have to pay them later, or sometimes you're paid in advance but they will be giving you assets and liabilities ka control later. It may be, however, before or after also. Acha, if the agreement is subject to approval, the acquisition date cannot be before the date of approval. Now acquisition date is not approval date. Acquisition date is the date on which you get control. आपको कंट्रोल कब मिला? If it is subject to approval, it cannot be before the date of approval. ठीक है. Coming over here, come to question number 11. Okay, come to question number 11. Okay, 9th April, Shyam Limited started to negotiate with Ram. 10th May, the BOD of Shyam authorized the management to go for merger. 15th May, the management of Shyam offered to Ram 12,000 shares. 31st May, the board of director accepted the offer subject to shareholders vote. Okay, if it is subject to shareholder vote, the acquisition date cannot be before the date of shareholders approval. 2nd June, they came with a press release about a proposed merger. 10th June, the shareholder approved. Acha. Now see, I told you acquisition date cannot be before the date it's approved. वो उसके पहले नहीं हो सकता. Now approval came on 10th June doesn't mean that acquisition date is 10th June. Acquisition date is a date when you get control, and normally control will come when you pay them. 15th June, the shares were allotted. So see, okay, approval came on 10th, but I have not paid on 10th. Are they telling you got control over assets and liabilities on 10th? No. So normally when I pay them, they will give me assets and liabilities ka control. So 15 June I paid, so over here acquisition date will be 15 June. And acquisition date is important reason. 15 June I paid, so 12,000 shares I am giving, the fair value of shares on 15th June is to be taken. Fair value of shares on which date? 15th June to be taken. The acquisition date cannot be prior to 10th June, that is shareholders approval. On 10th June, shareholder approval came, but control came or not, question is silent. Generally control comes when we pay, so acquisition date is 15 June. 15 June ka price is 90, so purchase consideration will be 12,000 shares into 90. Clear? Okay, next is direct acquisition related cost. Okay, cost of acquisition, direct cost of acquisition. Now see, the direct cost of acquisition are the cost which acquirer incurs to affect the business combination, like finder's fee to find a proper target, due diligence fee, accounting fee, legal fee, etc. So These are all kind of fees which are directly related to the acquisition. As per Ind AS 103, the acquisition related costs are expensed. It will go directly to P&L. They are not put in PC. They will be going directly in P&L. Acha, now there's a stamp duty. Pay attention. We acquired someone's business. And whenever we are acquiring someone's business, assets and liabilities actually are recognized at its fair value. Assets and liabilities coming in are recognized at acquisition date fair value. Now they had a building, their building comes to us. We'll recognize building at acquisition date fair value. But now building, we need to get it registered in our name. We have to have a stamp duty paid on it. The stamp duty paid on acquisition of land coming under business combination. And normally you purchase a land debit to bank, uske related stamp duty added to cost of land normally. But land coming under business combination, the stamp duty paid, would it be added to land, or would it be treated as acquisition related cost? So see, the land coming in is already recognized at fair value on acquisition date. The land is already at fair value. Now stamp duty, if I add on it, it will be more than fair value. That's not valid. The stamp duty paid will be treated as acquisition related cost. It will be directly expensed, goes to P&L. So if it was a normal acquisition of building, if it was not this, if it was just a normal acquisition of building, whatever I paid for building to bank, stamp duty on it also added to building. But building coming under your business combination already recognized at fair value. Now stamp duty, if I add, it will be more than fair value. That will be wrong. That's why it will be treated as acquisition related cost, goes in P&L. Okay, next. Contingent consideration. Okay, contingent consideration is something which may or may not be payable. Contingent. Okay. Okay, so pay attention. Imagine I'm giving you 1 lakh shares right now. And then I say that I acquired you now. Next year, after 1 year, if the profit crosses 5 CR, I'll give you another 20,000 share. So 1 lakh share I'm giving. If now the profit crosses 5 CR, combinedly next year, my profit crosses 5 CR, I'll be giving you 20,000 more share. So can I say that 20,000 more share may be given, may not be given? It's a contingent consideration. It is what? Contingent consideration. Now, as per Ind AS 103, fair value of contingent consideration on acquisition date is included in your PC. Fair value of contingent consideration on acquisition date is included in your PC. Okay? So we include that in PC, and it may be treated as equity or it may be treated as liability. Right? It may be treated as equity or it may be treated as liability. If at all I am required to give shares dena hai, it will be treated as equity, but if I have to give cash, it will be treated as liability. And one more thing, if the shares to be allotted are fixed, then only it comes as equity. If shares to be allotted are variable, if I say that if at all profit crosses 5 crore, I'll give you shares worth rupees 50 lakhs. Okay, the number of shares to be given is not fixed. I'll give you shares worth 50 lakh. So 50 lakh divided by share price going that time. So if number of shares to be issued is variable, then also it will be treated as a liability. Okay, so as per Ind AS 32, it is equity if it satisfies both the condition. One, there is no contractual obligation to deliver cash, and the number of equity instrument to be issued is fixed. ठीक है, तो I'll include that in PC. PC में include हो गया assets coming, liability coming, something is to bank, something or contingent consideration. उसका fair value I include. If it is equity, it will not be remeasured. याद है 102. If it is contingent consideration, we included the fair value in our PC. If it is equity, classified as equity, it will not be remeasured. If it is classified as liability, it will be remeasured every year and the difference will go in your P&L. Fine. Question number 15, check out. Okay, A Limited acquires 100% in B. Purchase consideration is 10 lakh shares we are paying, giving right now, immediate issuance. 10 lakh shares, face value is 10, face value 10. And further I'll give 2 lakh shares after 1 year, or number of shares to be given is fixed. It's equity after 1 year if profit exceeds 1 crore. The fair value of shares today is 20 rupee. Fair value of shares today is how much rupee? 20. Okay, the 10 lakh shares I'm giving today only. 10 lakh into 20, it is 2 CR. Acha, extra 2 lakh shares I'll give if profit exceeds 1 crore. Fair value of contingent consideration. So don't say 2 lakh into 20. No. It will be given. The fair value of contingent consideration on acquisition date is 25 lakh. Okay, the 2 CR wo tha plus 25 lakh, that is included in your PC. Acha, and as it is equity settled, number of shares to be given is fixed. It will not be remeasured. It will not be remeasured. I have to give 2 lakh shares. That's it. Not remeasured. Okay, now after 1 year, if criteria met, I have to give 2 lakh shares. Okay, we have included the 25 lakh. वो 25 lakh लिया था fair value of contingent consideration on acquisition date. So when I was making journal entry, I did not write 2 equity shares. I write 2 SBPR. Day 1 when I acquired, so 2 crore, 2 equity share capital. Yeah, 2 crore is equity share capital, and this 25 lakh is 2 SBPR. Now, if that condition satisfied, it gets converted into equity shares. 2 lakh shares are given. So assume for this 25 lakh rupee, 2 lakh shares are given. Shares are treated as issued for 12.5. Shares are treated as issued for 12.5. Okay, same fact as one, but only thing is the number of shares to be issued are not fixed. If number of shares to be issued are not fixed, it will be treated as a liability. So to SBPR nahi hoga, it will be to SBPL. 25 lakh. Now it has to be remeasured. Okay, so I have to give variable number of shares equal to 40 lakh after 1 year. So 25 lakh becomes 40 lakh. 15 lakh ka loss goes in P&L. Now for that 40 lakh, I have to give them shares right now. And now the fair value of share is 25. The 40 lakh divided by 25. How many number of shares I have to give? 1,60,000 shares. Okay, 1,60,000 shares. So see, initial recognition 225 is PC. Subsequent first case mein it is classified as equity. It is not remeasured. 25 remains 25. Now 2 lakh shares are given for 25. Shares are treated as issued at 12.5. But under case 2, it was treated as liability. As it was treated as liability, the 25 lakh will become 40 lakh. Extra 15 lakh will go in your P&L. This 15 lakh will be recognized in P&L. Achha, now 40 lakh, I'm giving shares. One share is worth 25 today. So how many shares are to be issued? 1,60,000 shares to be issued. Is it clear? Now, purchase price allocation. So whatever purchase price I'm paying, I need to allocate to various assets and liabilities, and difference will basically become your goodwill kind of thing. Okay? So you need to measure the identifiable. Goodwill is kind of balancing unidentifiable. So identifiable assets and liabilities coming in are recognized at acquisition date fair value. Identifiable assets and liabilities coming in, they are recognized at what rate? What value? Acquisition date fair value. Difference automatically will become your goodwill. So these are assets and liabilities coming. This is paid. Difference. Goodwill. Okay. Now intangible asset. Okay, so intangible asset coming under business combination, should I record separately? If I don't record separately, its value gets subsumed in goodwill. So should I record it separately? So if it's an identifiable intangible asset, you record it separately at its acquisition date fair value. When do I say it's identifiable? If it meets any of the following criteria. 1, contractual legal criteria, that intangible asset arises out of a contract or a legal right, or it is separable. So that intangible asset is separable, capable of being sold, rented, transferred individually or with a related asset. That's called separability. So if it's an identifiable intangible, then you record it separately at its acquisition date fair value. Usko goodwill mein subsume mat karo. Don't include, you record it separately. ठीक है. Moving ahead, reacquired right. Okay. Many times what happens is the right which I had given. Imagine McDonald's India Limited gave a franchisee right to A Limited. McDonald's India Limited gave a franchisee right to A Limited to use that brand name for 10 years. Now McDonald's India acquires A Limited. So whenever I'm acquiring A Limited, the right which I had given to them is coming back to me. That's called reacquired right. So reacquired right is an identifiable intangible only. So मैंने right दिया था, So now right is coming back. Well, right is something which is basically separable. I had sold earlier. So it's a kind of acquired intangible only. So that reacquired right, can I record in my book? Answer is yes. The right coming back to me, can I record in my book? Answer is yes. So reacquired right is an identifiable intangible asset because it meets separability criteria. So you can record in your book at its acquisition date fair value based on the remaining right ka period. So measure it based on the remaining contractual term. Ignore basically the option of renewal available. See, they had a right, I had given them a right, they had a right which could have been renewed. Now if I reacquire the right comes back. Now I cannot renew to myself now. So measure it based on remaining contractual term without considering the effect of renewal. Acha. Now whenever the right is coming back, so right aaya mere paas. Now that should be now amortized over the remaining term. So I'll record in my book acquisition date fair value, amortize it over the remaining term. Now sometimes what happens is, because of me, A Limited had earned very well, so I paid less for the right. Because of me, A Limited suffered a loss, so I paid more for the right. So sometimes what happens is, because of pre-existing relationship, I have paid more or I have paid less for it. So because of that pre-existing relationship, if you have paid more, if you have paid less, that will go directly in your P&L. वो P&L में ले जाओ, that should not affect goodwill or capital reserve because that was due to pre-existing relationship. So if you are acquiring at market, no problem. But that reacquired right के लिए you are paying them more, so it was due to some pre-acquisition, basically pre-existing relationship. So extra paid you debit it in P&L, don't debit it in goodwill. So if it is at market terms, no problem, but if it is more than or less than market term, it's recognized as settlement of pre-existing relationship. Fine. Moving ahead. Okay, settlement of pre-existing relationship. Pay attention. There might be a pre-existing relationship between acquirer and acquiree. Either it can be a contractual one, debtor, creditor, lender, borrower, or it can be a non-contractual litigations going on. Okay. Now, sometimes what happens is because of business combination, the pre-existing relationships are settled. The business combination leads to settlement of pre-existing relationship. So if it is leading to a settlement of pre-existing relationship, we need to find out gain or loss. Now, wo gain or loss hai na, because of pre-existing relationship, that should not be affecting goodwill capital reserve. That should go directly in your P&L. So that's why we need to find out the gain or loss coming in due to settlement of pre-existing relationship. Imagine, I already had to pay you 100 rupee. I already had to pay you how much rupee? 100 rupee. Now I acquire your business for 1000. If I acquire your business for 1000, now I don't have to pay that 100. So actually out of 1000, 100 is towards settlement of pre-existing relationship, 900 is PC. Acha, suppose for that pre-existing relationship, I am paying you 120. So books mein liability 100, but I am paying 120. So 120 is for the settlement of pre-existing relationship. 880 is for PC. And our liability was 100, I paid 120, that extra 20 gets debited to P&L. Liability was 100, I paid 120, the extra 20 gets debited to P&L. So liability debit 100, P&L debit 20. And 880 is for PC. 880 is for PC. Are you getting it? Okay. So now, how do I find out gain or loss? How do I find out gain or loss coming due to settlement of pre-existing relationship? If it's a non-contractual lawsuit wala, based on the fair value. Based on the fair value. Okay, litigation going on. So what was the fair value of litigation? Out of 1000 I'm paying, litigation ka fair value was 100. So 100 is towards settlement of litigation, balance is towards PC. Acha, 100 is towards settlement of litigation. Okay. But in my books, provision was only 60. Provision 60, but I paid 100. So provision you reverse. So debit ho gaya 60, extra 40 P&L debit. The point is pre-existing relationship getting settled, the profit loss goes in P&L, should not be affecting goodwill or capital reserve. If it's non-contractual, it's based on fair value. If it was contractual, वो contract था. So then in that case, how do I find out the gain or loss? The amount by which the contract is favorable or unfavorable compared to current market terms, or the penal provision, उसमें से whichever is lower. Okay, the contract unfavorable by 10 rupee. Imagine the contract is unfavorable. Based on current market terms, contract unfavorable by 10 rupee. And it can be cancelled by 6 rupee. So if I pay you 10 rupee more, market rate 100 hai, I am paying you 110. So rather than paying 10 rupee more, I could have cancelled the contract by 5 rupee. Rather than paying 10 rupee more, I could have cancelled the contract by what? 5 rupee. So in that case, 5 rupee is settlement, वो loss है settlement of pre-existing relationship, not 10. तो 100 की जगह I paid you 110, but I could have cancelled by paying 5 rupee ना, तो extra 10 की जगह 5 देना, तो 5 is for settlement of pre-existing relationship related loss. दूसरा जो extra 5 you paid ना, that is for goodwill, वो goodwill हो जाएगा. The amount by which contract is favorable or unfavorable compared to the current market terms or the settlement provision, उसमें से whichever is lower. So suppose contract unfavorable by 5 lakh, settlement 2 lakh. So I took over that contract by paying 5 extra. No, you could have cancelled by only paying 2. So 2 is the loss on settlement of pre-existing relationship. You took over by paying 5 extra. The extra 3 वो goodwill है. ठीक है. Now check question number 18. Progressive Limited is being sued by Regressive Limited. RS filed a case against P. RS filed a case against P. P has recognized a liability 10 million. So P की book में liability is 10. Now P acquires R. P acquires R for 500. Now when P acquires R for 500, the litigation which R has filed also goes away. So can I say in this 500, there's something towards settlement of that litigation also. And the fair value today of the litigation is 20. Out of 500, 20 is towards litigation, 480 is towards PC. Achha, so 20 is towards litigation, 480 is towards PC. Achha, 20 towards litigation, in my book liability is only 10. Liability only 10, but 20 is towards litigation, the extra 10 will get debited in P&L. So how do you account? How do you account? So see, liability 10 goes away, P&L debit 10 to bank 20. So 20 you paid for liability. And remaining 400 is PC, 480 is PC, assets and liabilities coming, 480 paid, difference goodwill. Did you understand? Out of this 500, 20 rupees towards settlement of pre-existing relationship, so I am paying 20 for it. Achha, for 20, the liability in books is only 10, the extra 10 which I have paid will go in P&L. Achha, question number 19. ABC acquires PQR for a consideration of 1 crore. 4 years ago, I had given a license to them to operate in Europe. The cost was 250. They can terminate it. If termination is to be done, unexpired fee plus 20%. So unexpired fee is 250 into 6 by 10 plus 20%, 180. 180 mein it can be settled. ठीक है? ABC has acquired PQR under current market condition. Under current market condition. The 6-year franchisee right is 450. Now, the thing is how much I'm paying for it today is not given. How much I'm paying for this is not given. See, it's worth 450 today. If I pay them more or less due to pre-existing relationship, वो gain loss होता है. So this question में the problem is to find out gain loss. How much you are paying for it today is not given. So what did they do? What ICA has done? What ICA has done is 250 may we had given for 10 years, so 6 years. Can I say we gave it for 150 only earlier? Uska rate today is 450. So they found unfavorable by 3 lakh. Actually, I can't find unfavorable that way. 450 is today's value. If I pay them more, 450 की जगह I am paying them 8 lakh. तो वो unfavorable by 350 हो गया. But they have found unfavorable is how? We gave them 6 years at 150, 250 into 6 by 10. Today it's worth 450. So 3 lakh unfavorable. Cancel हो सकता है by 180. Whichever is lower. 180. So 180 is basically the loss due to settlement of pre-existing relationship. That 180 goes in P&L. So out of 1 crore which you have paid, उसमें से 180 is basically a loss for settlement of pre-existing relationship. So you have to debit 1 crore 80 lakh in P&L. So now assets are coming. Reacquired right coming in will record at 4.5. So check over here. minute. Okay. Now pay attention, as it is settlement of pre-existing relationship, the gain or loss on settlement will be lower of the following, which you already know. Now in this case, the unfavorable amount, I told you ICIS, you see, in order to find unfavorable amount, we need to find out amount what we are paying for reacquired right and the current value. Question doesn't tell how much we are paying. So ICIS found out loss by comparing the current market value 450 and we had given that 6 years for 150. So they found out 3 lakh and settlement is 180. So gain loss is coming loss 180. Loss on settlement of pre-existing relationship. So that 180 will be debited to PNL. 180 will be debited to PNL. Now, how do I make journal entry? How do I make journal entry? So imagine, other than this reacquired right, the net assets coming at 90. The 90 net asset debit other than reacquired right. Reacquired right, I'll record at basically the fair value and acquisition date. It's identifiable intangible. This much I have to take it in PNL. 1.8 don't forget to take in PNL. Total you paid 1 crore. Difference goes in goodwill. Now if you don't take 1.8 in PNL, that also gets merged in goodwill. That's why that 1.8 you have to take it separately in PNL so that goodwill will go down accordingly. Okay, next. Next point is about the measurement window. Laptop works slowly. That is also getting tired. Okay, now this point regarding the measurement window, this is something which was not there under AS, it came under Ind AS. Now, whenever you are recognizing assets and liabilities coming in are recognized at acquisition date fair value. But sometimes when you are recording on acquisition date, the fair values might not be available. So you might have recognized at a provisional amount. Okay, you might have recognized at a provisional amount. Now, within 1 year, if the final amount comes in, based on facts and circumstances which are already there on acquisition date, based on facts and circumstances existing on acquisition date, the fair value got determined later. If it's within 1 year, you can go back, adjust the figures, corresponding goodwill or capital reserve will also change. The acquirer shall retrospectively adjust the provisional amount recognized on acquisition date to reflect the new information which is based on facts and circumstances. That existed at the acquisition date. The corresponding effect is to be given in goodwill or capital reserve. Now sir, what if the year is already over? So next year में the previous year figures you restate. तो don't, वो year खत्म हो गया ना. As such it's within 1 year. But the financial year got over in between. So next year में the previous year figures are restated. Opposite effect, goodwill, capital reserve will also be restated. Clear? Okay, next. But this should be based on facts and circumstances which were there on acquisition date. Okay, question number 21, pay attention. ABC Limited acquires XYZ Limited on 15th January 1. One of the customer had claimed that there is some amount due under penalty clauses. Customer is claiming some amount is due under penalty clauses. And based on evaluation, you recognize 1 crore as liability. This is best estimate. अभी आपने estimate किया. ठीक है. Now, 1st October 1. अच्छा, 15th January था, ये 1st October. Within the measurement window, the customer comes out and tells it's not 1 crore, it's 2 crore. See, agreement was already there. So customer coming and telling it's new information based on facts and circumstances already there. Agreement is not changed. Okay, so 1 crore becoming 2 crore, it's basically within the measurement window. I have to change opposite effect liability is basically increased, opposite goodwill will increase. Okay. Now ABC Limited continue to receive some extra information. This evaluation doesn't change till February. Now then you conclude the fair value of liability. Fair value of liability is 1.9 crore. Acha, this is after the measurement window. After measurement window doesn't fall under this chapter now. If liability changing now, provisions changing now, that will go under your chapter of provisions in Ind AS 37. And in Ind AS 37 we don't measure the provisions in between. So this you ignore it. 1 became 2, recognized as per 103. 2 becoming 1.9 will not come as per this standard. वो Ind AS 37, and 37 doesn't take in between. वो between नहीं लेता है. Now year end it became 2.2. So 2 becoming 2.2, 0.2 provision goes up. It goes in P&L as per Ind AS 37. Okay, so this extra one, yes, it is there, but then that between it is not considered. That last में 2 becoming 2.2, it's recognized in P&L. Okay, coming to question number 22. Okay, now Bank F acquires Bank E, assets of Bank E, the loans which were given by Bank E, that comes to Bank F. So Bank F receives borrower B's financial statement for year ended September 30th. Acha, we acquired in October. Now fair value of loan to B at acquisition date is determined less. Acha, so what happened is we acquired another bank. They had given a loan to someone. Now that loan ka fair value we didn't knew, we had recorded on provisional basis. Now we got the financial of that party. That is for year ended September. Year ended September means it was already there on 1st October. And now we understand uska fair value is much lower. As uska fair value is much lower, we recorded on provisional basis. Now this fact was already prevalent on acquisition date. You can adjust it. The fact was prevalent on acquisition date. But suppose if it is not September ending, if it is in December, you get to know. In December, you get to know that borrower B has lost major customer earlier that month. So borrower B has lost customer in December only. So then in that case, that was not available on 1st October. The facts were not prevalent. Now it doesn't fall under Ind AS 103. Oh, basically it doesn't fall under measurement window concept only. Is it clear? Okay, next one, contingent payment to employee shareholder. Now employee shareholder means what? As such they are a shareholder also and they are employee also. So in acquiry, the other company which you are acquiring, they are shareholder also and they are a key managerial person. Imagine one is a director as well as a shareholder. So now there's a contingent consideration. I need to understand whether I'm paying him in capacity as a shareholder or whether I'm paying him in capacity as an employee. If I'm paying him in capacity as a shareholder, contingent consideration, something I paid right now, something I'll pay in future if profit exceeds this much. So then it's a contingent consideration. Remember, contingent consideration is included in your PC at acquisition date fair value. But if it is given in capacity as employee, then in that case, it will be accounted like your employee cost. If shares are to be given in future or payment to be done in future based on price of share, so SBPR, something like that, or SBPL, it will be covered. So then it will get covered under Ind AS 102 or Ind AS 19 employee benefit. So if it is basically in capacity as a shareholder, it becomes a contingent consideration. If it is in capacity as an employee, it will be accounted as your employee cost under your Ind AS 102 or Ind AS 19. Okay. Moving ahead. Okay, check out over here. We acquire 100% of Viva. It's owned by a single shareholder and who is also a KMP. There's a cash payment right now, 20 million. Contingent payment, how much is contingent payment? 2 million. Okay, which are the condition? EBITDA margin basically becomes this much. EBITDA margin becomes this much, and we need to understand whether he has to stay. If he has to stay, then in that case, it's basically for his employment. And the former shareholder continues to be employed. Okay, continues to be employed means it is for his employment. You should not account it under 103. It will be accounted like 102 or Ind AS 19. Okay, so not included here. Next. Question number 25. We'll complete this chapter today. It may get 15-20 minutes more late. By 11 o'clock we'll finish. Chalega. But we have to finish this chapter. Entity A acquires entity B. TK to pay 900. Additional payment 500 if subsequent earning increases specified target. He is also an employee. On acquisition date. On acquisition date, the fair value is 850 and value of additional payment ka fair value is 200. And over the next 3 years, the earnings amounting to 1050, assuming conditions are met. Assume conditions are met. Stat the impact of position X classifying payment. Now see, classifying payment as remuneration. Remuneration means incapacity as employee or as contingent consideration, incapacity as shareholder. Both are considered. Achha, if it is in capacity as a shareholder, it will be included in your PC. So PC 900 tha. If it is contingent consideration, it's included in PC. Here it's not included. Here it's not included. So ye ho gaya. And if I try to understand the impact in P&L, if it is if it is basically treated as employee cost only, fully it goes in P&L. If it was treated as basically your contingent consideration, we recorded at 200, but remeasure, it's a cash to be paid. वो cash pay करना था, remeasured and extra 300 to be paid, 500 हो गया total. So that 300 comes over here. Understandable? Okay, next, acquirer share-based payment award exchanged. Now see, A Limited acquired B. B had already given ESOPs to their employee. Now when I am acquiring, that company is no longer there. So to their employees, I'm giving now my ESOPs. That is nothing but your acquirer share-based payment award exchanged. Now whenever it is like this, the first and second year, the expense is already recognized by B. Now when I'm giving my ESOPs, so I'll record expense only for remaining 3 years. So first 2 years expense are in acquirer's book. My book may expense is only for next 3 years. But the thing is, shares which I'm giving is worth 5 years. The first 2 years ka expense not there in my book. So pre-combination period. So I need to find out the pre-combination period value, post-combination period value. Pre-combination period value will be treated as a part of PC. So PC के part में ले लेंगे, we'll write it basically to SBPR, automatically debit goodwill will happen. So pre-combination period basically goes in your part of PC. Post-combination period will be accounted over the remaining vesting period. ठीक है? Okay, so pre-combination, post-combination. This is basically two things. When you're obliged to do. When you're obliged to do, required as per agreement or required as per law. And when you're not obliged to do, everything is post-combination, pre-combination is 0. Okay, now how do I find out pre-combination, post-combination? How do I find out? Just 1 minute. It's getting hanged in between. Let me just close it once. Okay. Now coming to first of all the fair value of pre-combination period. How do I find pre-combination period? The fair value of original award today. Fair value of original award today into vesting period completed divided by total vesting period. Fair value of original award but today into vesting period completed divided by total vesting period. Total vesting period is the total vesting period under old option or total vesting period under new option, whichever is higher. So total vesting period under the old option or total vesting period under replaced option, whichever is higher will be taken here. Okay, and how do I find post combination period? So what is the fair value of the replaced option, the new one which I am giving, minus pre-combination. The fair value of replaced option today, उसमें से pre कितना था वो निकाल दो, remaining is post combination. Pre-combination will include it as a part of PC. The first 2 years expense basically were booked in acquiree's book. Third, fourth, fifth year will come in my book. So how do I bring that first 2 years? Part of PC में ले लेंगे. So pre-combination period is included as part of PC. I'll credit to SBPR. Automatically effect will come in goodwill. Post-combination I'll record it over the remaining vesting period. ठीक है, तो check. Okay, check question number 26. Green Limited acquires pollution as a part of arrangement. Green had to replace the pollution limited existing equity. Green had to replace. So can I say it is obliged? TK. Original award basically 5 years, 2 years are already completed. Out of 5, 2 are already completed. Under replacement award, the wasting period is reduced to 2 more years. अच्छा तो original में total wasting period 5 था. Replacement 2 plus 2 more, it is 4. So I have to take 5 or 4 whichever is higher. I have to take 5 or 4 whichever is higher. So 5 I need to take. Now original award, the fair value today. Original award fair value today 500 into wasting period completed 2 divided by total wasting period 5. So 500 into 2 by 5, 200 is pre-combination period. Acha, fair value of replaced option 600, 600 minus pre-combination 200, 400 is post-combination. So pre-combination period 200, I'll include it as a part of PC. Post-combination period is 400. Post-combination kitna hai? 400, which will be amortized as an expense over next 2 years. Did you got it? Any doubts? Question 26. Okay, next one is a non-replacement award. Now see, non-replacement award happens when you get a control. When you're getting a control by acquiring equity interest. Okay, I acquired 80% in B. If I acquired 80% in B, I got control over B. But can I say B is still in existence? B is there in existence. So B can continue their ESOPs. So non-replacement. So the thing is, B became my subsidiary. They had given ESOPs to their employees. That continues. They had given ESOPs to their employees. That continues. But the problem is, in B's book, in acquiree's book, first 2 years expense they have booked. It is shown as SBPR. Now the thing is, we include their assets and liabilities, not their SBPR. Third, fourth, fifth year they will book, it will come in CFS. So first and second year B Limited has booked some expense. Third, fourth, fifth year, once I acquire them, they book in CFS also, it will come. So in CFS, first and second year's expense is not coming. Now in their book it is SBPR. In their book it's SBPR, but in CFS I can't write it as SBPR. In their book it's SBPR, CFS it can't be SBPR because I am not going to issue share. B Limited is going to issue share. Subsidiary is going to issue shares. Subsidiary going to issue shares to someone else. NCI increases. Subsidiary going to issue shares to someone else. What happens? NCI increases. Are you getting my point? Okay, so over here, first 2 years expense is there in SFS. CFS mein nahi aa raha hai. I will include it in CFS. How do I include in the CFS? I'll credit NCI. Opposite effect automatically comes in goodwill. So pre-combination period, same way you do pre-combination period, post-combination period, but here we don't credit SBPR, here we'll credit NCI. Because I cannot write SBPR in my book. I am not going to issue share, subsidiary is going to issue share. So I'll write to NCI, opposite effect comes in goodwill. Acha, post-combination period mein, in their book it will be SBPR, our book mein it will be NCI only. Okay, so whenever you acquire control by purchasing equity interest, this will come into picture. And in standalone book of acquiree, it appears as SBPR, but CFS mein I cannot write, it will appear as NCI. We cannot show it as SBPR because we are not going to issue shares. So accounting same way. Pre-combination period, post-combination period. Pre-combination period is a part of your PC, but we don't write in journal entry to SBPR, we'll write to NCI. Difference automatically goes in goodwill. Subsequently also, whatever expense is coming, third year, fourth year, fifth year, credit will be given to NCI. Moving ahead. Okay, coming to contingent liability. Coming to contingent liability. Okay, now see, contingent liability coming under business combination. Acquiree had some contingent liability. Contingent liability can be two types. One, it's a possible obligation, may come, may not come, arising out of past event, the occurrence of which will be confirmed upon happening or non-happening of uncertain future event. Or it may be a present obligation. So present obligation, but it was not recognized. Reason 2. 1. Outflow of economic resources was not probable, or the reliable estimate of outflow could not be made. The The outflow was not probable or reliable estimate of outflow could not be made. So even though it was a present obligation, it was not recognized. Achha, if contingent liability is a present obligation, if contingent liability is a present obligation, they were not able to measure reliably. When I am acquiring them, if I am able to measure reliably, then such contingent liability will be recognized at acquisition date fair value. So in your book, you record contingent liability as actual liability at acquisition date fair value if it's a present obligation which we can measure it. Outflow not probable doesn't matter. If outflow is less probable, the fair value will come less. So if it's a possible obligation, if it was a possible obligation, continue it as current liability in our book also. But if it's a present obligation, then if we are able to measure it reliably, we'll be recording it as actual liability, acquisition date fair value. Okay, check out. If it's a possible obligation, in business combination also not recognized. But if it's a present obligation, we will recognize it if we are able to measure it reliably. Outflow of economic resource not probable doesn't matter. If outflow is less probable, the fair value will come less. Achha, if we are not able to measure reliably, then we can't recognize, then we will also show it as contingent liability only. And we record on day one. If it was basically a present obligation, we are able to measure it, we will record it as acquisition date fair value pe. Uska later changes will go in P&L. And if question gives contingent liability with the acquisition date fair value, we always assume it's a present obligation, we are able to measure it reliably. Okay. Now, the contingent liability will record, okay, if suppose we have a reimbursement, indemnification, the reimbursement receivable has to be booked as a separate asset. I repeat, reimbursement receivable should be booked as a separate asset. You recognize the fair value of indemnification asset as a separate asset on acquisition date. If indemnification is going to come, the indemnification asset you book it separate. Indemnification cannot be more than the liability. So indemnification asset, uska value cannot be more than the value of contingent liability which we have recorded. So don't record contingent liability, or basically when we are recording it as actual, don't record net of indemnification asset. Indemnification asset, show it separately on asset side. Okay, coming to question 30. Company A acquires Company B 1st April 1. B is sued by one of the customer for 250 rupees. The seller provides indemnification for any loss greater than 100. Achha, 150 rupees ka indemnification will come. So you record a liability of 250 opposite 150 rupees greater than 100. 100 ke upar kitna hai? 150. That you show it as reimbursement receivable or indemnification asset. Okay, next one. Question number 31. P is sued for rupees 2 crore. Indemnification is up to rupees 1 crore. Now fair value of liability 70. If fair value of contingent liability 70, we record a liability 70. So indemnification asset cannot be 1 crore, it will be restricted to 70. Achha, if liability is 1.2, so liability 1.2, opposite indemnification asset will be 1 crore. Moving ahead. Keep smiling, pay attention. Okay, NCI. 20 minutes more. Okay. As per Ind AS 103, see, whenever we are acquiring someone's business, even though we acquired basically 80%, I'll record 100% assets and liability. So 20% assets liability belonging to someone else, we are required to show it as NCI. NCI can appear as per two ways. NCI can appear as per what? Two ways. One, proportionate net asset belonging to them or fair value. If NCI is at proportionate net asset, assets and liabilities came, uske related net assets I am showing. So asset side 20 is related to them, I show 20 on liability. Okay, fine. But if we show NCI at fair value, the asset side 20 belongs to them, but the fair value of NCI based on shareholding, fair value of NCI based on the price of shares what they're holding is say 25. The asset side 20 belongs to them, I show them at 25, extra 5 goes in goodwill. So whenever NCI is at proportionate net asset, goodwill is only related to our share. But when NCI is at fair value, the goodwill can be related to our share as well as NCI share also. So 20 ki jagah we show them at 25. Net asset mein 20 belongs to them, but we are showing 25. The extra 5 opposite mein goodwill will come. Okay, how do I find out goodwill or capital reserve? How do I find goodwill or capital reserve? Consideration by acquirer, that is for 80%. NCI. That's for 20%, either at proportionate net asset or at fair value belonging to NCI. अच्छा, this is on acquisition date. ये acquisition date का fair value लेना है. Less fair value of identifiable assets and liabilities on acquisition date. Difference is goodwill or capital reserve. Clear? ठीक है. Important is you need to take basically NCI of acquisition date, either at proportionate net asset or fair value. Okay, coming to question number 5. Coming to question number 35. Now check over here. Company A acquires 70% of Company S for 5 million. You intend to recognize NCI at proportionate share of fair value of identifiable asset. Means NCI is at proportionate net asset. And measure the net asset at 10 million. ठीक है. तो 10 million is net asset. NCI 30% becomes 3. NCI is 3. Okay, we paid 5 plus NCI 3, 8 fair value of net asset 10. Your gain on bargain purchase is 2. Gain on bargain purchase is 2. So you're required to calculate gain on bargain purchase 2. But question is not that. State whether the procedure followed by A and the resulting measurement bases are appropriate. ये important है. State whether the procedure followed by A and the resultant measurement bases are appropriate or not. Now see, normally they are telling under Ind AS that under business combination gain on bargain purchase doesn't come. See, why someone will sell you at a lower rate? But generally gain on bargain purchase doesn't come. Goodwill only comes. If gain on bargain purchase is coming, you try to be double sure. How to be double sure? The fair value of assets and liabilities are proper or not, NCI is proper or not, something which should have been included in business combination is included, or something which should not be, like a settlement of pre-existing relationship, something which should not be business combination it is excluded. So that all you try to be double sure, and then you see whether basically gain on bargain purchase comes or not. So generally business combination will not have gain on bargain purchase. Extremely rare cases if it's coming, the acquirer shall assess the following before recording that gain on bargain purchase. What? Any transaction which should be accounted separately. Procedures used to identify fair value of identifiable assets and liability. Procedures used to measure the fair value of consideration transferred. Procedure used to determine the fair value of NCI. They are all proper or not, that needs to be double sure. And accordingly, A concludes that the procedure followed and resultant measurement base are appropriate. Based on that, gain on bargain purchase comes 2. Achha, now sir, gain on bargain purchase, where does it appear? If reasons for gain on bargain purchase are clear, if reason, like it was a distress sell, so if reasons for gain on bargain purchase are clear, it comes in OCI. From OCI, it gets accumulated in other equity. OCI to other equity. If reasons for gain on bargain purchase are not clear, it will go directly in other equity, capital reserve. So reasons clear, OCI to capital reserve. Reasons not clear, directly in capital reserve. Okay. Next, question number 36. Question number 36. Again, it's a simple question over here. This is similar to earlier one. We are required to find goodwill or gain on bargain purchase. Chalega. You can do it on your own. Moving ahead. Okay, step acquisition. Moving ahead, step acquisition. What is a step acquisition? The control comes in stages. Acha, the first lot doesn't give you control. Subsequent lot is giving control. 30 tha, we acquire another 30. Now control comes. The first lot mein control was not there. Control coming in subsequent lot. Already 60 was there, plus we acquired 20. No. Already 60 was there, plus we acquired 20. That's not covered here. Okay, so whenever business combination is acquired in stages, business combination acquired in stages, the earlier investment what we had is to be remeasured. The earlier investment what we had is to be remeasured. And see, earlier investment was nothing but equity instrument. So if it was equity instrument, either it would have been valued as per Ind AS 109. And as per Ind AS 109, if it was subsidiary, if it was associate or JV, either cost model was followed, or it might have been fair value through OCI or fair value through P&L. Normally investment in equity is fair value through P&L. Normally investment in equity fair value through P&L, unless you choose a irrevocable option. आपके पास irrevocable option है to measure it at fair value through OCI. So if you go for irrevocable option, fair value through OCI, it may be there. Otherwise, it will be at fair value through P&L. If it was associate, you could have carried at cost also. Okay. So if earlier equity interest held is remeasured, so what do I do? Difference. If it was at cost or FVT P&L, difference goes in P&L. If basically it was FVT OCI, the difference goes in OCI. So earlier you have to remeasure. And now when you are finding goodwill, now whenever you are finding that goodwill capital reserve, so how do you find consideration by acquirer? The current consideration plus the fair value of earlier interest held. Plus the fair value of earlier interest held, that needs to be taken. Okay, the checkout. So in case of a step acquisition, upon obtaining control, you have to remeasure the previous equity interest held, and the gain loss, it goes in P&L if it was carried at cost or FVT P&L, and it goes in OCI if it was carried at FVT OCI. Okay? Plus one more thing, prior period. Earlier it was just equity instrument through OCI. If it was equity instrument through OCI, the accumulated balance in OCI, every time it was fair valued, the accumulated OCI balance. So upon becoming subsidiary, you assume that associate or that is basically disposed of. So equity instrument through OCI, the accumulated balance in OCI, it's like that investment is now disposed of. So now what do? If investment disposed of, to uske related OCI balance, you remove it. It's an item not reclassified to P&L, transfer it directly to retained earnings. And how do I find goodwill capital reserve? The current consideration plus the fair value of equity interest held. Add NCI, either at proportionate net asset or at fair value, unless the fair value of identifiable assets and liabilities, difference is goodwill or capital reserve. Now this remeasurement of earlier equity interest held, all that things what we are doing, it's only for the purpose of CFS, not for the purpose of SFS. It's only in CFS. Now in CFS, that investment goes away. The related OCI balance should also be going away. It's item not reclassified to P&L. That's why I told you take it in retained earnings. Okay, moving ahead. 5 more minutes. Sir, what if this chapter doesn't get over? Don't worry yaar, kal kar lenge. Instead of 4 days, it might take 5 days. Usse zyada kuch nahi hoga. Okay, coming to question number 37. Company A acquired 5% of company B for rupees what? 1 lakh. Okay, 5%. It was fair value through OCI. And as at 31st March, it's at fair value. There's unrealized gain of 5,000 in OCI. Now you acquire 95% more. Okay, now you acquire 95% more. 1st April. 31st March only it was fair valued. 31st March only it was fair valued. 1st April we are acquiring. Now the earlier equity instrument 5% is to be remeasured, but there's no remeasurement gain loss. Leave it. There's no remeasurement gain loss. वो कुछ नहीं है. So in your book it's 105. Accumulated OCI balance 5,000. Now how do I account for it? That is like that investment is disposed of. Reason, now it becomes a subsidiary. In your CFS, investment goes away. The related OCI balance 5,000 lying in OCI, that gets directly transferred to retained earning. So check in CFS, investment goes away, related OCI balance should also go away. So that 5,000 should go in retained earnings. Now how do I find out goodwill? So current consideration for 95, previous equity interest ka fair value 105, 1,05,000. So to find goodwill capital reserve, the fair value of equity interest held 1,05,000. This will be added to the fair value what we are paying for this 95, and you will compare it with identifiable net assets. Okay, question number 38, important. Last question of the day. Okay, question 38, last question of the day. I understand it's getting delayed, so I'm keeping it up till here. Last question of the day. Okay, pay attention. 1st April 1, PQR acquired 30% for 8,000 crore. And you know, 30% it was an associate. If it's an associate in your CFS, in CFS, the associates are accounted by using equity method. Our share in profits are included. So as per equity method, we have included our share of profit, some share in P&L, some share in OCI, and revaluation also in OCI. So we have included this. So in your CFS, in your CFS 8000 tha plus 700 plus 100 plus 50, तो total 8850 is the carrying amount. 8850 is your carrying amount. Now what happened? You acquire remaining 70%. Okay, when you are acquiring remaining 70%, to find goodwill capital reserve, the earlier equity instrument held is to be remeasured. Acha, they have to be remeasured. The fair value of 30% is 9,000 and net assets ka fair value 30,000. Okay, 30% already held is 9,000. In our book, it is 8850. In your book, 8850, remeasured to 9,000, 150 rupee gain. 150 rupee ka gain comes, that goes in your P&L. 150 rupee gain goes in your P&L, assuming in SFS it's carried at cost. Associate tha, it will be carried at cost in your SFS. Okay. Now finding goodwill or capital reserve. How do I find the 150 rupee gain comes? That goes in P&L. Fine. Now goodwill capital reserve. So for the 70%, for 70% we are paying is 25. For 30%, the fair value 9,000. Fair value 9,000. Add NCI 0 because 100% hamara hai. And minus the fair value of identifiable net asset is 30. Goodwill comes is basically 4,000. Acha, so now we did two entry. So remeasurement gain we took in P&L. Remeasurement gain we took in P&L. Investment became 9,000. 8850 remeasured. And now this entry, net asset comes in 30. Goodwill comes in 4. We paid 25. NCI is nil. And investment also goes away. Our investment goes away 9,000. So one entry was this, second is this. ICI passes a combined entry. ICI क्या करता है? Combined entry ICI does it. We passed two entry. Acha, one more thing. Now in your CFS, what happened? Now in your CFS, what happened is your investments are gone. So related OCI balances. Yeah. If investment are gone, the related OCI balance should also go away. The share of exchange difference in OCI, it's item reclassified to P&L, so that you take it in P&L. And revaluation reserve is item not reclassified to P&L, that you take it in retained earning. So share of exchange difference debit ho jayega, P&L credit. Revaluation reserve debit ho jayega and retained earning credit. So check out two more entries will be there. Check out two more entries will be there. Okay. Upon acquisition of 70%, it does not remain an associate. So whatever was included in OCI accumulated, wo sara needs to be removed. The share in exchange difference is item reclassified to P&L, it goes to P&L. And revaluation surplus item not reclassified to P&L, it goes to retained earning. So see how many entries we passed? 4. Investment we brought to today's fair value. Second, acquisition entry, difference goodwill mein gaya wo. Third, earlier OCI balances now are not there. Investment goes away, related OCI balance goes away. One was item not reclassified to P&L, one was item reclassified to P&L. We did 4 entry. ICI passes a single entry instead of 4 entry. ICI passes a single entry instead of 4 entry. Did you understood? So ये चारों entry का combination is given in this entry. Okay, so we did till here business combination without transfer of consideration, say it is pending. Business combination without transfer of consideration, from here it is pending. I'll continue it tomorrow. Oh, the today's target not achieved. We are still far behind of the target. Okay. Important is to ensure you are able to understand properly. So I hope this revision is basically helping you out. It is in depth, the coverage is proper. Any suggestions you have, you feel free to tell it to me. If you're there on our Telegram channel or you have my Telegram, you can directly DM to me. All your suggestions etc. related to this are welcomed. And if you like it, do share about it to all your friends, circulate amongst your friends. This is really exhaustive revision. I'm telling you, preparations will be done in a more better way. And my personal suggestion is whatever is done today, whatever you revise today, you do tomorrow. Aap wo karo kal. So tomorrow you do all the topics which you have done today. Then whatever we revise tomorrow, that you do day after tomorrow. The 4 days what we are doing here, the same thing you're going back and revising again. So this all things will become perfect from your side. And we are finishing anyways by 26, 27. still you are having 4 to 5 days for your self-study later on as well. And just remember one thing, success is not by doing great things, it's just by doing small things with great discipline. The last 1 month, ensure you have the greatest of discipline and you are not giving up or taking lightly in this last 30 days. Chalo, see you all tomorrow, same timing, evening 5 o'clock. Till then, tata, bye-bye, take care, good night and Shubh Ratri. Thank you, Binduja. Thank you, Girdarlal. Thank you, Nikita. Thank you, Rohini. Thank you, Jitendra. Thank you, Bhaskar. Thank you, Shakil. A Telegram channel, you just type over there CA Niket Thacker. You have two things. One is basically a channel, other is a discussion group. The discussion group is two-way, channel is one-way. Just write CA Niket Thacker, Niket. Bye-bye, Nikita. Chalo, bye-bye everyone. Good night. Take care.